10 trading sessions. But think about it. Russia-Ukraine sort of conflict settles down automatically. Hopefully, I mean, that 25% penal tariff goes away and we get access to cheaper oil and without President Trump's ire in that sense. And of course, I mean, it has a calming effect on the rupee as well because of the trade deal and an agreement, etc. So it's all one big linked thing as we look at the next few months or so. U.S. equities closed mixed. S&P down about a quarter. NASDAQ was up a little bit. You had the jobs number which came through. I mean, the November number, jobs added were about 64,000. Expectation was about 50,000. But unemployment rate rose to 4.6%. It's the highest since 2021. Not very much move in terms of macro markets. The 10-year was down about 3 basis points on the yield. 4.15 is where we finally left off. And by the way, the jobs data has not done very much to change market expectations for 2 more Fed rate cuts, that is in 2026. I'll just tie in and look at the levels quickly. So the downside level is, and it's not changed basically, but despite yesterday's very sharp fall on the Nifty Bank, and of course broader markets which fell 1% as well, 25,750 is where the sort of support. It's not a moving average or anything, but it's a cluster of support. 25,750 and 58,850 is that level on the Nifty Bank. So we are closer to it as of yesterday's close than we were day before yesterday. And of course, on the upside, the 20 days have been acting as a bit of a level. 26,028 as of yesterday's close on the Nifty and 59,299 on the Nifty Bank as well. So that's where we stand with yesterday's session and looking ahead into this Wednesday's session. 20 points lower on the GIFT Nifty. Nigel is now standing by with what's happened on the F&O side, positioning, etc. Nigel, over to you.
Well, that's a point well noted, Prashant, with regard to the Brent crude prices still hovering at very, very low levels. From an India macro perspective, that's good news. And you'd like to see some stability on the rupee. And one would believe that maybe, in fact, the rupee could peak out, at around this 91.5, 92 odd mark, given that we'll get into a seasonally stronger period in the next quarter itself. Getting back to the equity markets, that in yesterday's trade, the final tick was at the low point of the day, but it was the weekly expiry as well. So the bulls will hope that some part of this is an expiry-related move, and that could reverse. So that's one factor that we'll be tracking. Besides that, a mild positive that I would look at it. Yesterday, yes, the Nifty ended down by close to around 160 points odd. The India VIX still is at very, very low levels. So that's telling you that the fear is still not in with regard to the headline index itself. So we'll keep an eye on that. Nifty cooling off, VIX cooling off, that's normally not such a bad thing. And the Nifty Next 50, that as well ended lower, but that has been a relative outperformer for the last few trading sessions, which is heartening actually because the broader markets have absolutely got pummeled. Moving to the institutional data, well, in yesterday's trade, there was something that happened in terms of the flows that hasn't happened earlier. And it's not happened since the end of October because the FI selling outweighed the DI buying, and the institutions, they turned net sellers for the first time since the 30th of October. This is the FI and the DI data put it together. Moving to the futures data, well, the FIs, they added shorts, both on the index as well as on stock futures. And that's clearly evident on the screen. There is some unwinding of long positions and some shorts that are creeping into the system. The FI short positions now at around 91%. So they're getting to the upper end of the range, normally at around 92% or thereabouts. That's where we've seen them peak out. And at 91% as well, they're aggressively net short on the index itself. You need some good news, whether it's a trade deal, whether it's something on the domestic front. That's what could cause these shorts to get a little bit, a little bit uncomfortable. The PCR has moved down to around 0.9. Remember, it was at around 1.2 odd. So to pull up, the strikes that were fairly active in trade yesterday, 26,000 call, very active, 25,900 call, very active. And on the downside, this 25,900 put as well was active, and the premium was ballpark around 150 rupees, which if you put that in, then you get your levels. Support 25,750 going by the options data, and resistance 26,050. That's the near-term resistance. So that support level has been moving down as the week has been progressing, and that's the important mark. You don't want that to break. In fact, if you pull up the Nifty, the 20 and the 50 DMA, that perfectly tallies in with that range. So on the upside, you have the 20 DMA, which is at around the 26,050, and on the downside, 25,750. The Nifty Bank, well, in yesterday's trading session, it showed some weakness. In fact, it closed below that 20 DMA, which is a bit of a worry. So you'll want it to get back above that because that's where the action is. That's where, the bulls believe that we'll see a bit of a fight back. So the Nifty Bank needs to find its form. Support where it's been bouncing off late, 58,500 on the upside. That's the crucial resistance mark. So let's see whether or not the bulls can fight back, because yes, it appears it was more an expiry-related downtick that we did see.
Oh, absolutely. So let's see if the bulls can find their feet today or not. By the way, just a couple of interesting points. Yesterday, after that jobs data came out, the U.S. Labor report, the dollar actually fell, and the dollar is close to a 2-month low now. And the dollar index has come off so significantly. 1 month back, the dollar index was at 100. Yesterday, after the data, it fell to 98.20. This morning, it's recovered a little bit. But this at a time when, the Indian rupee has been doing its own thing, absolutely paying no attention to the overall dollar weakness and sliding even more. So that's something that we are going to keep an eye out on. And by the way, after the jobs report yesterday, there was some buying in gold because all said and done, October, there was a fair amount of job loss. The November numbers were better than expected, but it seems that, there is a debate out there. So yesterday, gold rose a bit. This morning, silver, pull-up silver is up 3.5% this morning. So that excitement in the precious metal space, that continues. Yeah, there we go. Look at international silver prices, 65.53 on the screen now. Quite a move over there. Asian markets are fairly mixed. Let's pull up the ones that we have for you and then the implied open. Again, not too much of clarity after the jobs report yesterday. So you got some of them like the Nikkei, the Hong Kong market, mainland Chinese markets are flashing a little bit of green. Does that mean that we'll bounce back? Let's see where the gift open is, where the gift Nifty is and where the implied open is. After yesterday's drubbing, will we continue to be in that range? Right now, it's anyone's guess, about 18 points lower. All right, let's welcome our first guest on the show, Conrad Saldana, Managing Director and Portfolio Manager at Neuberger Bergman is with us. Conrad, thanks so much for being with us. Season's greetings to you. Hope you're getting all set for a fantastic Christmas break. But before that, I want to start with how you're viewing this decline in the Indian currency. Because apart from taking your call on asset allocation over here, the kind of stocks you want to own, currency seems to be a big factor, down 7% this year. How are you thinking about it?
Thanks, Rupee, and season's greeting to you as well. It is a little surprising, given that the dollar has been relatively weak. Now, I'd say the conundrum also is not just the rupee; it's also been the Japanese yen. But for the rupee, given the export data that's coming out, is proving to be more resilient to the U.S. I think it's probably the fund flow argument that's pressuring it a little bit, given the FI outflows continue. I think it was a couple of $100 million. But it should see some stabilization here, but it seems to be in a bit of a free fall and defying most other currencies as well. So it was a bit of a conundrum, especially if you're looking at returns in dollar terms for foreign investors. It has been a big underperformer.
Yeah, which was my question, Conrad, that whether going forward, as you take your allocation calls to India, whether you'll be a little more hesitant, if at all, looking at the way the currency is behaving, and whether that's the kind of conversation that you hear around. I mean, till now, allocating to India is, the deciding factors are earnings growth, AI or no AI trade, etc. But now, will currency become another impediment?
Yeah, I mean, that's always a factor for a hard currency investor from whether it's the US or Europe, right? And I think it will come back to, again, I think it's sentiment, right? And it's been so negative. What are the other choices? And so in a relative context, if the AI machine keeps on working, giving you earnings growth, when that fades, my guess is India would be the alternative investment, right? In a sense, much more domestic oriented, but you need to see that growth come through as well. So I'm less negative about that. But the alternatives has been when India was doing so well. It was China that was seeing the brunt of the outflows and a lack of investment. Now you've seen that turn around where China, Korea, in fact, this year has been star performers. So those have seen tons of inflows coming through, but you've seen that in share price performance, but also in the earnings growth coming through. So I think the setup for India looks a little better into next year, but we'll have to see in terms of does real growth come in softer, but potentially inflation with the depreciation of a rupee, does the inflation factor creep up? So maybe nominal GDP growth actually turns out fine, right? But the mix of that might be slightly different, and hopefully that transmits into better earnings per share.
Okay, all right. Good to get that perspective, Conrad. Morning, Prashant here. So as you look into 26 from a portfolio perspective, I mean, are you sort of happy to hold what you own? and we've discussed some of the names in the past. Would you be looking to make any changes? Any parts looking more attractive? Others looking a little more challenging? Has the setup changed at all from a portfolio perspective?
I would say the setup the hasn't changed significantly, but I think the biggest change you've seen in the last 3 months has been a bit of a destruction in the small and mid cap space, right? And with that liquidity coming out, you saw an acceleration into the outflows. But so I do think that they're starting to look more attractive. And there are not many takers right now. I think most strategy here would be, listen, if foreigners want to come in, the first port of call is to come into the larger cap names. I think on infrastructure, you got L&T looking good. I think the bigger banks are fine. The credit quality is not deteriorating. Potentially rate cuts, while could be happening in the West, especially in places like the US. In India, I think it's not a foregone conclusion given how much the rupee has slipped. So I would say that that's another good area with the larger banks still executing. So I'm constructive on that. But I do think the dark horse really is the small and mid cap space that was once the fancy of most funds. And has really gotten hit pretty hard and is starting to look attractive fundamentally. I'm not sure what turns it around apart from them posting good numbers and the market coming back, but that would be a second derivative as the fund flows start to come back.
All right, Conrad, name a few stocks, right? In the past, we've spoken about, I think, HDFC Bank, SBI, Axis Bank. Those are stocks that you like, in NetWeb as well as Orient Pro. Anything new that that y'all have added? And also, I think y'all had a view on EMS, if I'm not mistaken, some time back. The EMS space, though, it has a big potential. Some of the stocks have come off. Did y'all get in?
The ones, Nigel, I think when you look at the EMS space, some of the smaller names have really gotten impacted. I would say, to me, the bellwether has and will be Dixon's. This is a name, just met with management recently in New York. They're executing. Yes, when you look at the end markets on the consumer space, it's a little bit softer, and they are more geared to mobile phones. But it's still a market share gain for them. So I think that goes unabated, and then they continue to expand their verticals. So I do feel that, listen, one name that's a bellwether longer term, that thematic has not changed in terms of more production in India and using it as an export engine just to diversify away from a risk standpoint for most companies globally. That has not changed in my mind, irrespective of the tariff jurisdictions. And I think part of the problem is that these tariffs haven't gone away, right? From the U.S. standpoint, but for the exceptions that you have in phones, etc., I do think that that there's an offering for India here. Dixon's is one that I think comes out as among the listed space as having the best runway and the best execution.
Okay, all right. We'll leave it there, Conrad. Great conversation and very useful to get that perspective. In case we don't speak again, wishing you, your team, your family a very happy new year, and see you in the new one.
Same to you, Prashant and Nigel and Survi. Thank you. Cheers.
Thank you very much. Okay, well, I'll just quickly run you through the interactions you'll hear on the program on the channel over the next 2.5 hours. So, Deven Choksi at 8:30 will be talking stocks, individual names from yesterday, follow through, and of course, new ones. 9 o'clock, Ajay Parekh of Soham Asset Managers talks to us about Vedanta, that green light from NCLT for demerger. 9:20, Mahesh Patil, CIO at Aditya Birla Sun Life AMC, is a market master of the day. 9:35, Patanjali Foods will be with us, and we talk about outlook for 2026. FY27. And we have the top team from the Bank of America equity team to talk about the 2026 outlook. We'll cover strategy, hospitals, pharma, and autos. And a little later, we've got a macro discussion lined up with Jahangir Aziz at 10:15. That's It's the Economy. Lata will carry the conversation forward.
Time to slip in a short break. Got a lot of stock-specific action track for you. We get to that in just a bit in our special Top 10 segment. We're looking at Shriram Finance, Indian Overseas Bank, Glenmark Pharma, Lupin, TCS, Keynes, eClerx, as well as Ahluwalia Contracts. All of them will be reacting to positive news flow. On the flip side, AkzoNobel as well as Ola Electric will be reacting to negative news flow. Take that break, come back. We get into further detail on all of these names.
Welcome back. So the cues across Asia are mixed, but there is some green. Now that's not entirely translating into a very buoyant-looking gift Nifty. And there's still some caution out there. If you're looking at the implied open, it's suggesting that it'll probably start 15, 20 points lower. By the way, the whole financial space is going to be in focus because of the deal that's happened in the unlisted financial space here in India. And that is the Japanese giant Mizuho coming in to buy a majority stake in Avendus, which is obviously an investment bank here. They're putting $500 million to work. So we'll talk about this. We'll talk about the financial space. In fact, that brings me to our list of stocks that we should focus on. And we have our team standing by with all the key movers and shakers of the day. Guys, good morning to all of you. Oh, okay. I think Gaurav is hitting it off. And since I was just referring to financials, Shriram Finance is going to be in focus. Their board meeting on raising capital is finally happening, I think. Gaurav, tell us more.
Well, as Shriram Finance is in focus, and the reason being that 19 December is a date where board meeting will happen, where company will consider fundraising, which also includes QIP. Now, why this is important is that, as you mentioned about the Japanese players, it seems that Japanese players are already and actually very interested in the Indian financials, because we have seen some deals happening, and there are some reports which suggest that MUFG Group, which is a Japanese group, is interested in buying 20% stake in Shriram Finance for a valuation of around $3.2 billion, which roughly translates to around 29,000 crores. Now, if you look at Shriram Finance, it does not need capital right now. The CET ratio is well about 20%. But if you look at why this is important for Shriram Finance is that it will bring fresh capital to the company. It will bring down the cost of funds, and at the same time, given that there will be some big name coming up in the company, there is a case of credit re-rating which will further reduce the cost of funds. Now, if you look at the stock performance in the last 6 months, we have already seen Shriram Finance giving stock returns more than 27%. And even if we look at the valuation, currently it stands at 2.2 times price to book on FY27. If you compare it with the closest peers, which is Chola Finance, it stands at around 4.1. So definitely there is also further headroom for growth in terms of valuation as well. Specifically, if you look at management, earlier they had denied categorically, but during the conversation with us, management said that there will always be many discussions going on and there will be some interested parties. So that was something which we took as a hint. Apart from that, IOB is something which will be in focus because government is going to sell around 2% stake in the company. Now remember, government holds more than 94% in the bank. So they are going to go with OFS to reduce the stake further. And remember, there is also a requirement of minimum MPS, which is around 75% of the stake, where government has to bring it down to 75%. And given that IOB currently stands at around 94%, where government holds 94%, it is important for government to bring it down. This OFS, it's coming at around 34 rupees per share, which is 7% discount to the current market price. But let's not forget that the price to book is at around 2 times for the bank. So definitely this bank is also going to be in focus today for trade.
Gaurav, thanks very much for that list. Appreciate it. Well, let's talk about pharma now. Ekta is here with news on Glenmark and Lupin. Ekta, morning.
Morning. Well, I'll start with Glenmark Pharma. It is in focus because it's entered an exclusive licensing and distribution agreement with Hansoh Pharma, which is basically for treatment of a non-small cell lung cancer drug, basically a drug for lung cancer. And Glenmark will be receiving exclusive rights to develop and commercialize it in licensed territories such as Southeast and South Asia, Middle East and Africa, Australia, New Zealand, Russia, CIS, etc. Now, Hansoh is going to receive an upfront payment of low double digits, a million in USD, milestone payments which could possibly accumulate to over around $1 billion, and tiered royalties on net sales in the licensed territories. So Glenmark has said that the reason for them to do this is basically to build and to strengthen their oncology portfolio and near-term commercial pipeline. However, there is an outgo of money which Glenmark will be putting in. So the street will really be waiting to see how the potential of this drug is going to pan out. Now, Lupin is going to be in focus because their Nagpur facility, which was inspected in September, received 6 observations, is now cleared. It's received an establishment inspection report with a VAI, which is basically a voluntary action indicated status. So that stock should be in the green.
All right. Thanks a lot for that, Ekta. Well, let's hop across to Hormuz. Hormuz, a couple of interesting large trades is what we're looking forward to today. That's on AkzoNobel. And Ola Electric promoter cashing out. Tell us more.
Morning, Nigel. And yes, you start off with Ola Electric. That was the bigger announcement last evening. And they informed that Bhavish Aggarwal, the promoter, sold around 0.6% stake. It was a 92 crore block deal that he sold. And the company later put out a statement saying that the stake sale was done to ensure that the promoter loan of close to 260 crore was repaid, and thereby removing the overhang of pledged promoter shares in the company. Of course, it remains to be seen that the 260 crore loan repayment involved only a 92 crore block deal. The other one being the fact that Bhavish Aggarwal still has a 30% stake in Ola Electric as of September of 2025. The stock, of course, trading at record lows. The IPO price of 76 rupees, so down 54% from those levels, and a post-listing high of 157, and it's down almost 80% from those levels. So, of course, going with red for Ola Electric. And the other one, of course, is AkzoNobel. There's a block deal where the promoter entity is going to sell up to 9% stake. That block deal valued at around 1,300 crores. The floor price is a 13% discount to yesterday's closing price. The promoter entity, which is Imperial Chemical Industries, had a 45% stake in the company as of the September quarter. So keep an eye out on this. It'll be interesting to see who are the buyers that emerge in the deal. But still, initially going with red for AkzoNobel as well.
Okay, all right, got that. Lots of buying and sellings in those deals. Make for interesting news for sure. So both Ola and we'll watch out for the other one as well. On to Upasna. Then Upasna, you're watching out for a bunch of names. Tell us which ones are they?
Well, certainly. Good morning. First up, let me start with TCS. Now, according to a Mint report that the company has bagged a mega deal valued more than $1 billion revenues from Telefonica, UK-based company. Now, when we reached out to the company has responded stating that it's a purely speculative report and company has not commented on the same. Next up is Keynes Tech. The Keynes wholly owned subsidiary, that is Keynes Semicon, announces strategic partnership with AOI Electronics and Mitsui. Both are Japan-based companies, and the key rationale behind this is to strengthen its upcoming semiconductor manufacturing operations in India. Now, company says that these alliances are expected to play a crucial role in advancing companies' ambitious target in terms of semiconductor and even India's global semiconductor hub target mentioned by the PM. Now, Eclairic Services also in focus. Now, buyback price has been increased from 4,500 to 4,800 per share. Consequently, the maximum number of equity shares proposed to be bought back will be reduced from 6.6 lakhs to 6.25 lakhs. And lastly, we are looking at Ahluwalia Contracts as well, as the company backs order worth 888 crore from Bihar State Tourism Development Corporation, and the execution timeline is nearly about 42 months. So all in all, we'll be watching out for all these stocks in today's trading session.
Okay, all right, all of them on our radar. Thank you very much for that, Upasna. Let's quickly recap our list of stocks to watch then. The ones that have positive news flow around them would be Shriram Finance, Glenmark Pharma, Lupin, TCS, Keynes, eClerk Services, and Ahluwalia Contracts. Stocks with negative news flow, largely on the back of share sales that are likely to happen in the market, would be IOB, AkzoNobel, and Ola Electric. Okay, so that's our stock list for the morning. Now let's find out what's happening in the world of commodities. And we have Manisha joining in with the latest. Manisha, I didn't notice anything else, but one thing is that oil is falling and silver is rising. There's no stopping the silver rally. What's the latest?
Well, that's exactly the headlines today coming in from commodities. You have silver, which has now gained 3.5% in the overnight market. And even as a lot of people are now getting cautious because you've seen a 127% of gain come in for silver. I mean, it's not like a small cap or something. It is a precious metal. It's a globally traded commodity. And the way it has been surging, markets do believe that the momentum perhaps could still be on the higher side. We already are trading above $65 an ounce, and markets do believe that by the time we close this year, it could perhaps be well within 65, 68. We would have achieved those kind of levels there. But yes, there is a very sharp profit taking in the meanwhile come in for the crude oil prices. 3% of a decline in the overnight market. It's trading at the lowest since 2021 right now. This is the third straight year of decline in crude prices, and we are down by 23% in this year. It has been about surplus that is coming in from OPEC Plus, which is reviving its idle production. And the non-OPEC production also continues to be on the stronger side. And meanwhile, you have weaker demand strengths coming in from China, Middle East and US, and that continues to weigh onto the markets. But the street will watch out for many central bank meetings that are expected this week. You have Japan, England, European Central Bank. So further cues for many of these commodities will come in from here.
Okay, all right. Manisha, thank you very much for the latest. We'll take a break on that note, come up on the other side. And we'll have Deven Choksi joining in. We'll discuss some of these stock ideas and some of the stocks in news with Deven in just a moment.
Welcome back. There's about 25 minutes to go for the pre-open session. The Lok Sabha approved the Insurance Amendment Bill, something we've reported on extensively. This bill allows, the amendment basically allows foreign companies to own up to 100% of Indian insurance businesses. The government believes this will bring more money into the sector and make it stronger. The bill also introduces changes to improve how insurance companies are run and to increase coverage across the country. You know, let's listen into what the Finance Minister had to say first, then we'll get you industry reactions.
percentage of FDI and the number of insurance companies. In 10 of them, less than 26% FDI is there. I said total of 74. In 10 of them, less than 26%. In 23 of them, between 26 to 49%. In 3 of them, 49 to 74%. And at 74%, there are 4 of them who have FDI at 74%. Sir, there is need for growing protection through insurance in this country. We need to have insurance more accessible. Enhancing FDI limit through Section 3AA of the bill to 100% will enable global insurance to inject substantial capital directly without waiting for domestic partner to invest capital in parallel. We are also empowering the regulator. This is very important because many members thought we are empowering the regulator. It's so empowered. It is empowered for a very good thing. That is disgorging wrongful gains. When most of the time wrongful gains happen and somebody's gained it, you don't have the statutory power to disgorge that and give it to whoever have been made to suffer. Now this one will give the power to the regulator to disgorge wrongful gains from insurers and from intermediaries.
All right, so that was the finance minister outlining some of the key features that this bill addresses and the reform, the intent behind it. We spoke with a whole panel of experts, former practitioners and current practitioners from the insurance sector. They all weighed in on what this bill finally means for the insurance space. Listen into the views.
We have been making our position clear on open architecture. More than the insurance companies per se, yes, insurance companies also had its own benefits to look at, but looking at how the customer should be served, it is difficult for an individual to be knowing the products, multiple products of many life insurance companies and going and presenting the right product to the customer. It was not going to be an easy task. An agent representing one life insurance company would have been beneficial for the agent as well as the end consumer as well. We were requesting the government for making this provision available, and I'm sure the government had taken a stand, and open architecture, which was originally proposed or it was being talked about, is not part of the current bill. Certainly LIC stands to gain the sense, as you said.
The fact that we weren't necessarily entirely comfortable on multi-tied agency, given the fact the amount of money that is spent on an agent can vary between 15 to 25,000 rupees that a company spends on training an agent over 3 to 5 years. So that was a little bit of a tricky one, and I'm happy to see that it doesn't find the light of day here. The investment guidelines have been made a lot easier, is very good. I'm particularly excited about the fact that we can now invest in private limited companies, which usually are the companies who have invested in technology and can get early investment, and not just do they gain, but even we gain at the same time.
When it comes to distribution network to be broadened, the IRDA already permits that. Almost about 8 such banking institutions they can tie up with. So this will be really maintained. So the other piece is the merger of the non-insurance with the insurance. There also, I believe, the regulation can come in where they can probably lay down that, if at all any such thing happens, what are the precautions which needs to be taken, and how they will ensure that the liabilities of the non-insurers should not really get into the insurance companies. There can be a firewalls which can be created to really address this concern also.
Okay, there you have it. Big wigs from the insurance sector weighing in on what this big reform really means for them and the overall insurance industry. Let's get in Deven. Of course, we have plenty of questions for him today. So, Deven, it's going to be a rapid fire because we have a lot of ground to cover. Let's start with insurance. What have you made of the bill? 100% FDI. Maybe the foreigners come in. Does that increase competition? Is it good? Is it bad? But for the timing, at least, no open architecture. How do you sum it up? And, give us 2 or 3 insurance stocks, your take on them, avoid, sell, buy, anything.
Yes, Rupee. Good morning. Well, I think the most of the coverage, I think, as far as the insurance is concerned, largely, I think what we are seeing is basically, I think, a possibility for some of these insurance companies in the area of launching of new products. The foreign insurance companies coming into the country, I think they are going to create their own segmentation. Some of the large underwritings, I think, would go to the big net worth foreign insurance companies, whereas some of the micro insurances, the smaller ticket insurances, would go to some of the Indian companies, be it, I think, the likes of Bajaj, or be it likes of Jio. I think they are the likes of those companies who are likely to take the advantage of the micro insurance business, I think, which is going to get opened up for themselves. The larger insurances, I think, are being underwritten by some of the larger foreign companies, and they would have an entry into the country. Whether they would have an entry into the country through some kind of alliance, answer should be yes. I guess I think they should be having ability to invest 100%, but at the same time, I think they would require the Indian partner to definitely, I think, work along with them. So overall, I think we believe that it's a structurally positive move for the sector as a whole. Which companies we feel are think are the most beneficiary? I believe that I think the companies with a balanced portfolio of products, likes of HDFC Life, likes of SBI Life, I think they may remain, I think, relatively more stronger, at least to begin with. But I think the potential wise, if you look at, I think the Bajaj could possibly be a surprise winner in this entire game. So let's wait and see, because they have a good footprint, including, I think, the Geo, they have good footprint. How they evolve into newer products, I think, it remains to be seen. But we remain distinctly positive about the possibilities of some of these companies.
Okay. All right, Devin got that. A couple of other stocks. Shriram Finance. Board meeting comes up tomorrow. There's so much of speculation about whether they are going to get in a Japanese investor now. Your thoughts?
Not honestly evaluated, Surbhi, at least I think this particular possibility is concerned. So would probably wait for the event to unfold and then evaluate.
But do you have a positive view otherwise? At current prices, does it still make sense to buy?
Well, I guess I think overall the entire fabric looks pretty set for the NBFC company as a whole. Not completely, I think, glued on to the Shriram Finance, because I think the larger amount of focus stays with the likes of Bajaj Finance in our portfolio. So we probably remain more comfortable over there vis-a-vis others at this point of time.
All right, Devin, and lots more questions for you. For the time being, though, we slip into a short break. We request Devin to continue to stay with us. We'll get our technical experts as well, who'll join us on the other side. Welcome back. Hope you're having a good morning. Well, let's hop across to Hormuz. As always, he joins us to take us through the big movers yesterday, which were backed by delivery. Hormuz, morning.
Good morning, Nigel. And EPAC Durables is the first name on the list today. And along with those consumer durable names that were beaten out of shape, EPAC Durables was no different. But yesterday, the stock was up 15-16% with the biggest single day gain and volumes since its listing. And the stock also fell to a 52-week low last week, and it has rebounded from those levels. 3.5 crore shares were traded yesterday, the 20-day average of just over 7 lakh shares. And out of those 3.5 crore shares, 25 lakh shares were marked for delivery, the 20-day average of just around 3 lakh shares. The stock, despite this move, is still down well over 50% from its 2025 peak, which is close to 670 rupees. Exicom Telesystems is another stock that moved higher. The stock was up in double digits at one point of time, ended with gains of close to 8%. The fourth straight day of gains for the stock. Volumes were the highest since May of last year, and the stock has gained in 5 out of the last 6 sessions, close to 1.5 crore shares traded yesterday, the 20-day average of just under 5 lakh shares. But again, out of those 1.5 crore, only 8.5 lakh shares were marked for delivery compared to a 20-day average of just under 2 lakh shares. The stock, despite that move yesterday, is trading below its IPO price of 142 rupees, and it is one of those IPOs that was subscribed over 100 times. Very strong investor interest. The stock had made a peak of well over 500 rupees last year, and it's down well over 70% from those levels. And lastly, Nazara Technologies was a name that sprung up among the list of gainers yesterday. The stock has gained in 5 out of the 6 sessions as well. Tuesday's volumes the highest in over a month. Over 50 lakh shares were traded, which is 5x of its 20-day average. And out of those 50 lakh shares, 12.5 lakh shares were marked for delivery, 20-day average of around 6.5 lakh shares. And the stock too has been an underperformer in the last 6 months, seeing losses of close to 30%.
Okay, all right, Hormuz, but we can't let you go at that. Tell us, what about the brokerage calls of the day?
A couple of initiations that have come in, Nigel, on the brokerage front, but we start off with the bigger one, that is Morgan Stanley's note on Reliance Industries, where they have maintained their overweight recommendation, but they have increased their price target to 1847 from 1701 earlier, and this is the second highest target on the street now for Reliance Industries. They are expecting 20% potential upside, yes, but Morgan Stanley is expecting a re-rating and an earnings upgrade every quarter in 2026, and they are saying that this $80 billion worth of investment that Reliance Industries has made since the start of COVID-19 will start to pay off in 2026 across verticals, and that is what is driving their bullish stance. The second one is an initiation on Meesho. We were speaking about this yesterday, the stock being up almost 70% from its issue price. UBS has initiated coverage here with a buy rating, a target of 220. So another 22% upside from the stock that has already surged from its issue price. Now they're saying that the asset light and negative working capital business model has ensured that the company has positive cash flows already as compared to a lot of the other internet related businesses. They're expecting the company's net merchandise value to grow at a 30% CAGR over FY25 to 30, and that will be led by a growth in the annual transacting users that will grow from just under 200 million to well over 500 million between FY25 to 30. Now the other initiation has come in on Orkla India. Contrary to Meesho, this stock is trading below its IPO price. JP Morgan has initiated here with an overweight rating, a target of 745, upside of around 21-22% here as well. They are saying that the earnings growth will gather momentum from the second half of the year, that will be led by revenue growth, margins expansion, and that was one of the factors why the stock has underperformed so far. Their valuations are also inexpensive compared to peers, and they are expecting their revenue and EPS CAGR of 9% and 13% respectively over FY26 to 28. The slower than expected revenue ramp up, volatile raw material prices, and any earnings dilutive M&A activity are some key risk factors for Orkla India, as what JP Morgan has highlighted.
All right, thanks a lot, Hormuz, for joining in and giving us all of those details. Well, let's go back to Deven Choksi. Deven, I wanted to ask you about Ola. You know, people got very, very excited about the prospects. The company seemed to be on the cusp of a turnaround. I recall when the stock listed went to 140 rupees. Then it saw a sharp downtick, and then it doubled to nearly around 75 rupees. But yesterday, the big news is the promoter, Mr. Bhavesh, has come and sold some shares in the open market. They're justifying it that there was some leverage, there were some pledge shares which now get released. But what's your view at around 34 rupees?
Well, Nigel, I think obviously few things are clear. We don't see a differentiator in this particular company's business. And that's where I think we are a little bit circumspect. We have been, I think, from the very beginning. And today, I think it is getting more and more confirmed that peers, I think the likes of Bajaj, the TVS, who are actually, I think, penetrating big time into the market through the distribution reach as well as, I think, the product superiority, as I would call it as. They're relatively better off compared to the Ola Electric in particular. So in my viewpoint, I think this is going to be a little bit more challenging kind of an environment for them unless they create a very significant amount of differentiator for themselves in the product segment. I don't see too much of clarity at this point of time for the company.
No, I got that. Devin, just a quick word, and I'm sure, Nigel, you'll talk about Vedanta, right, in a bit from now. There is an upgrade which was flashing at the bottom of the screen as well. But that is the other news which came out, and stock ending pretty much at the day's highest point. That NCLT merger finally going through. Just your view on it from a stock point of view. And yesterday we had, Rakesh Arora, who's a veteran metals analyst who was with us and who kind of he had a slightly non-consensus view. The consensus is that it's great news. His view was slightly more downbeat, that maybe, and for a bunch of things. Where do you stand in this one, Vedanta, Devin?
Yes, Prashant. I feel that I think leave the Hindustan link aside because it is already a listed company. It is not part of the demerger at this point of time. But overall portfolio of, I think, all the metals that they have, including oil and gas, I think the demerger is a good news because I think if you notice for last 8 quarters or 12 quarters, I think there have been a significant amount of constraint for the company to expand into different product categories, largely because of the fact that I think the balance sheet size was not permitting, at the same time the leverage position was bothering. Now, with this demerger taking place, they have a reasonably good chance of, I think, inviting the higher capital, at the same time deleverage themselves in a systematic manner. And given the kind of metal commodity cycle, particularly for the white metals and also the copper, I believe that I think the company is ready for taking the larger amount of benefit in coming period. So yes, I think there may not be many short-term triggers, I agree, but at the same time, I think the potential looks, I think, quite brilliant from the 3 to 5 year perspective, because we structurally believe that the white metal and the copper as a commodity, I think are likely to show better performance in coming 3 to 5 years.
Devin, always a pleasure having you on the show. Thanks a lot for joining in and giving us those details. Have a good day ahead, Devin. Well, on that note, we'll slip in a short break, come back. Pre-open rates will be with us. And as promised, technical experts as well will be joining in. We'll also get a view coming in from Sanjay Parekh of Soham Asset Managers on the NCLT approving Vedanta's demerger finally. Stay tuned.
Okay, well, I think we are hitting market open. The pre-open for stocks, of course, I think we can ignore for a bit because it tends to go all over the place and settle. But I think we can look at the rupee. I think the first rates as they start to come up, the dollar rupee rate, nothing yet. It's, I think, maybe a couple of more seconds and we should have it right about now. We'll put it at the bottom of the screen with regards to how it's opening. Sudarshan Sukhani is with us. Shrikant Chauhan is with us as well with technical trading ideas. Gentlemen, good morning. Good to have both of you here. Apologies coming to you later than usual. Sudarshan, you go first. Yesterday was a bit of a slide, slam dunk in that sense. Broader market sold off 1%, Nifty, Bank Nifty a little lesser. How do things stand and how do you look at indices first, Sudarshan?
Yeah, good morning. Yesterday, the suggestion was to go short below 25,900, but today it's different. You know, the Nifty slide brings it to a very strong support zone between 25,700 and 25,800, that 100-point zone. So that could act as support, or if it breaks, it should probably lead to a significant decline. But when we are closing close to that support zone, a short selling idea is not justified. We have to wait and find out if the Nifty will hold that support, then maybe again begin and try to test higher levels. So at this point, there is really no trade in the Nifty. Wait and watch for a day or 2 days what that support zone does.
Okay, all right, got that, Sudarshan. Shrikant, let me come to you. Indices, do you have a trade?
Good morning, Survi. Good morning, Nigel and Prashant. So yes, for Nifty, it has been consolidating within the range of 26,200 and 25,700 on the downside. 25,700 is certainly going to act as major support for the market, and ideal strategy should be to look for taking long bet close to 25,750 sort of levels, or maybe between 25,800 and 750 with a stop loss at 25,650. So till the markets are not closing convincingly below the levels of 25,700, we are of the view that market should remain in a range and again can bounce back to the levels of 26,050 or 26,100 sort of levels. Most of the stocks have fallen to their important support levels. But if we consider the breadth of last 10 days, then we have seen some unique sort of activity. We saw some increase in the overall breadth of the market. And based on that, I'm of the view that 25,700 should act as major support for the market. And there we should look for taking some long bets.
Okay.
Okay, all right. Let's get to the picks then, gentlemen. Shrikant, you go first.
Yeah, so like we are relatively bullish on mid-size bank. There we are seeing consistent buying interest in stocks like Ujjivan Small Finance Bank or IDFC First, Equitas Small Finance Bank. So there we are seeing good amount of price action. And yesterday we saw some consolidation in IDFC First Bank. Currently it is around 83.50, 84 sort of levels. But based on its technical formation, I am of the view that stock is gradually moving towards the levels of 88 and 91. So here we should look for creating some long bet with a stop loss at 81.50 for short-term traders. And for positional traders, the target is close to 91, 91.50. The other stock on which we are bullish is from the metal basket, and that is Nalco. It is forming rising top, rising bottom series, and it is now very close to its important resistance level based on extensions. On the dismissal of that 280, we can expect rally towards 300 sort of levels. So currently at these levels, it is like showing some signs of consolidation. But at this level, if we buy, we can keep a stop loss at 270 for the target of 300.
Okay, all right. And in fact, on Nalco, as Vedanta and Hindalco had put out a piece, I think 10 days or so ago, that aluminium looks pretty well placed for the next couple of years, going by the global dynamics. So that should coming across to you. What's your view in terms of individual stocks?
Well, it's a mix, 2 buys and 2 sells. Bharat Forge is a buying opportunity, buy with a stop under 1380. Balkrishna Industries is the second buy with a stop under 2325. The intraday shorts are Cient, CYIENT, with a stop above 1165, and TVS Motors is an intraday short with a stop above 3680.
Okay, all right. Thanks a lot, gentlemen. We'll keep coming back to you all to get your calls as the course of the day does progress. But now let's focus on Vedanta, which was the big stock after they got that green signal coming in from the NCLT with regard to the demerger. Kotak, they have come ahead. They have, put out a note on Vedanta. They've upgraded the stock with a target price of 650 rupees. They revised the consolidated EBITDA by around 4 to around 6% because they are factoring in higher LME prices and weaker Indian rupee as well. Now, it's important to note that the commodity price assumptions that they're making are 5 to 25% below what spot is at. They're saying going by spot, the FY28 EBITDA would be 10% higher. And that pegs the bull case, stock price or target price at around 770 rupees, but that's based on FY28 financials. A few factors that they're highlighting: buoyant commodity prices puts Vedanta in a sweet spot. The aluminium division is in a sweet spot, both on growth as well as on margin accretion. And they're estimating the aluminium, profitability or the margin will move to more than $1,070 to around $1,100 to around $1,200 from around the $940 that it last hit. So aluminium could be the big driver. And finally, the parent, that's Vedanta Resources, debt concerns are well behind. So put all that together, Kotak upgrades the stock and they're quite positive. But let's get in someone who's been quite positive on Vedanta for a while now. We have Sanjay Parakh, founder and chief investment officer at Soham Asset Managers, who joins in. Hi, Sanjay. Appreciate you joining in. We just want to talk about this particular stock in this conversation because you have been bullish. I recall for the last 18 months or so, we have been asking you, and sometimes not at the great times, but you have said that Vedanta is a stock that you'll like and you'll have in your portfolio. Now, a couple of quick questions. Could you tell us, they say that, there'll be some unlocking of value. Could you put a number to it? Currently the stock trades at around 5.5 times. If once the divisions are separated, where does this value unlock come in?
Yeah, so good morning, Nigel. As you said, we own the stock, so we clearly have interest in our clients' portfolio in our area as well. So with that, disclosure, clearly, the positives are each of the entities will be focused. The multiples you rightly covered is today 5.5 times, but aluminum, when it becomes a focus entity, there's a very clear scope to go up to 6.5 to 7 times. The power assets, which will be total 5,000 megawatts, that today is valued at EV of 2.5 crore per megawatt. That also there is scope for re-rating. And HZL implied in the price of Vedanta, while HZL, based on EBITDA at 10, it's at 10 times EV EBITDA. But when you imply the Vedanta, it's less than 7.5. So there as well, which will remain the standalone entity, there could be a leg up. So the sum of part, we believe very clearly there is a possibility of value upgrade. Our value before this announcement of demerger was on 28 at 670 to 680 rupees. So with this demerger, for sure, at least 10 to 13-14% upside is due to just because of the demerger.
Okay, got that. But there's a corporate guarantee as well that they have to give. How do you view this? It was on expected lines. I've had a chat with the management, and here on CNBC-TV18 itself, we've asked them. They said they're comfortable giving that corporate guarantee because of the ongoing litigation that's there. Do you believe that's a bit of an overhang, or do you believe that will be put in one of the entities and that's par for the course?
Yeah, if you, all these PSC contracts, typically, you have to at times, give a disclosure in terms of cost for the capex, and there are several items which are at times contested. So PNG rightly, was not comfortable with the energy entity ability to, in case there are liabilities to provide for the energy. So the standalone entity has given a guarantee. I think it's around 16,500 crores, but I don't know whether how much of this could crystallize because a part of normal any PSC contracts in the profit sharing contracts, there could be such items which are contestable. So, we don't know exactly how much of this is crystallized, but if there is a small amount that crystallizes, maybe 10-20 rupees per share, the standalone will have to take that by fulfilling the corporate gain.
Okay, all right. So you don't believe that's a big overhang? I think majority of the street, at least as per what details we have as of now, you don't believe it's a big overhang, and some are hoping that actually goes in Vedanta's favor. So we'll have to wait by for that. Sanjay, I'm going to be speaking to the management hopefully in the next 24 hours or so. Mr. Anil Agarwal, hopefully we do get him and we'll get him exclusively on CNBC-TV18. what would be that one thing you'll be looking forward to when we speak to the management? Because it's always been a little bit tricky with regard to what the promoter is going to do next. And over the last 15 years, we have seen him do a lot of things. But now it seems that he's headed in the direction of value creation. What's that one question you want me to ask him?
First is the complimenting the management. I think they've paid 90,000 crore dividends. They have done, it was very, very tough, right? The journey was tough, and yet they moved into demerger. So that's the first compliment you would give them. I mean, their clear eye on market cap creation is there. Only always the worry the street has is like these like JP, which are not within the core area, or any big expansion which will come in standalone, is one thing which is not related, which will worry the market, That is one area where they need to give more comfort. The rest is all absolutely, we have to give kudos to the team.
Don't get over adventurous. I think that's the message. And, I recall in the last many months, I've been asking the management, how keen are you all on JP? But I think from a shareholder's perspective, as you're saying is, you're happy that at least that hasn't gone through and, it'll be an unrelated part of the business. Well, Sanjay, congratulations first on that call on the stock. You have been holding your ground. We have seen the stock, fall multiple times in the last few months, but you have held on to that. So congratulations, and hopefully we do get the management later.
Absolutely, and I think we'll ask Mr. Agarwal some of the questions which, Sanjay, you want us to ask. Well, I think 9-10 calls. I think we've got 4 minutes to go for the market open to kick off. So, Darshan, what do you have?
Allocation Industries, buy with a stop under 23.25.
Okay, all right. Balakrishna Industries is the stock on Sudarshan's radar up on your screen now. Well, brokerage call of the day, Gaurav is here with that call on financials. Gaurav, it was financials yesterday as well. I mean, for example, Axis is something you'd highlighted. What's today?
Well, if we look at financials, it seems that they are actually reiterating their confidence on the business. So first, let's talk about RBL Bank. What management said to Citi is that they see substantial opportunities in accelerating the product vertical and at the same time also diversify the income sources. Apart from that, they also believe that the cost of fund is likely to come down, and there are two reasons for that. First is that the equity augmentation that we saw, and second is the potential post-merger improvement in the credit rating. When we look at the asset quality, they do not see any kind of worry in the MFI segment, but specifically in the card segment, they see that in the next 3 to 4 quarters is some period where they will still see some kind of stress, and the amount will come down below 500 crore mark after 3 to 4 quarters. Now, let's come to SBI, the biggest bank. Before coming to SBI, let me remind you what happened yesterday. Axis Bank actually pushed their target for the recovery in net interest margins, and after that we saw some negative sentimental impact. But what SBI is saying is that tailwinds from TD repricing and lower bulk deposit will be more than enough to neutralize the combined effect of 25 basis point of repo rate cut and MCLR repricing. So this is the biggest bank actually giving some confidence that the net interest margins may remain stable from here on as well. Apart from that, they are also confident on their growth guidance. They say that RAM is actually doing well. Corporate, they're expecting to grow in double digits in second half, and that is the reason why they believe that they will achieve the guided range of 12 to 14%. In fact, they will achieve the medium to higher end of what they had guided earlier. And they also see CASA, specifically CA, which is current account, is growing at around 13 to 14%. Now, from banks, let's move to NBFCs as well. L&T Finance is where Citi is with buy rating and a target price of 330. What management is saying is that they're confident about the disbursements and achieving the AUM growth of more than 20% in this year. They are also confident on achieving at least 2.8% RA by the end of Q4 FY27. Remember, the ROE is at around 2.4% in second quarter of FY26. And lastly, they are also confident on achieving almost 2% credit cost. When it comes to the utilization of the macroprudential provisions, they do not see any need for utilizing this anymore. Right. That is also something which is positive for L&T Finance in the commentary.
Okay. All right, Gaurav, thank you very much for that. A couple of seconds to go before we open out. Of course, we'll watch for SBI because Citi moved Axis Bank big time yesterday with its brokerage note. Let's see if SBI reacts positively. In terms of stocks, Meesho will be in continued focus. Yesterday, it hit record highs. And it's again up 3.5% in the pre-open. Then in terms of such stocks and news, watch out for Ahluwalia contracts, 4.5%. By the way, we've not spoken of city gas distribution companies. Should keep them on the radar as well, because that one nation, one gas transmission tariff that kicks off from now. And IGL is up 3%. There's a positive note from Nomura on IGL. And that stock's reacting very positively as well.
You know, this company Orkla, which is MTR, which we had them right here in our studios, which is recent listing. I think there's an initiation from one of the brokers, which is also there. I think stocks up some 2-3%. What do we have? First rates coming through. The Nifty is starting unchanged, almost unchanged, 25,870. The Nifty Bank is blinking red and green, 58,973. You've got the Sensex, which is unchanged. Small cap index is up. Small mid cap index should be, something similar as well. So not very much to report right now. But small cap index is looking a lot better, about 0.25% higher. I mean, let's just look at the Nifty 50 heat map, and then we'll quickly turn our attention to individual names, because I guess there's more action there. Vedanta and the like. Shriram Finance is on one end of the spectrum with a pop coming through, as we've been highlighting. Perhaps a deal brewing. ONGC is on the other end, and some insurance companies as well. HDFC Life, ICICI Bank. It's ICICI Bank actually. Grasim, Dr. Reddy. So it's kind of evenly split between what's up and what's down, and there's a grand total of 2 points to show for it, at least within the first 60 seconds of market open. Surbhi.
Absolutely. That big block trade on Akzo Nobel has just happened. Stocks down 14%. The anticipation was that 9% equity will move, but I think it's even bigger. 11.5% equity has moved down, 15% lower on Akzo Nobel. IOB, where the government is selling about between 2 to 3% of its equity, that's also in focus, down about 3%. So large block trades in focus. But on the large cap screen, it's really all about Shriram Finance as the market continues to buzz with excitement. Finally, is there going to be a deal announced or not? We'll have to wait and find out. 2%. SBI is the other one that is reacting quite positively to that Citi report. 968 is where SBI is at this moment. Eicher Motors, Hindalco, Bharti Airtel, these are the gainers. TCS is up about 0.5%, just under 0.5%. Eternal is recovering after yesterday's slam dunk. Let me just check what's happening with Swiggy, because Swiggy also sold off big time yesterday. It's very, very flat right now. All eyes, of course, are going to be on Zepto, which is coming out with another big issue in the near future, perhaps as early as next week. But that's it. It's pretty flat trends otherwise on the Nifty. On the downside, you have a couple of financials. ICICI Bank, HDFC Life, HDFC Bank. So some of these names on the lower end. Nigel?
The stock to track, Meesho. Just take a look at that stock. Massive volumes in the first few minutes. The stock is up 7.5%. For this week, it's up close to around 18%. Big move is what we're seeing on that one. That large trade has got out of the way, I think so, with regard to Akzo Nobel. So that one's got cleared out, explains why that stock is down. And silver is the one that continues to twinkle, shine, whichever way you want to put it. Because of that, we're seeing a lot of these ETFs that are up. And the only way to play it is Hindustan Zinc. And Vedanta, because of their holding in Hindustan Zinc, they get some bit of a tailwind as well. So explains why that stock as well is doing pretty well. On the flip side, you have Shakti Pumps that's coming for a bit of a breather. Polycap actually is down on pretty large volumes. 3.5% lower is, Polycap. That stock is a little bit lower. And IOB, because of the fresh supply that's likely to come in. So that's another stock. Bandhan Bank is a stock that I'll be tracking. For the last couple of trading sessions, I've been highlighting that's a possibility that it could come out of the F&O ban. And today it appears, that could be the day, just going by the details that we have. 81%, open interest as a percentage of MWPL. So Bandhan Bank is a stock I'll keep on your radar. Net, trading in the green. The street would like that after yesterday's final tick was at the low point of the day.
Just one more stock. Watch out for Ahluwalia Contracts. It's seeing a big move right now, almost 6%. Volumes are very thin. I need to keep that in mind. They've got a large order, almost 900 crore rupee order from the Bihar State Tourism Corporation. And that stock's up about 5 to 6% as well. By the way, L&T Finance, another NBFC which Citi highlighted, and they have a positive view in their latest brokerage note. That stock also up 1.5%.
20 points, right, so far, and that's the overall picture. The big casualty from yesterday was PV Fintech. Was down almost about 5.5-6% by close. That's stable. It's down 1%. This morning, 1.25%, so just under 1,800 now on PB Fintech. So watch out for that as the day progresses as well. What else? Shakti Pumps has had a bit of a big move from 550 levels to 750 very quickly. So it's seeing some give back, 3.5% or lower. It's got large volumes. Akzo, Polycab, etc. we've mentioned. There is Reflex, which is up about down 2%, had a bit of a move last few sessions. Praj had a large move yesterday. Actually, last 2 days, Praj moved very, very substantially from about 290 odd levels to about 350. So a little bit of pullback. NetWeb is down about 1.25%. HBL is down about 2%. Indian Overseas is down about 2.75%. And so it goes. So that's basically the stuff on the downside, which is coming up with volumes as well. All these silver ETFs are, again, of course, up and about, right? Silver B's 3.5 higher, and there's HDFC Silver and all kinds of stuff, right? So these are all ETFs, all up between 3.5%, and of course on the equity side, Hindustan Zinc up another 2% at this stage. So that's something else which is coming through. Not very much else. I mean, Reliance Power I can spot with a 3% pop. There's HCC, bombed out name completely, 4% higher this morning. IGL we mentioned, Ahluwalia we mentioned, Tata Motors commercial vehicle business, that is up about 2% this morning. Eicher is up about 1.33%. So it's quiet. I mean, there's nothing dramatic happening with regards to some of the stuff. HPCL, oil marketing companies, because of the oil fall, I mean, they're up about 1%, but there's also, of course, I mean, at the margin, there's risk that what Trump will do with Venezuela, will that cause a bit of a spike in oil prices? So we'll have to see. But of course, I mean, the fall in oil has been a pretty substantial. WTI under $55, as we've been pointing out at this point. Let's do one thing. Let's, as we wait for a perspective on markets, let's line up some of the views that we got from the top insurance, companies that we spoke with yesterday. This is, of course, the country's largest insurer, LIC. So let's line up those bites. Let's look at, SBI Life, another company we spoke with yesterday. And of course, Bajaj Allianz was the other one of the largest private sector insurers who we spoke to as well. And we should be able to play some of that stuff, some of those sound bites out for you in just a bit. I think we have it. So let's just listen and quick listen once again to the top insurance company voices. We'll come back with a market perspective.
We have been making our position clear on open architecture. More than the insurance companies per se, yes, insurance companies also had its own benefits to look at. But looking at how the customer should be served, it is difficult for an individual to be knowing the products, multiple products of many life insurance companies, and going and presenting the right product to the customer. It was not going to be an easy task. An agent representing one life insurance company would have been beneficial for the agent as well as the end consumer as well. We were requesting the government for making this provision available, and I'm sure the government had taken a stand, and open architecture, which was originally proposed or it was being talked about, is not part of the current bill. Certainly LIC stands to gain the sense, as you said.
The fact that we weren't necessarily entirely comfortable on multi-tied agency, given the fact the amount of money that is spent on an agent can vary between 15 to 25,000 rupees that a company spends on training an agent over 3 to 5 years. So that was a little bit of a tricky one, and I'm happy to see that it doesn't find the light of day here. The investment guidelines have been made a lot easier, is very good. I'm particularly excited about the fact that we can now invest in private limited companies, which usually are the companies who have invested in technology and can get, early investment, and not just do they gain, but even we gain at the same time.
When it comes to distribution network to be broadened, the IRDA already permits that. Almost about 8 such banking institutions they can tie up with. So this will be really maintained. So the other piece is the merger of the non-insurance with the insurance. There also, I believe, the regulation can come in where they can probably lay down that, if at all any such thing happens, what are the precautions which needs to be taken, and how they will ensure that the liabilities of the non-insurers should not really get into the insurance companies. There can be a firewalls which can be created to really address this concern also.
Well, that's a big story, isn't it? Insurance. And we had the top voices from across the industry on it yesterday. Mahesh Patil is Chief Investment Officer at Aditya Birla Sun Life Asset Management Company. Mahesh, great to have you with us here. Good morning. Thanks very much for joining in. From the insurance space, now with this amendment passing, although it doesn't have the composite license, the open architecture is missing, but there is other stuff. You're part of course, a conglomerate which is insurance businesses as well. But from an investment point of view, in your portfolios that you oversee, Mahesh, what's the leaning towards in this space?
Yeah, so insurance sector is a sector which we have been positive now for last 1 year. I mean, last year we had a lot of regulatory headwinds in that sector, okay, which impacted the growth over there. And subsequently, we have seen some kind of a relaxation over there. And I think overall, again, the growth in this sector, which had kind of mellowed down, is again coming back. There is some impact because of the commissions and the regulation on that, which could have some impact on the margins. But more importantly, I think the GST cuts, what we had seen, that is also leading to overall cost coming down for the buyers, and that is especially say in the health insurance space, and that's the reason why we've seen good volume growth. So I think as long as the volume growth remains fairly strong, and which you've seen in these monthly numbers coming in, I think the slight impact on margins, okay, which could be there, that can easily be overcome. And this is a sector which we see a good long-term secular growth, which can compound at around, say, 13 to 15% in that range.
That's insurance. Got that point. Mahesh, great to have you with us on the show today. Let's talk quick commerce, food delivery and whatnot, because that's where the game is being redefined every single day. Look at Meesho. And I know that you won't comment on individual stocks, but I'm not quite sure what's going on here. The company finally came in and offered shares at 111 rupees. Stocks now, getting very close to 200. So is this FOMO playing out? At the same time, we've seen a cool off on the likes of Eternal and Swiggy. Zepto is hitting the market with an large issue next week. So this is a very hot space. How should investors think about it? And what do you like? What do you dislike? And how are you? What's your approach to the whole space?
Yeah, so all these new age companies which are coming up, again, are disrupting the existing business model. And each company has a particular moat or a competitive advantage, okay, which they are trying to get in and capitalize on that to capture the market. So market has already been there, right? It's more about getting the market, getting more market share. And these are very high growth companies. So the way to look at these companies is not just the next 1 year, 2 years. You have to take a slightly longer term view, say at least the next 3 to 5 years view, and then look at how this compounding growth over that period would lead to cash flows and the discount, and see whether the valuations are really fit into one's matrix. But more importantly, I think it's important to look at companies which have already established a clear leadership in that particular segment. So that ensures that they have the scale and size, okay, which will help them to really bring down the initial fixed cost much faster. And if the competitive intensity is fairly well established, right, then I think the road to profitability is much clearer. I think these are the factors, I think, which we look at in these names. And where the competitive intensity is increasing because of another play coming in, then we see some volatility coming in, and we've seen that in the quick commerce space.
All right. Hi, Mahesh. Good morning, and good to see you in. A quick question on, the rupee move. That's seemed to be making some part of the street a little uncomfortable. Today, there is some kind of appreciation that we're seeing out there. Is that concerning, or is it par for the course? Some would argue that the kind of, slip that we have seen, maybe in fact it's intentional in a particular manner, to help us out in terms of the deficit number. What's your view?
So if you look at in this calendar year, this year, I think rupee has been one of the worst performing currencies. But the more recent fall, if you see in the last 3 months or so, that is also in line with what we've seen in some of the other Asian currencies also, which have depreciated. Obviously, I think India is still yet to sign the trade deal, so that's impacting. But I think it looks like the way the government is taking the route is that let the rupee, because RBI, which initially was defending the rupee at around 88 rupees or so has now kind of given away a bit. The intervention is much lower. And I think the rupee depreciation is a mechanism by way we are trying to really ensure that the competitiveness of our exporters, okay, which have been kind of impaired because of the tariffs, okay, to some extent it is taken care of. And overall improve the competitive vis-a-vis the other currencies. That's a more recent phenomenon in the last 3 months where we've seen other Asian currencies also depreciate. And overall, from a market standpoint, I think currency, once it depreciates and stabilizes at a particular point in time, we have seen that it is normally positive for earnings because if you look at the Nifty, for example, around 50% of the companies have a positive correlation to the rupee depreciation because either they are having, they are exporting, especially sectors like IT, metals, oil and gas sector, even auto exporters. So in a way, I think it will also have a calming impact on the market once it stabilizes because you could see this translating into some kind of an earnings uplift. And yeah, so I think as long as once the market gets a confidence that this is a level where it will find support, I think you will also see then money flow coming into the market. And rupee now is slightly undervalued on a RER basis. So if at all we see that the current account stabilizes, which is actually showing a good trend in this last month, I think the rupee should hold on over here.
Okay, all right, got that. Actually, a big appreciation is what we are seeing, in today's trading session. I think we should just pull up an intraday chart of the rupee. The sharp pullback, I was chatting with Lata yesterday and I spoke to a few economists as well. The RBI stepped aside. That was one factor that was plaguing the rupee. Then you had FI selling as well that had continued. But the hope is getting into 2026, there'll be fresh allocations and maybe, in fact, India gets its share. So that's what could help it. And in fact, it's a seasonally weak month. In December, you normally see that the rupee is a little bit weakish. While getting into Q4, the deficit number looks better. You have exports that are pushed out, which gives you some kind of support. So for the time being, stability and some appreciation is what we're seeing on the Indian rupee. Mahesh, I was just looking at some of the portfolios out there, and it appears on a sector like metals, if I'm not mistaken, you're relatively underweight. You could correct me on that. But what's the view? Because it appears there's a bit of a melt-up taking place in that space. Valuations come secondary, momentum comes first.
So in metals, okay, we might be slight underweight, but actually our view has been turning positive on the metal space, and we had increased or reduced our underweight over a period of time. And again, the reason for that has been that the sector has been a kind of a underperformer last year, and that's one of the reasons it's underowned also. And with dollar kind of a weakening, we've seen uptick across metals. We are more positive on the non-ferrous side, though, because there we see drivers which are not the short term, but also more structural, because demand for, say, aluminium and this thing is likely to be better coming in from electric vehicles and also in this aerospace space. And there the demand-supply gap, okay, would be favorable, which will support prices higher. So I think that's the view on metals. We are not negative. We are turning mildly positive over there. But again, this is a sector which is to be watched in terms of what China does, because it's still the largest consumer and producer of metals. And at the margin, I think how the Chinese economy and the IP numbers track will determine in terms of how sustainable some of these movements are.
Okay, all right, got that. Thank you very much, Mahesh. Good to have your perspective on the market. And we wish you a very, very, happy holiday season and a happy new year in case we don't talk up until the 1st again. Thank you for joining in.
Thank you.
All right, let's take a look at what's going on. So there's a bit of a momentum that seems to be picking up right now. 55 points up on the Nifty, not bad. The mid-cap market is very, very quiet, though, you'd have to say. Not too much going on over there. And financials are, at least at the index level, Bank Nifty, again, extremely flat. Well, let's move on then and put the spotlight on Patanjali Foods. That's the next company on our radar. Now, the stock is down about 11% in the last 1 year. It's down almost 20% from its peak. So what will 2026 have in store for Patanjali Food and perhaps for its shareholders as well? Mr. Sanjeev Asthana, CEO at the company, is joining in, and there are 3 key points we want to focus on. Mr. Asthana, thank you so much for joining in. So we just want to highlight some of the key talking points, so to speak. Obviously, we want to get an outlook on the new calendar year that's upon us, 2026. Some idea also on how the post-GST cut era is playing out for the FMCG and the consumer space. And we want to understand what your overall sense is for the second half of the year as well, how the numbers are shaping up. So, Mr. Asthana, let me actually start right there. The post-GST era. In the earlier interaction, and I just want to place this on record for our viewers, you had told us that the GST cuts alone could deliver additional 300 to 400 basis points growth for you in FY26. Is that still playing out? Are you on track for that? How are things on ground post the cuts, and are you seeing any bump up in demand?
So, Surbhi, just 2 parts. One is that we've seen the pickup happening sooner, especially in the HPC category in the rural areas. And there the demand seems to be gaining some momentum. The urban areas have not responded as well as of now. But my estimation is that, the third quarter, which we are right now undergoing, and the fourth quarter should be definitely way better. My expectation is by sometime by end of this fiscal, that demand momentum that has picked up will tend to flatten. It will not perpetually be there, but the base will be set at least 300 to 400 basis points higher. So we pretty much stay, to the course of this growth in the HPC category. The foods have not responded as well, and likewise the urban areas also have not responded. My sense is that it'll happen with a lag. I think all the changes that have happened, and I think consumers to sort of start responding and, with the affordability getting better, we are expecting certainly that fourth quarter onward, the foods portion of that will also get an uptick.
So, say by the time we are ending this fiscal, end of March, what is your expectation on HPC volumes, and what would your estimates be for the overall foods volume? Or we can talk in sales as well, because, the pricing has come down, but the question is whether the volumes will actually make up for it. So give us some sense on both the businesses and where the numbers could look like, either volumes or overall sales.
So HPC, we will definitely witness anywhere between 12 to 15% annualized growth, that we are witnessing the momentum, compared to in November when we took over the business last year. Definitely we should gain 12 to 15% this year. And I'm pretty much expecting by end of this fiscal, we should definitely be up apple to apple comparison, close to 10 to 12%. And on the other side, on the food side, the growth we have always maintained between 8 and 10%. Urban has not responded as well. So I'm estimating that anywhere between 6 to 8% growth we'll definitely see, by the end of this fiscal. And which is pretty much, par for course in terms of what the targeted numbers were at the beginning of the year that we'd set for ourselves. And so we are pretty much there on that front.
Hi, Mr. Asthana. Good to see you. By when does the FMCG business become 50% of your revenue? I think that's the guidance, right?
So the guidance is that in 3 years' time, we are very much, convinced about it, targeting all our efforts are in that direction. And as we are seeing the growth that in the veg oil segment, the growth is pretty just about 2.5 to 3% what we get. In the FMCG segment, the growth, if it continues at 12 to 15% on the HPC, 8 to 10 on the food side, then in 3 years' time we should be very close to that number, which we had stated, in our estimations of where the businesses are going to head.
Okay, all right. I want to focus on the edible oil part of the business then. Could you tell us how has pricing changed sequentially? Point number 1. And point number 2, what kind of volume growth are you working with for the second half of the year on edible oils?
So first half was quite flat, and where we had this, challenge of some demand contraction that we witnessed, even though there was a marginal volume growth, but the revenue, the price points were lower. So which basically, gave a pretty flat growth rate. The second half has been quite good, aided by 2 key pointers, some duty change, which the government implemented earlier this year. So that has supported the domestic refining. The branded sales have tended to pick up in the wedding season that we're witnessing right now. And overall, so my estimation is that we should grow about 3% this year on the veg oil side. And next year should be relatively better because I think we've come out of a contracting demand scenario on the edible oil side. I think next year should be relatively stable at between 3 to 4% growth. We should be consistently be able to get that.
3 to 4% growth for FY27 and FY26, second half of the year 3%, or for the year you're talking about 3% after the first half?
I'm talking for the year. The pickup is quite good in the third quarter.
Okay.
And likewise, the estimation is for the fourth as well. So we should be
that's good.
for the full year.
So that's good.
3 and 4%, yeah.
Got that. Just one more point, sir. In terms of market share, what is it? And in terms of edible oils, if you had to give me a margin, what is it likely to look like?
So margin, we are at about, till first half of the year, we were at about 3.53%, which is very much what the company targets. And for the full year, we should be close to a similar number, maybe closer to 4%. That's what the estimation that we are having. And growth-wise, in terms of market share, we are quite close to 10% now. So edible oil is seeing, Nigel, a sort of a consolidation in the marketplace, where the larger players are tending to benefit more on account of the consolidation, all the reforms that have happened, the risks on the FX side, including the, the working capital deployment that's required. So broadly, Patanjali Foods, along with a couple of larger players, are going to be a beneficiary with this market consolidation on the edible oil side.
Okay, interesting. So we're expecting stability over there on the edible oil business. Overall, on the FMCG business, Mr. Asthana, I believe palm oil prices have been going up quite a bit. Can you give us a sense on margins? Second half, how is it likely to be for your non-edible oil business? And if there is indeed a lot of raw material inflation you're facing?
So earlier this year, Surabhi, what had happened was that the palm oil prices had gone beyond soya and sun prices, which had quite a significant impact in demand contraction for the palm oil prices that supported quite a bit of soya and sun. Now, this dynamics between the three segments in the veg oil plays out quite a bit. I just wanted to take a minute to talk about our oil palm plantation business. So that has been a sort of a growth engine for the company. We have already crossed 110,000 hectares of plantation. This year, the estimation is on the P&L side, on EBITDA basis, we should be upwards of 300 crores plus of EBITDA that will generate on the oil palm plantation. And this I'm expecting every year will continue to grow at anywhere between 10 to 15%, both on the revenue side as well as on the income side. So which is a big driver of growth in terms of our dependence on the imports is diminishing to that extent. Marginal still, but my estimation is that progressively this is going to continue growing, gaining more momentum, and will become a pretty large part of our overall profit margin.
Yeah, so just quick 10 seconds left on this, because there's so many positive levers working for you. You have your own, palm oil production now. You're saying that business is shaping up, 300 crores of EBITDA. Plus the mix is going to change. There'll be more and more FMCG getting added. So what is the margin trajectory for Patanjali Foods at a blended level? FY25, your blended margins were somewhere just shy of 6%. What should we expect in FY26 and FY27? How does the profile change?
We should be 6%. And progressively 100 basis points each year we'll keep adding. And our stated objectives were 50,000 crores revenue, 5,000 crores of EBITDA in year 3 to year 4 from now.
Okay, and 100 basis points improvement in margin going forward on a steady state every single year. Got that. Thank you very much, Mr. Asthana. Good conversation as always. And let me take this opportunity of wishing you a very, very happy festive season and a happy new year as well. We'll take a quick break on that note. Up next, Prashant is chatting with the top team from Bank of America Global Research, talk about their outlook for 2026. Amish Shah, Gunjan Prithyani and Neha Manapuria joining in for that conversation.
Hello and welcome. As we look ahead into 2026, markets are navigating a complex transition from post-GST adjustments and earnings resets to shifting consumption patterns and a long-awaited cyclical recovery in markets in key sectors as well. 25 has arguably been a tough year. And of course, expectation as we turn the chapter over into the new one is that it's going to be a little easier. Easier, not easy. Well, adding to the complication, of course, more recently has been the slide we've seen in the currency, the rupee, that is, from 90 to 91 in about 10 sessions, being pushed back this morning as we speak, but we'll have to see. To help us cut through the noise, we are joined by the core of Bank of America Global Research's India Equity team, analysts who advise some of the largest money managers and institutions investing in our markets. Amisha heads equity strategy at BofA. Gunjan Prithyani tracks autos across, two-wheelers, passenger vehicles and tractors at BofA. And Neha Manpuria covers hospitals and pharmaceuticals at the firm. We'll try and break down what 2026 could look like for markets overall and, of course, for some of the key sectors as well. Thanks very much, all of you. Gunjan, Neha, Amish. Appreciate you guys coming down.
Pleasure.
So should we start right at the top? From a strategy point of view, Amish, how are things looking? The consensus is that it's going to be a little easier, as I said, not like an explosive move or anything of that sort, but maybe a little better into 26 over 25. Is that just turn of the year kind of optimism? We all feel a little more optimistic at that time. Is that time of the year, or you think it's grounded in numbers and you can sort of build that case up from bottom up?
I would agree. 26 is looking better than 25.
Yeah.
So let's say same time last year, markets were looking expensive. Earnings growth expectations from consensus was quite lofty. It seemed like earnings will come off. Small and mid caps was driving the rally. In fact, lower the float on the stock, those stocks were doing well, which seemed like momentum trade that will not sustain. So I think all of that is now behind. If you look at so far in this calendar, for Nifty companies as well, FY26 consensus has already cut their earnings by 11 percentage points, and for FY27 by another 6 percentage points. So I think earnings expectations are now sensible, and earnings growth we think is going to accelerate. So as a result of that, valuations are now also looking reasonable. I would not say Indian markets are cheap still, but they are now reasonable. And with earnings improvement and no more earnings cuts, I would argue 26 is much better. And then finally, when you look at the events calendar, what can drive the volatility in the market, we do think that the events are also skewed on the upside rather than downside right now.
Lesser events which can derail the story in that sense, maybe, right? Hopefully. Has Rupee come up in conversations with clients lately? In what way?
Well, it's in the front and the center right now because it's an unknown. And as we know, market always likes to have predictability. So, till the time, and we know the drivers of why the rupee is being weak. So how do you price in? At what price do you say that the rupee is now adequate? Will it appreciate? Will it continue to depreciate? So clearly there are sensitivities for stocks around that. So I think it's in the front and the center of the conversation. If you're a near-term investor, for the long-term investors, they do think that at some point in time, now we are at the fag end of this depreciation, things will settle down, and then they are looking at X of currency, how should they build their portfolios?
So for new investors, foreign investors who are coming in, you're better off buying now if the currency were to be stable from here, in that sense, right?
Definitely would say so. Even otherwise, for a foreign investor, I would say that, historically, whenever Fed has cut rates, it has led to EM flows. Whenever dollar has been weaker, it has led to EM flows. If you look at our own house views, we are expecting only 4% returns from S&P next year, but we are expecting 12 for Nifty this year, in CY26, right? So clearly returns also are skewed in favor of Nifty rather than the US. All of that basically points to the fact that logically, FII outflows should at least become zero next year, possibly could also be inflows.
So no more money out from equities, foreign money.
Is our view.
Is that view. And but is there any framework to kind of be able to sort of tell as you begin, or is it just like a function of various things, positioning and how much has been already sold, etc.?
So positioning, yes. But just think about it that if you are a multi-asset fund manager, then the way you are likely to look at is debt versus equities. So the 10-year bond yields are currently around, call it 4.25 on an average. So 4.25, add to that the risk of rupee depreciation. So you might be probably expecting, let's say 6.25 as rupee risk-free. And then add to that the fact that you're not buying bonds, you're buying equities, so you need risk premium. So let's say 5% for equity risk premium. So you're expecting about 11+% returns. As far as the markets give you a visibility that is possible, then the preference is more in favor of equities than debt. And then if you switch to, let's say, within equities, if I'm an emerging market portfolio manager, and then where do I allocate money versus India, China, Brazil, etc., then as I'm saying that on the back of the fact that India's earnings have come off, valuations are now looking okay, India at least is one of the alternatives versus throughout this calendar, India was a avoid. So I think all of that put together, whether you are an equity fund manager allocating between markets or whether you're an allocating across asset classes, FII outflows definitely, in our view, should stop.
You know, we had a senior person from Bank of America on the currency side, on the fixed side, on last week, and I asked him, towards the end of the conversation, I asked him, what's the one non-consensus view that you have? And he said, well, dollar will appreciate in 2026. Well, I don't know if that's a published view, but he said it on record. He said it. So, yeah, I mean, lots of moving parts. We don't know essentially what's going to happen, but it's a constructive framework, Amish, that you're working with, right? Let's get to some of the sectors now. And Gunjan, autos has been the savior sector in that sense, right? Has done very well, and some of the stocks more than others. What Amish was talking about, that earnings will pick up and perhaps consumption picks up, etc. Are you seeing that evidence after these cuts? I mean, what started after a bit of a pent up because there was that festive thing and the Shraddh period, and there was cuts happen, and right out of that there was of course a big bump in sales. Has that sustained? Are you seeing that being durable? That bump in auto sales being durable, and what segments mostly?
Sure. So yeah, certainly I think GST has been a very important catalyst. If I look at the sector growth, it's accelerated from nearly nothing in the first half to now in the range of 8 to 10%. So to your point, yes, there was a huge bump, almost 20% up during the festive days. But if you actually even normalize for the time the GST announcement was made till date, the registrations are up between 8 to 10% across various subsegments. So clearly there has been acceleration in growth and it's holding on. Our view is when you think from an auto upcycle perspective, everything that matters, be it credit, crude, cost of ownership through GST rate cut, cost of compliance, regulations are a lot lesser going into the next 2 years. A lot of things are aligned, and hence, our view is that growth should sort of sustain going into next year as well. But I think the more pertinent point is, like you started off saying, that auto has been a savior. It's a space that's done well. The pertinent question that we face from investors is what's in the price. I think that's where a lot of positive revisions happened immediately post the GST rate cut. And now it seems like, the expectations have more or less aligned with this 8 to 10% sort of subsegment growth that we are seeing across the various spaces.
In some categories, are we going to very quickly revert back to the same kind of situation which persisted before the GST cuts, which is of too much inventory, etc.? I mean, are you starting to see any of that, or no? It's kind of flowing through well.
So I think, of course, growth will normalize as the base catches up, but I think, 6 to 8% sort of growth looks par for course. It is
volume growth.
Volume growth, yes.
For
PVs and two-wheelers, 6 to 8% sort of volume growth looks par for course as we get into a more normalized base next year. Of course, next couple of months, still the visibility of growth is higher, etc. I mean, you could see two-wheelers numbers being in double digits, but that's more of a base effect. So 6 to 8% for fiscal 27 seems par for course. I think the interesting subsegment could be CVs, which has had no implication from GST as such, but it is a second-order beneficiary of any economic recovery. So that's the segment probably to watch out from a next year's perspective, where expectations are still relatively reasonable, and we are starting to see a little bit inflection on that space.
This entire rare earth magnet issue, right? I mean, it's kind of disappeared off the thing, although there's been companies are doing just fine without... So how's it happening? I mean, or it's an issue to watch in 26 as well, or you think it's sorted now?
I think at least it's sorted in the short term. But there are two things playing out here. One is the easing of the supply chain. There's clearly a lot more availability now than it was a few months back. Secondly, if you also look at the EV growth in itself, that's sort of moderated. And that's outcome of, GST, because GST has made petrol vehicles cheaper, and hence that, this whole argument of shift towards EVs has been pushed out for a couple of years. I mean, we're seeing a lot modest growth in the on the EV side. So it's both combination of supply and demand being a bit modest, but I think longer term we'll need to find a solution, which is where, lighter rare earth materials, some of these companies are working towards that. Those are solutions we'll have to watch out. But for now, 3 to 6 months, I don't think that's a big worry in minds of corporates.
Niyam, let's talk about, you track hospitals, you track pharma, right? So let me actually pick up with pharma, which is of course a big export sector. And the obvious question is this Rupee thing, right? Does it make a difference at the margin for earnings?
Not really, not as much as probably it does for the other sectors. While pharma is export oriented, I think the one thing different about pharma is, it's not, US is the largest, but it's not the only market. You also have Europe, you also have, emerging market where currency tends to be volatile. And then you also have your raw material cost, which is usually USD pegged, and some amount of your spending is also pegged to local currency. So the flow through isn't as much, and therefore you don't see pharma stocks react as much to FX moves. I would say less so for pharma.
So what's the big dominant driver going to be for pharma, to your mind? Or is it going to be different things and different kind of subsegments where you'll find places to make money?
Yeah, so I think while we use the term pharma, there are like 3 different subsegments. For the large cap or the US generic focused names, I think the tariff news has sort of died down. Yeah. Is the possibility completely out? No, you never know, right?
Which is those sectoral tariffs.
Tariffs, the Section 232 tariffs, right? At the moment, what White House has said is there's unlikely that generics would be included in those tariff discussions. Even for branded, we've not really seen anything come out other than the one tweet. So I think the tariff noise has sort of died down. It does not come up in conversation as much. I think for the US-focused names, the big debate is as you get into 2026, you had this very large product rev limit for most companies, which is going away, right? So how do you fill that hole? So are you looking at how is your US pipeline looking? Are you looking at other growth drivers? We have seen companies use the cash flow from this large drug to diversify their business and enter into newer segments, OTC, medtech, specialty. So I think there's a lot of focus on which of these will be your sustainable growth drivers and drive earnings momentum. Probably not next year, but 2 years out. And therefore, valuations are, I would say, below, long-term mean because there's still a little bit, headline earnings won't look as great because of rev limit going away, but a lot of focus is on what happens to that, capital allocation that you're making into these newer areas for pharma companies. And I think for CDMOs, obviously, there's a lot of discussion around, reshoring, Biosecure Act, with China in licensing, how that impacts biotech funding, winters, has that improved? So I think there is more action, I would say, happening on the news flow side on CDMO versus the US pharma.
The exporters into the
yes,
US. So,
that's right.
And that's an area of interest for you in terms of CDMO, perhaps over the large cap
yes,
companies.
Yes.
Okay, hospitals we've not gotten to yet. I have to take a quick commercial break, so allow me to do that. I'll just take that, come back, and we'll continue this conversation right here. So let's do that. Take a break, and the BofA Top Equity India team is with me. We'll, of course, dive down into individual some of the ideas and what they like more than others. So all of that coming up in just a bit.
Welcome back. The market's flattened out again. So the bulls have not been able to have a decisive grip over, what we've seen so far. So that 50-point up move, it's also getting sold into pretty volatile and choppy. And it's extremely flat across the indices. I mean, the Midcap index, the Bank Nifty, whichever way you look at it, there's no clear headway as far as the day's action is concerned. And even Shriram Finance, which at one point in time was up 3%, lots of excitement ahead of their board meeting, that stock's fizzled out a bit as well. It's up about 1.3%. Now let's see what's happening in the world of commodities. We've got Manisha joining in with the latest. Manisha, what do you have your eye on?
Well, I have it on precious metals and crude for sure, and I'll take you through all of that. The gainers first, and the precious metal prices have continued to surge. This is on the back of U.S. non-employment rate, which has risen to almost 4.6%. You also have the dollar index, which continues to decline. That one is trading at around 2-month lows right now. And the U.S. benchmark 10-year Treasury yields also have edged lower, absolutely supporting the precious metal price gains therein. A lot of money continues to come into the tangible commodities, so whether it's metals, precious metals especially, is where you have allocation coming in on. I want to start with silver because we have seen yet another 3.5% of gains in the overnight market. And with that, it's an all-time high of $65.65 an ounce coming in for the international markets there. With that kind of a gain, we are up by 30% in last 1 month. And for the year 2025, silver is an outperformer. Best performance really coming in from this one with the gain of 127%. Silver has hit a record highs, not just in the US markets, but in India, Europe, and various other countries as well. It has been about potential silver supply deficit for a 6th straight year in 2026. And then you also have a lot of backing coming in from speculative money. You have investment demand, not just in India, but various other parts of the world also supporting silver prices there. Gold is trading very close to all-time highs. It's trading above $4,300 an ounce. You have platinum, which gained up by 4% overnight. It is trading at 2011 highs right now. And you have palladium as well, gaining 2.5%. That one is trading at 2-month highs. But that's exactly where the gains end, because take a look at the energy markets, and we've seen constant declines onto this one. Whether it has been about crude, natural gas, heating oil, gasoline, all of these commodities have continued to decline. Crude oil prices fell 3% overnight, trading at a 2021 low. So it's a 5-year low now for the crude prices, where WTI and Brent both have declined quite sharply, posting out 23% of a decline for this year. And this is a 3rd straight year of decline coming in for the crude oil prices there. So when you look at the WTI, it's headed for a worse performance since 2018. And the Brent also is seeing a worse performance since 2020. Well, in the Asian markets right now, there's a bit of a buying. And this comes in after the U.S. president says that there is a complete blockade now on the sanctioned oil tankers linked to Venezuela. That led to some sentiment gaining into the markets. But apart from that, there's nothing really that is supportive for the crude oil prices. You have progress towards Russia-Ukraine peace talks. That would mean more Russian oil finally coming into the markets. And there is Russian oil stored on water, estimated at around 170 million barrels. So if that starts coming into the global markets, you're looking at prices declining from here. Adding to that is the OPEC Plus steadily restoring its shut-in capacity. Not just OPEC Plus, you have non-OPEC producers also ramping up in sense of output. And in front of that, you have signs of weak demand from China, western part of Asia, and US as well. But what the markets are also looking at going forward is that there's a 75% probability of Fed holding rates in the month of Jan. Having said that, this week is quite active. You have monetary policy meetings coming in from Bank of Japan, Bank of England, European central banks as well. Next week onwards, of course, the volume thins and you have a holiday season starting. But before that, this week promises to be very, very volatile.
Okay, all right, got it. Manisha, thank you very much for that. So we'll keep an eye out on both crude as well as those precious metals. But for the time being, let's look at Meesho. I mean, the stock has had this phenomenal run. It started its journey even this morning, substantially higher. And the gains since listing day are breathtaking, to say the least. 111 was the issue price, and it's knocking at the doors of 200. There is a positive brokerage call coming through on Meesho today. Let's get to Mangalam for more. Mangalam, wow, what does one say?
What a good story it has been so far from a consumer standpoint, yes, from an investor standpoint as well. Ever since it's listed near 80% high from its issue price, and this at a time when the company operates an asset-light, negative working capital business model, which implies that they have free cash flow. The management during the IPO as well had been guiding to us that don't go by the reported EBITDA numbers or the reported net loss numbers. On a free cash flow basis, the company has over 1,000 crores. And that is something that they are looking to continue and grow going forward as well. UBS has taken note of that. They've initiated coverage on the stock with a positive view. They have a target price of 220, so just about 10% away from where it is right now after a near 80% rise that we've seen from its issue price. They're saying that the net merchandise value is expected to compound upwards of 30% over the next few years, and contribution margin, this is another thing that the company had said. Global benchmarks are close to 8 to 10%. They are currently at around 3.8, 3.9%. UBS expects it to be around 6.8% by FY30. And the average order value of the company has been declining because of efficiencies in logistics. So that's something, again, from the red herring prospectus, coming down from 274 to 233. And importantly, you know, the order frequency because of that has increased from 9 to 15. They believe that it will continue to increase as average order value comes down. And the average transacting users as well, currently about 20 crores, which is 1 in 6 Indians, 1 in 7 Indians. They expect this all the way up to 51 crore in the next 5 years. So put all of these ahead with the growth tailwinds ahead, they value the stock at 220 rupees, and the stock's racing towards that.
Yeah. What's also racing is Vidit Atre's own valuation, the Meesho founder. With this kind of a stock surge, now he's entered the billionaire club. Just within a couple of days of listing. Thank you for that, Manglam. Indeed, what a fascinating story that Meesho has turned out to be. We have to take a break right now, but on the other side, we have our special segment. It's the economy coming up. Lata today will be speaking with Jahangir Aziz of JP Morgan about the US jobs data, the Federal Reserve, and the outlook on the rupee.
Welcome to It's the Economy. Financial markets are entering 2026 with much disagreements over many countries' macros. The US non-farm payroll numbers at 64,000 in November, though above market estimates, is pointing to a weakening demand, as do the US retail sales numbers. There are divided views on the Fed rate cut in January and even, for that matter, thereafter. In India, the rupee's decline is the talking point, with FPIs not entering the market. To understand more about Indian currency, FPI flows and US macros, I have with me Jahangir Aziz, Chief Emerging Market Economist at JP Morgan. Jahangir, thank you very much indeed for your time. First, let's start with the non-farm jobs for November at 64,000. How do you see the Fed reacting with its policy to this data?
So I think, we need to look at, not just, 1 month's data, but look at what's happened in September, October, and November combined, right? So we've had about 105 or 108 in September. We went down minus, 105 in October and up 64, right? So it's still, pretty much at that average level around 50. So if you look at just the fourth quarter by itself, you're running at minus 50. So we had 0 as a fourth quarter average. So it's actually below our run rate at this point in time. I think based on that, we had one more cut, which was in January, and that would be the last cut for this easing cycle before it goes on to a long pause. And we also have actually rate hikes in 2027 in the first half of the year, of 50 basis points, 25. So I think that right now it is still on track for a January final rate cut, even though the Fed itself has in the last FOMC warned us not to be too excited about it, right? But I think we are still on for one more rate cut at this point.
They did set the bar very high in the post-policy conference. Now, I'm going to ask you an unfair question because you are, I know, not the equities guy, but how does JPM see the AI trade? Do you see, a big unwind? And I'm asking this because this has implications for the dollar.
No, it definitely has an impact on the dollar. And, when I look at my equity analyst, the equity analyst still has a tremendous amount of faith on AI expansion continuing. I think we have something like $570 or $600 billion of data center-related, AI-related capital expansion that we are pricing in for 2026. That is part of our GDP forecast. And if you look at the past 50, 60 years of history, whenever there has been capital equipment expansion or capital expansion per se in the US, it has always been accompanied by an expansion in employment. Or when capital expansion has fallen or capital has contracted, employment has also contracted. We've seen capital expansion continuing much more strongly than obviously anyone had expected at the start of the year. And we've seen employment coming down. And not only has employment come down, what we've also seen is labor income has slowed down, and so has consumption growth. And you've seen the retail sales number that also came out. I think so there is this divergence that is taking place. And this divergence cannot last long. In our year ahead, we called it a house divided cannot stand. That you cannot have capital expansion continuing at this pace and unemployment going down. Unemployment rising. You've seen the numbers, 4.6% this year. So you can have all of this expansion taking place, but if that is not getting translated into higher employment and higher labor income, then consumption will get affected. However, consumption is 70% of the economy. If that variable slows down, then it's very hard to see. We have a 2% growth rate for 2026. Very hard to see that getting sustained. But your point is right. It has a significant impact on the equity market, and equity market is a key driver of what is going to happen to the dollar.
Okay, all this dollar was backdrop to my question on the rupee only, for which I invited you. The rupee has been allowed to depreciate, and quite sharply lately. Do you see it as an appropriate RBI policy response, or can this fall be destabilizing?
So look, these are value judgments that let's not go into that, right? Whether it's good or bad, right? But let's look at the fundamentals, right? So the fundamentals is that you've had current account deficit, regardless of what caused it, right? Went up from around 0.5, 0.6% last fiscal year to about 1.2, 1.3% this year. That's basically all that is going to happen. You and I have done, I mean, we have been talking about India for a long time, right? Yes. At any given point in time, if you had a 1.2% current account deficit in India, we would think it's a great outcome. The problem is that, and this is the challenge is why can't India finance a measly 1.2% current account deficit? We have in the past financed 2.5%, 3% deficit without creating any real headaches, right? Without having these kinds of depreciating pressure. So my issue is not with the current account deficit per se going up. I know a lot of people are pointing to that, well, it's doubled, etc. It's just 1.2%, right? It is the fact that we can't even finance 1.2% of current account deficit, and the culprits are well known, right? You have net FDI, which is skating water. We have foreign portfolio inflows that is barely above zero, right? And none of the Indian corporates are going abroad and actually issuing issuing bonds or raising or borrowing money from them because there's no real corporate investment taking place. So I really think the challenge isn't where the current account deficit is where the balance of payment is. And if you have negative that's correct. And if you have a negative balance of payment shock, then the rupee necessarily needs to adjust to it and be the absorber, rather than let the entire economy be the absorber of that shock. And more importantly, it frees monetary policy from actually having to be held hostage by FX movements. So I think that if the RBI does not allow depreciating pressures to build up and let these pressures vent off, yes, the rupee is going to depreciate, but that's about all that is going to happen. It is not going to get transmitted back into the economy in terms of monetary policy being held hostage, being directed not towards a domestic economy, but being directed towards trying to defend an exchange rate.
Fair point. So you're giving a clean chit to the Reserve Bank. Well, I agree with you that our problem is not current account deficit, but capital flows. And India has seen capital outflows for the past 2 years in a row. Do you see this changing in 2026?
If you look at the growth numbers, and again, let's go with the official growth numbers. Let's get into a debate about what the real growth number is, right? Let's go with the official growth numbers. These are spectacular growth numbers, right? We've always been told, well, capital flows are essentially driven by growth differential. Look at the growth differential. Rarely have had, and you have to go back to 2005s and 6s and 7s to get these kinds of growth differential with the rest of the world, right? China is at about 4.5%, 5%, right? Even with China, we have a 300 basis points of growth differential. Yes. So with these differentials we can't attract portfolio inflows, then the problem isn't with the growth differentials per se. We need to look at other things. And here is my non-equity analyst view. So just don't hold me to it. My equity analysts will throw a fit if they hear this, right? Here's my problem. Nobody invests in a country. People invest in companies. So tell me a company in India, which is, let's say, $200, $300 billion company that has a prospects over the next 10 years to become a $1 trillion, $2 trillion company. That's what attracted all the capital flows into AI in the US, AI-related stocks. If we do not have companies of that stature, then where will foreigners or anyone invest in? If we look at the emerging market world, once you've taken out China, which got taken out in 2020 because of all the policy decisions that they made, you have taken out from the emerging market world companies that are capable of multi-year growth and becoming trillion-dollar companies. But if you don't have that, then where will people invest? No one really invests in a country, right? You invest in particular companies and stocks, right?
Yes.
But if you don't have that, so if India is unable to deliver, India has what, hundreds of thousands of startups, right? Almost every day somebody gets IPO'd.
Yes.
Yet, we aren't able to hone into 1, 2, 3 companies that are going to become trillion-dollar companies in about a year's time. If you don't have that, then where will the money come into?
Okay, earnings growth is expected to pick up. I mean, for banks, for instance, as the rate cycle ends, expectations are their margins and credit growth will improve. So my question is, assuming the AI trade unwinds or at least dulls and earnings picks up somewhat, do you see the FPI flows back in 2026?
You talked about, that this is not a one-year phenomenon, right? You go back to last year, the year before that, right?
Yes.
We didn't have any AI trade then, did we?
No.
And if we didn't have any AI trade then, India did not attract the kind of inflows that India typically used to attract 10 years back, 15 years back, right? As percentage of GDP, let's say, not in terms of absolute dollars, right?
Yeah.
Obviously, dollar amount has gone up. Then again, you're back to looking at ad hoc explanations for things that are not any longer ad hoc. These are structural issues. And if we don't address these structural issues, I do not think you can have episodically, you will get money coming into India. But you have to create companies. You have to create assets that have the prospect of, moving up 4, 5, 6 times. Indian banks, you can tell me, and correct me if I'm wrong, I don't think any Indian bank, somebody will look at and say, you know what, in 10 years' time, their market cap is going to rise by 5 times.
No, not that much. But anyway, speaking of earnings growth, are you saying you're not very sure that if the AI, won't deliver, then we are not going to get funds?
Yeah. I mean, when we talk about the AI trade being dampening out in the US, we should have been part of the AI trade in India, right? They are not part of the AI trade. I mean, it was supposed to be, China is the one that created the DeepSeeks and the Kimkis of the world. We didn't create the DeepSeeks and the Kimkis of the world.
Yeah, we are excluded from the AI trade. Well, actually, let's come to inflation. Inflation has been unusually low in 2025. Do you think this continues in 26? And by the way, do you think this is explained by Asian disinflation? Or is there a problem of slack demand in India too?
So my sense is that, look, a lot of... So there are 2 different factors is driving the low inflation. One is a genuine factor, right? So you have a good monsoons, the food prices are down, not down, food price inflation is down, and you've had core inflation going down for the last 19, 20, 24 months, right? And then there's a base effect. I think that on the base effect, there will be a turnaround that will take place starting maybe in the first quarter of 2026. We are expecting that base effect to be large enough to take inflation back up into the range of 4s, 4.5s in 2026. So yes, on the base effect, it will go up. But clearly the problem is going to be on core inflation. Core inflation hasn't shown any real signs of recovering with any strength. And we've spoken about this many, many times, that if you have a systematic decline in core inflation, then almost always it is a telltale sign that there is a massive slack in the economy, and that slack is not going away anywhere.
Oh, so you are saying that low inflation is reflecting domestic demand slackness, not just Asian disinflation?
So I'm looking at both factors. So I'm looking at basically a core inflation. So part of the core inflation that has declined, that has taken place, is undoubtedly the fact that China has been exporting disinflation for not just last year, for about 2.5, 3 years. In fact, since it opened up after the pandemic, right? So that is clearly a factor. But if you look at that driver, which is export prices coming out of Chinese export prices are still negative, but they are no longer as negative as they used to be about 6-9 months back, which was running at -7, -8. Now they're running at -2, -3. But that deflationary impulse is still going through to the extent that Indian consumer goods, a large chunk of that, and Indian intermediate goods, a large chunk of that comes from China. That will persist. But even if you strip that out, there is still a very large part of core inflation decline that can't be explained by Chinese prices. And that has to be because you have a very, very large slack in the economy, and that slack clearly is not going away. And the corroborating evidence or the proof of the pudding is the fact that corporate investment isn't picking up in India, largely because they already have excess capacity.
Okay. Well, thank you very much. Out of time, Jahangir, but basically for an 8% economy, if you're speaking of slack demand, then maybe it is the K-shaped recovery. Thank you very much for joining us and for staying up for us. Have to wrap up on Bazaar. Chartbust is coming up.
Shriram Finance, the top gainer on the Nifty right now, up around 1.5% in a flat market where the board is set to mull a fundraise on the 19th of December. This comes even as reports suggest that Japan's MUFG is looking to pick up a significant stake in the company, so the street putting 2 and 2 together.
Shares of Meesho surged nearly 10%. After Brokerage, UBS has initiated a buy rating, target price of 220 rupees. They're expecting net merchandise value to grow at a CAGR of 30% till FY30.
A big block deal in Axo Nobel sees 11.5% worth equity, nearly 1650 crore rupees changed hands. The promoter likely to have sold stake. The stock slumps 13%.
India's largest dialysis service provider, Nephro Plus, makes a flattish debut, listing with gains of close to around 4%. The management will be joining in shortly to discuss their post-listing plans. Well, hello and welcome to Chartbusters. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel, with me is Mangalam. And as we speak, the market's trading a little bit in the red. The Nifty has done a bit of a U-turn. It was up 50 points. Now it's down close to around 35 points. The good news today for some is that at least the Indian rupee has shown some kind of stability. In fact, we have a pullback of close to around 1% underway. So that's good times, Mangalam.
That's good times, Nigel. You know, yesterday it was a red shirt and the market was red. So you said, maybe let's try and change the luck. Wore a green one. For the first hour, it did work for the bulls, for the equity markets, though important to see where we go from here. But the strength in the rupee, that point is very well taken. Let's see if that, lets some sort of recovery or lends itself to some sort of recovery from the lows, because around this 25,800 mark, we have an important support coming in for the Nifty as well. But amidst all of this, we have a primary listing. We have India's largest dialysis services provider, Nephro Plus, which made a flattish debut on the street, listing with gains of about 6%, now holding on to gains of about 4%. Rohit Singh, who's the group CEO of Nephro Plus, joins in to discuss their post-listing strategy. Thanks a lot, Rohit, for joining in. Congratulations. There were pyros, there was fire, and, a lot of celebrations as you listed. So obviously a momentous milestone in your journey. But now, along with the milestone, it also increases a lot of responsibility for you, because now you don't have to answer only your immediate stakeholders, but public shareholders at large as well. And the one thing that they really want to know, 129 crore of the fresh issue that you have raised would be going into almost 170 dialysis centers. With the current strength that you have, and with the 170 dialysis centers that you open, what is the likely same center revenue growth going to be for you? And what is the revenue potential, growth potential for you with these store additions?
Okay. First of all, thank you very much for having me here on your show. It's indeed a great day for Nephro Plus, a company that started 15 years ago. A journey that was started by, co-founded by a patient himself. In fact, we are the third company in the world to get listed, only company in Asia to get listed, which is dialysis-focused organization. So it's a great day. The segment is evolving. This segment was a in-hospital-led service earlier, and now with Nephro Plus coming in and leading the charge, we are expecting this segment to evolve further down. So indeed, a very momentous day for all of us. It's taken us 15 years of hard work to get so far. Over the time period, we have scaled up our services. We are now operational in 5 countries. We treat over 34,000 guests. We call our patients as guests on monthly basis. Team size of over 6,000 teammates who work tirelessly to provide this life-saving therapy across 290 cities. So it's a very widely distributed dialysis network, 5th largest in the world, and biggest brand in the country. So yes, we have raised a primary issue for future expansion as well. We have historically grown at a comfortable CAGR of 25 to 30% in that range, and keeping that momentum going, we believe that this fresh issue will also help us fund our future growth, because as we all understand, dialysis is done at CKD stage 5. That's when the kidneys have failed, and dialysis as a therapy does the alternate function of kidneys. It's a 4-hour treatment, typically done twice to thrice a week. So anybody, and this is not a cure, so anybody whose kidneys fail have to keep coming to dialysis till the time they want this function to be, kidney function to be replicated. And in India, it is a severely underserved market with only close to 10% of people getting dialysis who need. So we see a huge headroom of growth there. And at the same time, there is this burden of hypertension and diabetes, which is becoming, we all understand, India is the diabetic capital of the world, unfortunately. And these two disease also...
Right. We get that point, Rohit. We understand, the severity of the issue. We understand the severity of the issue, the underpenetratedness of the dialysis market in India. But so far, dialysis has only been in hospitals, like you said. But now it's moving out of hospitals. I'm looking at some of your numbers. You treated about 1.9 million patients in the first half of this year. At what rate is this number of patients likely to grow for you? And the second point is cost per patient was close to around 2,500 rupees in the first half of this year. This cost is the entire life cycle per patient, or is this just one sitting, one patient? How do we look at this average revenue per patient and the number of patients going forward? Because that will determine your revenue.
Absolutely. So, good question there. So, let me take the later part first, which is the average cost per treatment, or we say revenue per treatment. This is basically price spent by either reimbursed by the government or the payer, or price paid by the patient himself per treatment, per dialysis session. And as I mentioned, dialysis session is required 2 to 3 times a week per patient. And hence, they spend this much amount on average at Nephro Plus network level, 2,500 plus rupees. But point to note here is this is the average of 4 countries that we are right now operational in. So it's an average of the network level, at the company level average. India will be slightly lower, but I think that's the network play here. To answer your first part of that, what we can expect this to grow, as I said, it is a severely underpenetrated market. There is India as a market is hugely unorganized in the dialysis. 80% of the dialysis is still in the unorganized market. So there is this huge play of shifting unorganized to organized, catering to this unmet demand, and this whole new patient funnel that will keep coming in because of hypertension and diabetes. So largely this number, what we have demonstrated in past, we are fairly bullish in future as well.
Hi, Rohit. Good morning. Congratulations on the listing to you and the entire team as well. A lot of hard work would have gone into this, so wish you all well. That said, I was looking at your revenue mix. I want to know how do you see things pan out between domestic revenue as well as international revenue? What's the mix, and where's the profitability more?
Okay. So again, thank you very much once again for having me here and for your wishes. Yeah, indeed a momentous day. So as we have seen that, and it's mentioned in our documents as well, close to 60% of our revenue is from India and 40% is from the overseas business. We have just moved to overseas business 4 or 5 years ago, and we are operational in Uzbekistan, Nepal, Philippines, and now entering Saudi Arabia. So we expect this mix to remain on the similar lines, because at Nephro Plus we have India division and international division. They're 2 clearly earmarked divisions. So India continues to grow at the healthy CAGR that we have witnessed in the last 10 years and plus. And in the international markets, we will go deep in the markets that we have committed, like Philippines, and start business in Saudi Arabia. So this will also inch up slightly, and we might explore newer markets in every 12 or 18 months time period. So international and India, I expect the ratio to remain on the similar lines, with few basis point every year or so to be increasing by the international pace, but largely the balance would remain the same.
All right. We'll, try and understand your business a lot more, the growth drivers, the cost levers, etc. a lot more once you come out with your numbers, because right now you're bound by regulation to not give us some forward-looking targets, etc. as well. So what we'll do is we'll let you celebrate today with a promise that you join us back after your quarterly results, and then we understand a lot more in terms of, the growth drivers for the company, your in-hospital versus out-of-hospital, the kind of investments that you make, and the ROI that you generate on each of those centers, and which is more profitable for you. But for now, celebrate today, and thereafter we'll obviously come back with a lot more questions. Take a short break. On the other side, we will get you all the market technicals. Chandan Taparia of Motilal Oswal Services joins in.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Welcome back. Markets down close to around 40 points. The Nifty Bank actually is taking a harder knock, and now it's approaching that crucial 58,500 mark. Actually, we got a couple of 100 points to go till there. So that's the one that will have to lead the fight back. Well, let's get in Chandan Taparia for a technical check on the markets. Hi, Chandan. Good morning. Good to see you win. What do you do? Towards the end of the year, we were hoping that the FI is going to break and the markets at least, end strong, and hopefully the broader markets as well participate. But today we're down another 35 points after falling close to around 160, 170 points. How do you trade it?
Yeah, good morning, Nigel. Thanks for having me. So the problem is the market got stuck in a range. Most of the data setup are indicating positive stance, but 2 or 3 data setup are not allowing market to hold at higher levels. We have noticed that index got stuck in a range with multiple support near 25,700. But at the same time, the absence of buying interest is clearly visible in between 26,000 to 26,200 marks. Good part is that index is holding well above its rising trend line and 50-day exponential moving average. But at the same time, sustained call writing at 26,000 is not allowing market to move on the higher side. So I believe the couple of reasons are there, and because of that, we have to be in a broader trading range. India VIX is below 10, which has been falling down from last 4 weeks, corrected from 13.85 to 10 level. So lower VIX is not allowing market to catch the momentum. USD INR is at 91, so weakening rupee is the key concern, and because of that, FI's flow is missing in the Indian market. FI's long short ratio is below two-digit mark of 9.5%. So absence of FI's participation is the reason that momentum is missing. But we have to be in this range. 25,700 to 26,000 is the range where we are looking market to trade for next couple of days. Talking about Bank Nifty index, Bank Nifty is also moving in a broader range of almost 1,200 points from last 20 trading session. Multiple supports are visible near 58,700, and at the same time hurdles are visible near 59,500, 59,800. So we have to be in this trading range in the Bank Nifty as well.
All right, Chandan, so you've spoken about the indices, the Nifty Bank now making a bit of a recovery attempt. Individual stocks, what do you have on your list right now? SBI is actually spiking right now. SBI has moved to the high point of trade. That's actually explaining the kind of spike that we've seen on the Nifty Bank from the lows.
Yeah, so SBI is my preferred pick. In fact, expecting the momentum in the counter, which can take it to 4-digit. The good part is that even after market consolidation, the higher base is clearly visible. Put call ratio of the counter is trading at higher levels. We have seen short covering activity in the counter with put writing at lower strike, including 950. It has been consolidating in a range, and today it has given a breakout with a surge in open interest activity, which indicate momentum could be seen. And in fact, a couple of PSU banks, or in fact the PSU index itself, moving upwards. So expecting SBI to do well with support of 960. This time it can head towards 1,010 marks, which is the lifetime high territory of the counter. Second trading idea, that is buy on Hindustan Zinc. And we are quite positive on the metal as a theme. In fact, as per the seasonality, Nifty Metal Index usually do well in the month of December. And this is the seasonality track of 8 times out of 10 times. So I believe this momentum could continue. And momentum precious metal is also the key trigger, which could keep the momentum on the higher side for most of these names. So positive on the Hindustan Zinc, Vedanta, National Aluminium. So here we are recommending to buy on Hindustan Zinc. However, it has been making higher top, higher bottom, really do well from 480 to 580 marks. But trend is intact. Buy on decline could continue. So one can buy with support of 570 for an upside target towards 595, 600 kind of level. One trading idea that is on the sell side, looking at the balance approach in the market. So Max Health is one counter which has given a breakdown after long 8 months. It has given a decisive breakdown with formation of head and shoulder, which is very simplification. We have seen build-up of short position. So because of that, weakness could be seen. One can sell with a stop loss of 1,080 and it can go down to 1,020.
Take that point, Chandan. Thank you so much for that. We take a short break, come back, get you more on the markets, a lot of stock-specific action, perhaps get you an insight into what's taking place in the city gas distribution space as well.
Fly Emirates, fly better.
Welcome back. Even as more stocks are declining than the number of stocks which are advancing, the ones that are moving have some gusto with them. You have Aditya Birla Fashion Retail. That's the stock that should come up for you. Up around 5.5% right now, and fair amount of volumes backing that counter as well. Remember, it's the demerged entity. This year itself, the business is demerged. Right now, up 5.5%, with volumes which are typically 3.5 times of what we see on an average in the first 2 hours of trade itself. So that's one of the stocks which you must keep on your radar. But the other group of stocks which are buzzing around are all these city gas distribution companies, as the PNGRB has notified that the unified natural gas tariff will come into effect from the 1st of January, the start of new year, and there's a Nomura upgrade on IGL2. Sonal joins in.
Thank you so much for that. Well, as you pointed out, it is a notification that has come in from the PNGRB, which is the regulator for new unified natural gas tariff structure. Now, do remember, all the details were already known. This is just a notification that has come by to talk about the effective date. So there are no new details that have come by. It is just the final date being announced is something that has gotten the stocks excited and the upgrade as well. So just to give you some more details, tariff zones will be reduced from 3 to 2, up to 300 kilometers and beyond 300 kilometers. There will be 2 tariff structures as well, and CNG and domestic PNG consumers, they will be given priority and they will have to pay zone 1 tariffs, which are the lower ones. So if we talk about both the tariffs, up to 300 kilometers it is 54 rupees, beyond that it's 102.86 rupees. Because they will only follow the first zone tariff, they will see a fall in CNG prices by 1.25 to 2.5 rupees per kg, and PNG prices by 0.9 to 1.8 rupees per SCM. This will lead to higher volumes because ultimately consumers will benefit from this, and that is the reason these regulations were expected to be very positive for the sector. Nomura also has come up with a note on IGL. They've upgraded the stock to a buy, a target price to 230 from 215. They say from here on margins will get support from lower tax and transmission as well, transmission tariffs as well. Lower tax because it will be 2% now in Gujarat versus 15% earlier. There'll be lower transmission costs because now it's a priority sector in the zonal tariffs. And third, they also expect Henry Hub prices to come off because now they are at elevated levels, and this should start supporting margins from Q1 of FY27, and that's why they are quite bullish on IGL from these levels.
Okay, all right. Thanks a lot for that, Sonal. Well, on that note, though, we'll wrap up on this edition of Chartbusters, but the team of Trading Hour is waiting by for you.
Hello and welcome to Trading Hour. I'm Ritu Singh and joining me live from the CNBC-TV18 Motilal Oswal studio in Mumbai are Mangalam Malu and Hormas Patakia. Look at the markets. It's been a volatile day of trade. Started up and now down about 128 points on the Sensex, 43 points on the Nifty as we speak. The Midcap index also down about 215 points. The Bank Nifty has also taken a knock, down about 120 points as we speak. Market breadth very much in the favor of declines, the ratio being at 1:1.8 as we speak at the moment. All the major indices are in the red, barring exceptions like the FMCG pack. You have the energy, metal, IT and PSU Bank index. But, lots of focus on individual stocks. Mangalam, Hormaz, hello, take it away.
Yep, indeed. A lot of focus on individual stocks today, though it's... the highs were sold into. Let's see whether the lows get protected or not. The advanced decline as well. At this point of trade, firmly in favor of decliners, just like yesterday, where over 2,000 stocks declined. Right now, we have about 1,800 stocks in the red. But if one had to clutch onto straws, the Nifty is still holding on to the 50-day moving average. And a lot of these PSU banks are doing fairly well. The Rupee itself has strengthened back from record lows. So let's see whether this is just temporary or this is something that continues going forward. So those are a couple of indices, stocks and macros which are slightly better than what we saw yesterday, but a lot of stocks which are buzzing. Hormaz has walked across to the wall.
Well, the broader market's not painting a pretty picture, but there are certain names that are doing fairly okay for themselves in today's session, even in a market like this. And Apex Frozen Foods is one such name. Now, the stock has done well in the recent past. It's gained in 4 out of the last 5 sessions. It's up 9% today as well. It snapped an 11-day losing streak last week and then has managed to rebound from those lower levels. Today's session, we have seen over 10 lakh shares traded, the 20-day average of 5 lakh shares, so already double of its 20-day average. It's been constantly taking support at its 50-day moving average, which is at 260, and it continues to rebound from those levels. And as a result of this gain today, the stock has turned positive on a year-to-date basis. The stock was up around 20% last year as well. Polycab is a stock that's not doing well for itself today. At the lowest point of the day now, 4% lower, among the top losers on the Nifty 500. It snapped a 4-day gaining streak today. The volumes, the stock has declined on volumes that are the highest in 2 months, and the stock has already seen over 15 lakh shares traded today. The 20-day average is just 55,000 shares. The stock has also now broken below its 100-day moving average, which is over 7,300. And after 8 straight months of gains, the stock is now seeing its 2nd straight month of losses. And at this pace, this could well turn out to be the first negative year that Polycab has had after its listing. But one stock that continues to buck the trend is EPAC Durables. The stock was the top gainer in the broader markets yesterday. It's extending those gains another 9% higher now after yesterday's 16% surge. Today's volumes are already well over 50% of Tuesday's volumes, and the turnover already is at more than 65% of its free float market cap. Now, over 2 crore shares have already been traded on EPAC Durables. The 20-day average is just 1.5 lakh, and the stock has now convincingly moved above its 50-day moving average of 299 and is now up over 30% from its 52-week lows of 245 that it had fallen to last week.
Take that point, Hormaz. Thanks a lot for that. So those are a bunch of stocks which are buzzing. None harder and bigger than Meesho, up around 8.5–9% right now, moving towards the 200 rupee mark, and that's after seeing a stellar listing and those gains post-listing sustaining as well. In fact, now as we speak, Meesho is up 17%, 211. So last time I checked, it was up around 10%, and it's seeing gains in quick succession. Remember, a large part of the equity is still blocked for trade, so it is moves which are happening on low float which is available in the market. But today's up move can be attributed to the UBS note that has come by. They've initiated coverage on the stock with a buy rating, target price of 220, very close to where we are right now. It implied 22% upside in the morning, but now it's about 5–10% upside itself after a 17% move that we've seen. Asset light, negative working capital business ensures that there is positive cash flow. That's something that Vedanta told us as well. They have over 1,000 crores of free cash flow, and they believe that this will grow. The net merchandise value for them likely to compound over 30% over the next few years because of the headroom that is available, and all of this comes at an improved contribution margin. Global benchmarks are between 8 to 10%. The company did about 3.8% in the first half of the year. The management said that they would like to veer towards the global benchmarks, and right now the expectation from UBS is 6.8%. The average order value has declined, and that's by design because the company has been passing on efficiencies to the customers, and that has resulted in increased order frequency. So order frequency has increased from 9 to 15, and they believe that average transacting users, which are about 1 in 6 Indians right now at 20 crore, that itself will surge to about 51.8 crores over the next 3 to 5 years, and as a result of which, they believe in the long-term story of Meesho, the stock gaining in short term already. But another stock which is on our radar, late towards trade end yesterday, we got the update on Vedanta, where the NCLT has approved the demerger, and Kotak Institutional Equities has written on the stock today.
Well, that's right. Kotak Institutional Equities, they have gone ahead and they have upgraded Vedanta to buy with a target price of around 650 rupees. They have revised the consolidated EBITDA by around 4 to around 6% because they are factoring in higher LME prices and weaker Indian rupee as well. Now, it's important to note that commodity price assumptions that they are working with are 5 to 25% below the spot rate. And they are saying that their FY28 EBITDA actually would be 10% higher on spot prices itself. And so their bull case pegs the target price at around 770 rupees. That's on FY28 assumptions. A few factors that they've noted. They're saying that buoyant commodity prices, well, that's putting Vedanta in a good spot. On the aluminium division, which is bulk of their profitability, they're saying that one as well is in a very sweet spot with growth as well as margin accretion drivers going ahead. And because of that, on the aluminium business, they're estimating, EBITDA number of close to around 1,077 or 1,100 and then 1,200 over the next few years. That compares, remember, with around $940 on a per ton basis. So they're clearly expecting the aluminium margin to move up substantially. And finally, the last point that they make is the parent, Vedanta Resources' debt concerns are now well behind. So all in all, Kotak quite impressed, with this NCLT green signal with regard to the demerger, and they have gone ahead and upgraded Vedanta Limited.
Second upgrade in the last 2 months as well. Nigel, thank you for that. The upgrade coming in on Vedanta. Of course, the stock at record high levels. 580 was the high that it made earlier in the day today, and still trading with gains of around 0.75%. Take a short break. On the other side, everything bond markets with Manisha Gupta.
CNBC-TV18 and India Bonds presents Bond Street.
Well, as promised, let's shift focus to India bond market, and I want to refer to the latest Niti Aayog report, which talks about on how India corporate bond market really needs to grow 7 times its current size. That is, if it wants to meet its long-term or bring it long-term financing demands. If it also needs to do that, if it wants to reduce its heavy reliance on bank-led debt, which is currently the market in its current shape and form there. Also, when you look at the US bond markets, well, they are larger than their equity markets, and that clearly is a phase that we have seen with most of the developed world. When you look at the India corporate bond market, well, it stands at around $650 billion, which is much lower, versus UK, which has a bond market of around $4 trillion. So that really is the case with US and China as well. Huge bond markets, large scale as well, and you have a big participation continuing there, which is not the case for India right now. The other thing that the Niti Aayog report puts out is that when you look at India's equity market, globally competitive, but the corporate bond market is 1/7 of its size, and this is what the Indian financial markets perhaps needs to work on. And having said that, it is only 1/6 of the corporate debt market in India, which is raised via bonds. So while of course you have to work on the overall bond market in India, but it is the corporate bonds which really need to be in focus right now. The other thing that the Niti Aayog report puts out is the bond issuance timing in India, which is quite slow at around 20 to 60 days. This is vis-a-vis 1 to 5 days that it takes in US and UK to issue a bond there. The push to the India bond market also comes in on the fact that the regulatory coordination needs to be worked upon. The only way that you can push the bond markets in India is by the way of improving infrastructure, by broader issuer participation as well. The other thing it talks about is the introduction of newer instruments which comes in case of green bonds, energy transition bonds, rural development bonds, and MSME-focused securities as well. Technology-driven platforms also, while we do understand that the online bond platforms, there are 29 of them right now, but this is yet another thing that would perhaps drive the new model success that equity markets have seen to be replicated in bonds as well, to ensure that we see stronger numbers there. Well, that's about the bond markets, but with that, let's slip into a short break. When we return, we'll discuss markets and chart prospects.
CNBC-TV18 and India Bonds presents Bond Street.
You want to talk business? Meet me in the Onboard Lounge.
Still fighting to hold the 50-day moving average on the downside is the index, around 20 points lower. So we're still off the lows of the day, ever so slightly, but we are off nonetheless. A couple of movers in the broader markets. Look at Apex Frozen Foods. We spoke about that, 11% higher on the stock. And Walchand Nagar too. We spoke about this earlier in the week. The stock is up 12% in today's session as well. But Mangalam has hopped over to the F&O desk and he's telling us what are the latest trends in this midweek trading session. Mangalam.
Well, down but not out. That's exactly what, the mood of the market is right now. The Nifty is just about 18 points in the red, which is a recovery from the lows. At the same time, while it's off highs, nothing really to worry about because it's holding on to important levels. If you look at, the advanced decline ratio as well, there are more stocks declining than the number of stocks which are advancing. But from 15 minutes ago, where there were just 800 stocks in the green, now that number has moved into triple digits. So it's about 1,000 stocks, or rather, triple zeros. It's about over 1,000 stocks in the green right now. Those lines coming slightly closer. A bunch of stocks which are buzzing with a fair amount of volumes backing them as well. You have AB Fashion and Retail, you have IGL, you have M&M Financials. All of them have some volumes backing them. And alongside that, we've seen some traction on SBI, Can Bank and Bank of India. A lot of these PSU banks too. Maybe the strength in the rupee has something to do with these PSU banks being well bid in today's trading session so far. The Nifty is held on to important levels. We spoke about the 50-day moving average, 25,789. Now the next thing to watch out for is whether the Nifty bank goes ahead and crosses past the 20-day moving average of 59,300. If that happens, then the recovery is well and truly underway. But, both call writers and put writers believe that the market right now is in this very narrow range. The 25,900 call writers, which corresponds with today's high, they are still fairly active in today's trading session. The premium down 28 rupees, about 100 rupees in premium, telling you 26,000 still remains an extremely important resistance. Stiff resistance between 26,000 to 26,050, notwithstanding the recovery that we've seen. But the fact that there has been recovery tells you that 25,800 is an important support as well. So the 25,800 put fairly well bid as well. And that stock, that option is trading at around 90 rupees, telling you between 25,750 to 25,700 is important support. So broad range on the index, 25,750 to 26,050 on the whole. A lot of individual stocks on our radar. We have Hind Zinc, which has seen a lot of long build-up, even as silver prices have moved higher. So that stock has moved to a record high. And interestingly, a lot of shorting activity on Polycab. So we don't know any news out there, but typically, Polycab, the stock moves happen before any sort of news comes by. A big spike in open interest. The stock is down 4%, and that open interest spike, understandably, is on the short side. So maybe we'll monitor if there is any news that comes by on Polycab. With that, we'll take a short break, come back on the other side.
Yep. Just before we do that, Abhijit Choksi from Stossify is with us for a quick chart check. Abhijit, good morning. Thank you for joining in. We are stuck in this very narrow range, right, between the 50 DMA and the 20 DMA. Are there any signs on the charts of a breakout in either direction, say above the 20 DMA or below the 50 DMA? Your call on the index and your specific stock recommendations as well.
Yeah, hi, good morning. So in stock specific section, I like this MNC power company called GE Vernova. It's the part of the global energy group GE. Now, the crazy part about this company is that 50% of India's power is monitored through the solutions provided by them. NTPC, Adani, Transmission, Reliance are their main clients. And what I like about this is that in just 1 year, their EBITDA margins have doubled and the company is almost debt free with 35% consistent 5-year CAGR growth. I'm just seeing this as a bet where a company responsible for 50% of India's power grid is available for less than $10 billion. I believe this is more like a safe stock in such kind of a market environment where this story seems like a good compounder. Thank you.
Well, Abhijit, quickly on Shriram Finance, given the expectations of deal announcements after their board meeting this Friday, and on the larger banking NBFC pack, with the kind of FDI flows we've seen come in this year, any top picks?
Yeah, I'm liking JM Financials in that sector. I believe that is more like a safe recommendation. There's just a disclaimer that I have already recommended to my clients at stockify.in. Thanks.
All right, Abhijit, we'll leave it at that. Thanks very much for joining in with your recommendations. On that note, we'll take a very short break. Don't go anywhere. We're back with the markets in just a bit.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Welcome back. The Lok Sabha has approved the Insurance Amendment Bill, and this allows foreign companies to own up to 100% of Indian insurance businesses. The government believes this is going to bring more money into the sector and make it stronger. The bill has also introduced changes to improve how insurance companies are run and to increase insurance coverage across the country. We spoke to a whole host of industry experts. Listen in to what they made of some of these changes.
We have been making our position clear on open architecture. More than the insurance companies per se, yes, insurance companies also had its own benefits to look at, but looking at how the customer should be served, it is difficult for an individual to be knowing the products, multiple products of many life insurance companies and going and presenting the right product to the customer. It was not going to be an easy task. An agent representing one life insurance company would have been beneficial for the agent as well as the end consumer as well. We were requesting the government for making this provision available, and I'm sure the government had taken a stand, and open architecture, which was originally proposed or it was being talked about, is not part of the current bill. Certainly LIC stands to gain the sense, as you said.
The fact that we weren't necessarily entirely comfortable on multi-tied agency, given the fact the amount of money that is spent on an agent can vary between 15 to 25,000 rupees that a company spends on training an agent over 3 to 5 years. So that was a little bit of a tricky one, and I'm happy to see that it doesn't find the light of day here. The investment guidelines have been made a lot easier, is very good. I'm particularly excited about the fact that we can now invest in private limited companies, which usually are the companies who have invested in technology and can get early investment, and not just do they gain, but even we gain at the same time.
In fact, Tarun Chugh also confirmed the CNBC-TV18 news break from the 15th of December on the life insurance industry moving towards deferred commission model for distributors. The Bajaj Life MD and CEO also said that moving towards this deferred commission model will certainly be a welcome move.
If there is regulation where kind of it is mandated that they're more deferred than upfronted, it will be lesser of an eyesore, is the way I see it. I welcome the fact that there is a overall commission discussion that is going to restart, and the chance of it being deferred should be welcomed as well. Let's see how the transitioning happens. The issue is always in the first year transitioning, and I think people have their own business models. You just see how the IRDA helps the industry or handholds the industry in this regard.
All right, that is about the insurance space. The market is giving up some of those gains that we saw just 20 minutes ago. So the Nifty now down about 40 points, with coming very close to moving into the green, now down being about 40 points, moving towards that 25,800 mark. It'll be very interesting to see that if the market finds support once again here, because if that happens, there'll be a double bottom for the day, and thereafter we would see a bit of an up move from here. In case it breaks that, then there could be a bit of a rough ride as we move towards the end of trade. Asian Paints, Apollo Hospitals, both of them currently at the low point of trade, and even as banks are doing well, a couple of these NBFCs not particularly well. So Bajaj Finserv is one which is lower as well. Before we take that break, just pull up the intraday chart of Eternal 2. That stock's been under a fair bit of pressure over the last few trading sessions. Today opened in the green. There was a positive brokerage note that came by as well. But now, quickly, the stock's given up all those gains, sitting with a gain of just about 75 paise. Take a short break, come back. Market fundamentals with Prabhakar Kudwa of Samviti Capital.
Fly Emirates, fly better.
Welcome back. You're watching Trading Hour. The market's still in the red. The Nifty tried a bit of a recovery we've been seeing, but in the last hour, but still holding on to about 25,800 levels. The Sensex still down about 149 points as we speak. But Prabhakar Kudva from Samviti Capital joins us now to discuss some market fundamentals and his top sectoral picks. Prabhakar, welcome. Thanks for being here. In the current volatility that we're seeing, what are some of your top sectoral picks for the next 6 months or so, and why, if you could take us through that?
Yeah, thanks for having me. I think what's really doing well, especially post the GST cuts, has been the auto ancillary space. I think autos and auto ancillaries in general are doing well, but auto ancillaries specifically because they seem to be, have reached a sweet spot where both the domestic as well as the export markets are doing well for them. And a lot of premiumization is happening in the Indian automotive space. And a lot of these auto ancillaries are seeing not only a top line growth, but also a margin expansion. So I would say auto ancillaries remains one of the best spaces over the next 6 months. Other than that, I think the power space, right, which actually did very well in the last cycle, also continues to do well because it has, again, multiple tailwinds, both from the domestic T&D, that is transmission and distribution, as well as the whole AI capex, that's happening, and where these are the ancillary beneficiaries. So power remains the a sector where there is good earnings visibility, at least over the next couple of years. And third, I would say, is the pharma space, where there is a tailwind driven by GLP and a lot of other peptides. So a lot of Indian companies that are in that space are likely to do very well over the next 2 to 3 months. And finally, I think selected mid-cap IT names, which again, are enabling a lot of IT for enterprises, seem to be in a sweet spot.
Alongside that, some of the select pharmaceutical names as well. Right, Prabhakar, I just wanted to know about IGL, because while you like power, a couple of these utilities are doing fairly well as well. IGL is up 7% right now as we speak. The street believes that this one nation, rule that has come in for city gas distributors should be beneficial for customers, and as a result of which, increased volumes for a lot of these city gas players. Do you put them in the same bracket as some of the power players in terms of utility?
Not really, Mangalam. I think the regulated utility players, right, they have capped ROEs. So I think they are more of a play where you buy them when they are undervalued, and you have to kind of sell them when they get overvalued. The segment that I'm talking about primarily is the segment that's focused on the transmission and distribution space domestically, and spaces where they are exporting stuff which is enabling the AI capex globally.
Prabhakar, pretty much large consensus on the street has been on private financials. Does that not feature in your pecking order because of the large-scale foreign investor interest that you are witnessing, particularly in the mid-sized financials? You saw some deals in Federal Bank, RBL Bank, Yes Bank, and now you are watching a new large name, Shriram Finance, entering the fray as a board meeting on Friday. Why not private financials in your pecking order?
Yeah, I think the primary reason is that if you look at a lot of these financials, right, the size of a lot of these, at least the large cap financials, has become, the base has become quite big. So the growth rates that an HDFC Bank and a Bajaj Finance used to show in the past, right, now they've halved. So I think there is not so much, for a growth investor like me, there is not so much of opportunity there in that space because the valuations are fair, the growth rates have slowed down, and the larger names are more likely to mimic what broadly the GDP, or 1.5 times the GDP growth, right? So we're talking about anywhere between 10 to 12 or 14% growth, right? So in the larger names, that is why I have not featured them. The mid cap names, to be honest, while the prices have done well, right? If you go back and look at the numbers, right, the earnings are nothing that exciting, right? The earnings, because the credit growth itself has been quite anemic over the last couple of years in India. So since I don't see the numbers yet, I'm not very confident to go and bet on them.
All right, Prabhakar, apart from, some of these names that you mentioned for the broader markets, cues in terms of what's happening on the macro front with the rupee, any select names there, and, domestically, some of the cues to look forward to before we close the year.
Yeah, I think like I named a few. I think midcap IT is a very good way to play, the rupee, right? Because again, what I mentioned for the private financials holds good for the big 3 or 4 IT names, right? The growth rates have been anemic, and there are not much of tailwinds for them. The size is too big, so even if they have a piece of the AI, right, it will not move the needle, for the entire revenue pie. So I think midcap IT names, which are focused on the AI enablement for enterprises. And I think a lot of names which have kind of been beaten down because of the whole tariff thing, right? I think it's a matter of time that this tariff issue gets resolved. It's been delayed already. So I think a couple of some textiles, I think, can be an area where there can be a 6-month trade. Similarly, a few shrimp players, right, who have done quite well in spite of the tariffs, right, can be an opportunity over the next 6 to 12 months.
Just pull up Meesho, 20% circuit now on the stock, and it's now nearly doubled from its IPO price of 111. And in line with Meesho, also pull up Urban Company. That stock has seen a very sharp spike. That has also moved towards the highest point of the day now, 4.5% higher there as well. And that is rebounding from the post-listing lows of 120 that it had made. Any of these new listings on your radar, Prabhakar? Meesho, Lenskart, Urban Company, all of them have come with a lot of hype. Urban Company from 200 is down to 120 now, but Meesho continues to move higher. Anything that you have spotted?
I think a lot of us put all of these new age companies into one bucket. I think it's important to differentiate between them. A lot of us get carried away by the success of Zomato, which is eternal now, and Paytm, right? But we have to really understand that Zomato and Paytm were basically had the sector itself had very less competitive intensity. There were only 3 or 4 players in the entire space. But if we talk about the electric two-wheelers or any of these other spaces, right, although they are new age platform companies, the competitive intensity is very high. Right, so unless you have a space where there are only 1 or 2 players who are dominating, who have network effects, I think we'll have to be really selective in this new age space. And a lot of them are being dressed up for the IPO, which is very clear from the numbers, right? There's good revenue growth, but the profitability has only improved over the last 1 year or the last few quarters. So I think one needs to be very selective and bet into the new age spaces wherever there is some sort of a competitive advantage.
Right. From the conversation that we've had so far, the sense one gets is that you veer more towards value and, companies at a price rather than paying absurd valuations for promised growth. In that case, you like the financials. Where do the public sector banks stand in your overall scheme of things? Today, they're fairly well bid. You have SBI, which is among the top gainers today. PNB is doing well. We have Bank of Baroda. So do you make that distinction as well, basis the valuations at which they're available?
Mangalam, I think the first criteria for me always has been growth. I think you have to look at value relative to the growth, right? So in a lot of these names, there is no growth really to speak of, which is why I said even the large private financiers I'm staying away from, is because the growth is not, the superlative growth or an above average growth is not there. So I think the number one criteria has to be growth. Once you have growth, then you look at valuations as the second criteria. So I think in these names, the absence of growth kind of keeps me away. And in the new age companies, while the growth is there, when you come to the second factor, right, the valuations are absurd and the profitability is just not there. So I think that is what kind of keeps me away from them.
All right, Prabhakar, thank you so much for sparing time and joining us today with your views on the sectors and specific stocks as well. Take a short break. Our big story on the other side. Stay tuned.
You want to talk business? Meet me in the onboard lounge.
Welcome back. Continuing to meander in that very narrow range is the index, but the big story of the day is the record foreign inflows into India's financial sector. While overall foreign flows are ebbing, the financial sector has seen inflows of over $7 billion this year. And another big one could be on the cards, with Shriram Finance set to consider a fundraise on Friday. A development that comes after reports suggested that Japan's MUFG is set to pick up stake in the company. Gaurav is first here with more on the Shriram Finance details. Gaurav.
Well, yes. So much awaited, or rather I should say much speculated deal is likely to happen, because on 19th of December, which is Friday, Shriram Finance is going to have a meeting where they will consider fundraising, which also includes QIP. Now, why this is important is that earlier we have seen many speculations happening around Shriram Finance that MUFG, the Japanese firm, is looking to buy around 20% stake in the company. In fact, the latest reports suggest that the valuation is going to be anywhere around $3.2 billion for the company for 20% stake. Now, why this is important for Shriram Finance? If you look at Shriram Finance, they already have around 20% capital adequacy ratio, which is more than enough of what is required at 15%. So this fresh capital, this can be used to reduce the cost of fund. That is number one. Second is that we have already seen management actually being a bit bullish about their growth guidance. They say that the growth could be somewhere around 17%. And at the same time, given this scenario, another rate cut is also happening, and at this moment, this can also lead to reduced cost of fund. Now, given that MUFG, if it enters in Shriram Finance, this will also make a case and headroom for further credit re-rating, and that is the reason why we may see further cost of fund decreasing. So, all in all, it is going to be positive for Shriram Finance. Now, if you look at the stock performance in the last 6 months, already we have seen the stock was up almost by 27%, and another headroom which to highlight is that if you look at valuation now, price to book for FY27 earning, it stands at around 2.2 times for Shriram Finance. If you compare it with its closest peer, which is Cholamandalam Investment, it trades at around 4.1 times. So definitely there also makes a case that there is a headroom for growth even further. So given that all these developments are happening and this is the end of the year, we are hoping to see some big move, specifically in terms of the news flow. And on back of that, we will definitely watch out on the announcements coming up from Shriram Finance on this Friday.
All right. Thanks a lot for that. All these announcements coming by on this Friday, Ritu. But foreign investment, how has that picked up in India's financial sector? You've done a deep dive.
Well, Mangalam, this Shriram deal is only going to be a cherry on top of the cake. It's been a spectacular year. Record foreign capital coming into banks and NBFCs in 2025. In fact, so far, we've seen about $7.5 billion already come into banks and NBFCs. The largest one, of course, coming from Emirates NBD, which acquired a 60% stake in RBL Bank for nearly 26,850 crore rupees. That's about $3 billion. And the story will get even bigger if this reported Shriram Finance MUFG deal does go through. And it's going to surpass all records estimated at what Gaurav was telling us, $3.2 billion. And that will push the total foreign capital that has come in this year alone into banks and NBFCs at $10.7 billion or more. But it's more than just these numbers. The RBL Emirates deal and the Samman Capital IHC investments, that marks a shift from minority stakes to more operational control that we're starting to see. In the secondary market transactions as well, we're seeing ownership getting reshaped. For instance, in Yes Bank, SMBC, the Japanese lender, is going to be the largest shareholder, largest foreign shareholder at 24.2%, although not categorized as a promoter. Private equity sovereign funds, they're also making some long-term strategic bets with what we saw with IDFC First Bank, and also Federal Bank and Blackstone earlier. The investor mix is also quite diverse when you look at these foreign players. So global banks like SMBC and Emirates NBD, sovereign and holding companies like ISC and ADIA, and private equity like Blackstone and Warburg Pincus. What is striking is also the shift from minority stake to capital-infused growth. So unlike previous years, the deals this year are quite large, they're strategic, and often promoter changing as well. So the sector itself is maturing as a global investment destination, and that seems to be supported by RBI's evolving stance on allowing foreign ownership in Indian banks. A quick look at the headline deals. The largest one, of course, RBL Emirates for 26,850 crores. Yes Bank SMBC up next, 16,330 crores. Samman Capital IHC 8,850 crores. IDFC Warburg and ADIA about 7,500 crores, and Federal Bank Blackstone at 6,169. Altogether, that alone is worth more than 65,700 crores flowing into Indian banks and NBFCs. A clear sign of some strong global interest in the sector. And now we're awaiting more, because we're not done just yet.
Oh yes, we'll all be watching out for Friday when Shriram Finance holds its board meeting for that fundraise. But Ritu and Gaurav, thank you for summarizing our big story for the day. Take your leave on this edition of A Trading Hour. Mangalam, Ritu and I say goodbye. Halftime report on the other side.
Stocks drift lower with market breadth remaining negative. Industrials, consumer durables and realty are the big drags, while metals and IT eke out gains.
Amid a slew of big-ticket investments in India's financial sector, Shriram Finance has scheduled a board meet on December 19th to consider fundraise. The filing follows recent reports of Mitsubishi Financial Group eyeing a stake.
Ola Electric promoter Bhavish Agrawal says 3.9% in the EV maker for nearly 90 crores to help pare down promoter debt of 260 crores and release all pledged shares. The move follows S&P's downgrade of Ola Cap's parent to CCC.
Rupee recovers nearly 1% from a new all-time lows of 91.07 per dollar to hit a high of 90 per dollar. Dealers say a mix of RBI selling and exporters hurrying dollar sales at higher levels helped the rupee recovery. Steep fall in crude prices also helping sentiment on rupee.
Hello and welcome to Halftime Report live from the CNBC-TV18 Motilal Oswal studio. I'm Ekta Batra and with me Sonal Bhutra and Vinny Motiwala. Well, what we can see is follow-on selling in today's trading session. So extremely tentative, you'd have to say, for the markets. Remember, this is despite the rupee strengthening in today's trading session, and that seems to be failing in terms of aiding sentiment. So the Nifty trading below 25,800 as we speak. So 25,797 is currently where the Nifty is at. We have the advanced decline ratio weakness, which has continued into today's trading session. It was firmly on the negative side yesterday, and that seems to have continued today as well. So overall, the picture doesn't look too great at this point, a bit tentative for the markets.
Hey girls, good afternoon. At the day's low when we start the show, right? And a lot of it is coming in from some of these big banks. HDFC Bank, for instance, is at the day's low as we speak. ITC, HUL, Asian Paints, so some of these FMCG names. So remember, this was an outperformer in yesterday's trading session, but has come in for some profit booking today. So all these names are at the day's low. We do have Kotak Mahindra Bank also contributing to some of the losses that we are seeing. There you go, HUL, a sharp fall from the highs, and that is the story for a lot of these consumption names as well. So we'll keep tracking that for you. But for now, it is a red looking screen across all the major indices, far and few in the green as we speak.
Absolutely, very far and few in the green. Let me just highlight that few that is there as well. PSU Banks, that's managing to hold on gains, top sectoral gainer today. We have Bank of India, Canara Bank managing to hold on to good gains. SBI more than 1.5% gains right now for SBI as well. IT, metals, that is doing well. So metal continues to do well. Obviously, we have seen silver prices also move to those record high levels. We'll keep an eye out on that. A lot of metal names like Hindustan Zinc, Hindalco, Nalco are some of the gainers as well, Ekta.
Yes, absolutely. So that's what's taking place in terms of the markets right now. But let's kick off the show with the first management on the show. We have Seneris Pharma, which is the first company that we're tracking. The stock has gained more than 40% in 2025 so far. It's a recent listing. In fact, the company is in focus because they've acquired Apnar Pharma for an enterprise value of around 91 crores. To discuss this, we have with us Swapnil Shah, who's the promoter and the MD of Seneris, joining in. Swapnil, thanks very much for taking the time out. This particular acquisition, Apnar Pharma, they do have one US FDA facility. Can you just tell us when was the last inspection? Give us a sense in terms of what is the kind of capacity from this particular plant that you have currently?
Yes, hi. Thank you for having me here. So, yes, Apnar Pharma last inspection was done in September 2022, so about 3 years back. And the capacity, current installed capacity is about 275 million units, which can be extended to 400 million easily by doing a multiple shift. So that's a decent size capacity that they have. And it's also UKMHRA and Health Canada approved manufacturing site. So it comes with all three certifications with the plant.
Okay. Swapnil, you will also be taking 5 ANDAs which will be acquired via this facility. Can you give us a sense of what the size is here and what is the opportunity you're looking at after this acquisition?
Yes, so these 5 ANDAs are pretty decent in terms of where it stands. It also has a pretty good government business on all the products that we have acquired. So those products will be manufactured at our US site and then will be further supplied to government business. And also from here, we have 3 already qualified products, right? So the business, they're already selling it to the US, and the business will further scale up once we start production of those 3 products immediately, right? So all in all, if you look at it, it's quite a value buy for us. And then we get a business traction from day one. So that kind of makes it the acquisition more interesting. On 75 crore debt, I think the net debt is only 35 odd crores. The remaining is debt related to liabilities as we speak.
Okay. Hi, Swapnil. Good afternoon. Also, could you talk to us about more in terms of, is it going to be margin accretive from the first day itself that you're talking about? And also these 5 ANDAs which are there with Apnar Pharma. What is the size of these drugs? Could you give us an indication there as well?
Yeah, so it's definitely going to generate a lot more business for us for next couple of years where we are today. I think this year, FY27, what we are planning is about 120 crore from that site. And FY28 with current infrastructure, let's say we don't invest more, still we are looking at about 250 odd crores, because on a 400 million manufacturing capacity, even if I do a 4 rupee a unit, that's itself will 4 to 6 rupees a unit, that itself gives me about 200 to 250 crore sales without doing much. Total market opportunity for this 5 ANDAs is about 700 million. For us, what we are looking at about net to net about $15 to $18 million business out of this 5 ANDAs that we acquired from Apnar.
Okay. All right, Swapnil, we're going to let it go on that note. Thanks very much for joining in and speaking with us. So that's Senerus Pharma. They have made an acquisition worth around 91 crores. But remember that the US FDA facility that the company does have was last inspected 3 years ago. So that would be a key monitorable going forward for this particular plant that they have acquired along with that total acquisition. We'll take a short break, but up next, we will be connecting with Quadria Capital's Amit Verma and Sunil Thakur in our fundraise segment. They will be talking about the outlook on pharma and healthcare into 2026. Stay tuned.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Welcome back. You're still tuned into Halftime Report on CNBC TV18. Well, for the markets, we're still tentative. So let's get talking about the investment outlook in the pharmaceutical and healthcare space. Over the past 12 months, the Indian healthcare and pharmaceutical sector has attracted an estimated $10 billion in total investments, spanning private equity, IPOs, and strategic deals. According to EY data, private equity and venture capital activity alone accounted for around 81 deals across pharma and healthcare, with total investments of approximately $3.2 billion across the space. To discuss what lies ahead, we have with us the top team at Quadria Capital, a specialist healthcare investment firm managing over around $4 billion in assets across South and Southeast Asia, including India, to share their outlook for the year. We have with us Amit Verma, the co-founder and the managing partner at Quadria Capital, and Sunil Thakur, who is the partner and investment committee member at the firm. Amit, as well as Sunil, thank you very much for joining in. Well, Amit, let's start with you, because you're joining us on a day where, Nephro Plus has hit the exchanges as well. You all have an investment, and you all are, in fact, the largest shareholder of Nephro Plus. Just give us a sense in terms of how much you all have made, because you all have exited around 5%. And the time frame of investment, we understand, was quite short.
Thank you for having us. Nephro Plus plays into our deep-rooted theme of investing in single specialty care. And it's testimony to the quality of the company that it's playing into the chronic disease market, where most of our patients are on recurrent dialysis need for many, many years. As you know, India doesn't play very well in the transplant market because we don't do enough transplants. Our returns are been close to almost 2x after our investment, but the IRRs, as you can imagine, because it's a short holding period, is going to be far higher. Having said that, we are firm believers in the medium to long term of this company. So we continue to stay as the single largest shareholder, and we will continue to support the company's growth as they grow.
So just a quick word on that. If you could just give us a sense in terms of how much you probably made in that timeline of investment, and also this 30% that you do hold in Nephro Plus. What is the timeline of exit, considering that the shareholding will probably get even more diluted once you do exit?
So I'll answer the second question first. For us, our standard holding periods are 5 to 7 years. So we're in no great rush to do anything with the stock. And on the absolute returns, because we've only sold a sliver, it's not going to be a number which is going to make you jump out of the seat.
Okay, so that was about Nephro Plus, but let's talk about your fund as well. You recently closed Fund 3 at $1.07 billion. The fundraise was 60% higher than the last fund that you had. Give us a sense of where will this money go? You said single specialty is something that you're liking right now. Where are you seeing valuation gaps, and what is looking exciting now at this point in time?
So there are 5 themes that we are backing as a fund, especially in Fund 3, and that will also roll over to the future funds whenever we raise. These 5 themes starts with localization, anything that's made in the country for the country, just to bring in the supply resilience. The second theme that we're going to back is outsourcing, especially in markets like India, Vietnam, few others, which are becoming solid supply base for global markets, especially if you look at pharma services, contract manufacturing. So that's the second theme that we're going to back. The third theme is going to be consumer healthcare. The fourth is digital healthcare. And the fifth is a play that we call it the roll-up play, where we are trying to target segments that are highly fragmented. So if you see diagnostics, if you see large part of even healthcare, other healthcare delivery services, it's highly fragmented in markets like India and similar markets in Southeast Asia. So we believe that there is a big play where you build brands, consolidate the market, and then offer affordable, accessible, and quality healthcare to a larger population. So these are the 5 themes that we are going to back. Within these 5 themes, if I have to pick few segments that we are going to back, single specialty continues to be an area of interest for us, which is what we've been doing successfully for last 10 years. We like specialty pharma play, we like manufacturing, contract manufacturing, we like CRDMOs, which are mainly on the pharma services side. Preventive healthcare is going to be a big area. Then on the associated healthcare services, we like health financing, health insurance in different formats. So anything that has the tailwind of the payer ecosystem is what we're going to back.
Okay. You did talk about CDMOs as well, so I want to pick up on that point. CDMOs, are you seeing as much traction that one should see in that space as well? Because even listed players, all of them are now in the CDMO front. Most of them talk about it. And the China Plus One, is that working out for CDMO players?
So I'll do the China Plus One and Sunil can take on the CDMO, the more direct question. China Plus One clearly exists as a theme. It hasn't played out as fast as it should. We are not distressed because it hasn't played out, because we do believe fundamentally investment in healthcare takes a long time and has huge regulatory challenges. So we like serious money to come into it rather than playing to the momentum and theme. In the next 3 to 5 years, however, you will see a lot more investment in India and Southeast Asia, because finally manufacturing cannot just shift on rhetoric. It shifts because of ground realities. So just because somebody announces, stays unnamed, somebody announces shifting of manufacturing units to the US, it's not going to happen in a hurry.
Are you seeing? Oh, so sure.
We do see enough and more opportunity that can outlive at least our fund 3, and there are different pockets of opportunities within CDMO, or I should say CRDMO. So you have the research side, you have the development side, and you have the manufacturing side, and each of these 3 segments within CRDMO has huge amount of depth, especially in markets like India, where you bring high quality talent. Where you bring the manufacturing capability, and we have strong muscle when it comes to manufacturing capability, because India has had a good history of good quality pharma manufacturing for last 30-40 years. So all that will start to play, and a China Plus One strategy, which is playing out in a very slow manner, will be a decent enough tailwind to make the sector exciting for any investor over the course of next 3 to 5 years.
And just to be clear, we started investing before it became fashionable to invest in CDMOs. So we've done...
Investments also must be more fashionable in terms of returns, I'm assuming.
They've been pretty handsome returns. And the companies that when I talked to you, we started off with Concord Biotech, we've done Akums, we've done N-Cube, and now we're in Aragen Life Sciences.
So
You're the next fashion and trend.
Sorry. Concord Biotech, and you named Akums in terms of the investments, and both of them have been listed. You have a list of companies where you are invested right now: N-Cube Ethicals, Noble Hygiene, Medibuddy, Straight Orthopedics, Maxi Vision, which is basically a single specialty. Which one of these are probably going to hit the market in terms of, an IPO? Where are you going to probably see some divestment come through?
So, right now, because the IPOs are so hot, there's a lot of attention on PE exiting through IPOs. But if you look through our past track record, 50 to 60% of our exits have actually been to strategics. Only 30% has gone to other PE firms or other financial sponsors. Only 10% has gone to IPO. So we are getting the limelight because of the IPO. But there's a lot of solid work in the back to be able to sell to strategics. Why that's important? Because strategic money is actually resilient. It pays forward for all the hard work that you've done in the past 5-6 years when you've held the company. And it is then improving the overall outlook for the company, where they're not living just quarter to quarter, but actually focusing on what they need to be delivering.
Okay, just a quick question, because I'm coming back to CRDMO or PLI themes, because they've been working even in stock markets, right? Do you not think it's getting a little overcrowded now, because everybody's been talking about it? I know you are there in that theme, but is it a fear that you have as well?
So obviously there is always that fear, but see, we take pride in the fact that, and I think we also take the responsibility as being a sector specialist fund, that we want to be the ones having early conviction. So we had early conviction about a decade back in single specialty, which has now become fashionable. As Dr. Verma mentioned, we invested in contract manufacturing 6-7 years back, when manufacturing itself, leave alone contract manufacturing, wasn't fashionable at all. So our idea is always to build themes around, specific specialty areas, even within contract manufacturing. So it's not going to be just run-of-the-mill contract manufacturing. Sure. If there are technologies or modalities where we start to see green shoots, those are areas that we will start to focus on.
So what's the unfashionable idea that you're looking at, which will become fashionable?
You might get 2 different answers. So go ahead, Sunil.
So there are different pockets of opportunities that we still see in the outsourcing space. This entire global capability centers which are being built around. There are models which, as I said, which have the payer tailwinds, which is RCM and few others, which are not only oriented towards serving the Western markets, but now you see a large payer base across emerging markets in Asia. So there are those pockets. Then you also have models around preventive healthcare, both on the services side as well as on the product side. So these are certain areas that are still, I believe, not fashionable. There is the medical devices side as well, but I don't know where it sits, fashionable or non-fashionable, but there is a lot of discussion around it, but that's an area.
Yeah, but we do believe that medtech is actually going to be the next area for focus, because there's a lot of local indigenization needed in the medtech space. And there are not enough companies of scale and size which can deliver the same way that we did pharma 10 years ago.
That's very, very interesting in terms of trends that we should be keeping an eye on as well. Amit as well as Sunil, thank you so much for joining us on the show and helping us understand in terms of the trends, as well as, good luck and with all those IPOs that are coming up, plus Nephro Plus for you all as well. So thanks so much for joining in
Thanks
today.
again. Thank you for having us.
But with that, we're going to actually slip into a very short break. And after the break, we have Pratesh Mehta of Yes Securities who will join us to talk to us about some of the trading strategies. Stay tuned in.
Fly Emirates, fly better.
Welcome back to Halftime Report on CNBC-TV18. As of now, the Nifty is moved below the 25,800 levels. 25,786 is what the Nifty is trading at, down 73 points, almost near the day's lowest point. Nifty Bank 2 continues to be under pressure. Broader end of the market also seeing a bit sharper of a fall versus the benchmark indices. Nifty Midcap is down 0.4%. Small Cap 2 is trading with cuts of almost 0.4%. But let's bring on board now Pritesh Mehta, Executive Vice President at Yes Securities, to talk to us about his trading strategies. Pritesh, good afternoon. Thank you so much for joining us as always. First, let's talk about the levels, right, that we should keep an eye out on the Nifty. 25,700, that's where we are roaming around and not managing to hold on to 25,800. So what is it that one should keep an eye out on now?
Good afternoon. Thanks for having me. See, if I rewind time by exactly 2 months, in the month of October, exactly this today's day, Nifty was trading around 25,800, similar to where we are trading right now. So it shows the price has not done anything meaningful last 2 months. In fact, the breadth is corrected in the last 2 months. So we had a scenario back in October 17th, the breadth of the market was around 32%, 50%. So 50% Nifty stocks had given double top buy, which is bullish sign. And 2 months later, right now, the list is dwindled down 22%. So it shows there is deterioration in the breadth. And now, if you look at the small caps basket, we have seen correction in price also and breadth also. So ideally, as far as the index is concerned, I would like to see some sort of stability, some sort of reversal in breadth. So when that comes into play, then we could we could start talking about long strategy coming into the index. But as of now, we need to wait for a while. We can see Nifty retracing back 25,700, 650 zone also from here now.
Okay. And what about individual names, Pritesh?
So see, there are two ways. Either you try and find out opportunities by going against the trend, but I would rather stick to the leaders. And one stock that we like is from the mid-small financial service universe, that is Federal Bank. Now, this stock has been a big outperformer against this basket, has been moving higher. I can spot multiple bullish anchor columns and follow-through moves. So buy for a target of 295. The stock would be around 254. The second stock which we are bearish on is DLF. The real estate index has been underperforming since last couple of months. DLF in particular has been going through a rough trend. We can see series of double bottom sell coming in. So we can see a decline to 620. The stop would be around 710.
Okay. All right, Pritesh, I'm going to leave it on that note. Thanks very much for joining in and taking us through all of those calls on the technicals. For the markets, the mid-cap index is underperforming, so down around 0.4%. Advanced decline ratio is weakening as the day has been progressing. So currently around less than 1,500 stocks advancing to almost 2,500 stocks declining. We'll take a short break, but up next, Manisha Gupta will join in on our commodities segment. She has with her Kunal Shah of Nirmal Bang Securities. Stay tuned.
You want to talk business? Meet me in the on-board lounge.
Welcome back. You're still tuned into Halftime Report. Let's get in Manisha Gupta joining in now. Manisha, what's on the commodity radar today?
Thank you for that, Sonal. Well, I'm looking at silver prices really because we've seen yet another all-time high onto this one, and it's reached a point where you don't know where it's headed from here. We have been hearing words of caution from lots of industry participants on there is a possible correction perhaps coming, but at this point in time, it still is not there. Kunal Shah is VP and Head of Commodities Research at Nirmal Bang Securities and joins us with his sense on what really can be seen going forward when it comes to precious metals. Kunal, 66.5 done, and that's where we are standing right now. With silver, it clearly has been one new all-time high to another. How are you looking at the current price? We do understand that there is dislocation when it comes to the global markets in sense of silver, but there is a lot of speculative investment money, and currently we are also looking at lower volumes.
Yeah, exactly. So it seems that more of a short squeeze have taken place on CME rather than more than any new fundamental development in the silver market. So you see a sort of resistance at 65, and the moment it broke off 65, you are seeing 66.5. So I think the short squeeze is taking place on CME. I would not recommend to go long at these levels. We are not having a comfort zone. Silver is already about 2 lakh, and these are not the levels. So today morning, what we saw, the dip or the correction was mainly due to the appreciation in the USD-INR pair, and that's the only reason why we've seen silver marginally going down. But no fresh longs advised at these levels. Wait and watch. If somebody wants to enter into long position, I think one should wait more rather than just technically jumping into buying position because it has broken off the level of $65. So wait and watch. Let the market correct. The only valid point here right now is that there is no incremental addition to the silver primary or the secondary supply. So the only reason why silver is behaving the way it is behaving, the supply side is still not responding to the sharp upside in the prices. It will take time, and till that time, markets may remain higher, and not recommending to go short, recommending to wait for dip correction, whatever you say, and that is the time you should re-enter into long position.
Well, absolutely. You can't expect mines to react so suddenly and so quickly to the prices expected, given the fact that silver is very volatile and we could see a correction as well. So until there is some sustainability in these current prices, we perhaps will not see that happen. But Kunal, coming on also on the overall buying within Indian markets, we understand that around Dhanteras, Diwali was a lot of physical buying. Do you see that happening right now, or would you say that's pretty absent? And right now what we are seeing is perhaps some last-minute buying that we're looking at before the year ends?
I think it's more of investment demand. The actual industrial and the jewelry demand have abated a bit. At these levels, people who missed the rally, they are the one who are seen buying. It's more of a FOMO buying rather than the actual buying, which is going on right now.
Okay.
And the actual demand remains weak. So we spoke to the bullion dealers across India, and what we came to know that the actual demand from the industrial side and even from the jewelry side, both continues to remain weak.
What's your sense on prices from here, Kunal? I mean, I understand upside is difficult to talk, but how are you looking at prices, seeing some resistance? And if the correction, the much-awaited one, does come, what are the support levels?
I think 60 should be the support level, considering whatever has happened lately. And on the upside, no charts are working or no fundamental are working right now. It's just every day, whenever there is a pause of 2-3 days, and it moves up by 5-6%. So in this scenario, I would say 70 on the upside and 60 on the downside. This should be the range, and I would wait for a correction to buy rather than jumping into long position at these levels.
But buy you will.
Like most says, whenever there is a shortage, it's very difficult to predict the prices, and that is what is actually happening. Because of the shortages, it is impossible to predict the prices, how long it can go up, how far it will remain high. We need to see more supply coming in, and which should balance out this equation and lead to healthier correction. So till that take place, we have to remain on the buy side. It's very risky to go short in this market.
Okay, risky to go short in this market. That's the word coming in from Kunal Shah of Nirmal Bang Securities. So that's on the commodity or the precious metal space. But just look at the markets, because that is at the day's low at this point in time. Even the broader markets are now seeing further accelerated pressure. So the Midcap index is down around 0.4%. Remember, it's lost almost 1.5% this week already, and it's lost around 2.6% this month. Just want to point out that for the Nifty, we're now trading at around 25,786. Low point of the day, as you can see at this point in time. We'll take a short break, but up next, we'll focus on city gas companies, which are surging on the back of the unified natural gas tariff effective. So stay tuned for that news.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Welcome back to Halftime Report with CNBC TV18. As of now, Nifty has come back about 25,800 levels, just around that mark as of now. We'll keep an eye out on that one, as well as the broader end of the market that's underperforming, like we mentioned before as well. So let's keep an eye out on that. But city gas distribution companies are in focus as PNGRB has notified new unified natural gas tariff structure. What is it? What is the latest update here? Sonal is here to give us that. Sonal.
Well, just to put it outright there, this is just a notification that has come by. The structure was already announced earlier, and these details were largely known with the investor community as well. So right now in this notice, they've just said that it is effective January 2026. Just to take you through the details once again, tariff zones will be reduced from 3 to 2. So basically, there'll be 2 tariff zones to determine what you will be paying as a consumer when gas is transported from GAIL to city gas distribution companies and ultimately used in your cars and in your homes as well. CNG and domestic PNG consumers, they are the priority because they are retail consumers. They will be given priority to pay Zone 1 tariffs across India, irrespective of whatever distance they are at, up to 300 kilometers or beyond 300 kilometers as well. They will have to pay the lower tariff. What is that lower tariff? It is at 54 rupees per MMBTU, which is up to 300 kilometers. The higher tariff is at 102.86 rupees per MMBTU. If that comes into effect, CNG prices are expected to fall by 1.25 to 2.5 rupees per kg. PNG or the domestic gas prices are expected to fall by 0.9 to 1.8 rupees per SCM. And this is the reason why all these stocks are on our radar, because one, it will reduce the cost for the transportation cost for a lot of these city gas distribution companies, which will of course be passed on to consumers, which will lead to higher volumes. So it will have an impact on their EBITDA and on their profits ultimately, which will be a positive impact. The other reason why IGL specifically is higher in trade, up around 7%, that is because Nomura has upgraded the stock to a buy on attractive valuations. They have increased the target price to 230. They think margins will now get support from lower taxes and the transmission tariffs that I just spoke about as well. Lower tax on domestic gas because it has been reduced to 2% versus 15% earlier. The lower transmission costs will flow to their EBITDA going forward. And they also expect Henry Hub prices, which is their key input, to fall from here on, which will aid margins from Q1 FY27. And that's why this stock is on our radar.
Okay, all right, Sonal, thanks very much for that. So that is on all of the city gas distribution companies. But we do have some news, which is a CNBC TV18 exclusive, where sources indicate SEBI may be making minor tweaks to proposals based on stakeholder feedback. This is to deliberate on the MF expense ratio. We'll get you more details on that particular story. As of now, we need to take a short break, but we'll get you specifics on that as well as on the market. Stay tuned.
Fly Emirates, fly better.
Welcome back. Well, for the markets, it's weak. We're at around 25,786 for the Nifty. But one stock which is managing to buck the trend is Shriram Finance. Remember, they do have that board meet which is taking place on Friday, where they will be considering fundraising. And remember that there is speculation at this point in time that Japan's Mitsubishi Group could be looking at an investment of around 20% stake. So that stock managing to hold up with a gain of around 1.4%. We'll take a short break on that note, or rather we'll wrap up on Halftime Report. Business Lunch will take all the action forward. Stay tuned.
Stocks drift lower with the market breadth continuing to remain negative. Industrials, consumer durables and realty are the big drags, while metals and IT eke out some gains.
Amid a slew of big-ticket investments in India's financial sector, Shriram Finance has scheduled a board meet on December 19th to consider a fundraise. The filing follows recent reports of Mitsubishi Financial Group eyeing a stake.
Ola Electric promoter Bhavish Agrawal sells 3.9% in the EV maker for nearly 90 crore rupees to help pare down promoter debt of close to 260 crore and release the pledged shares. The move follows S&P's downgrade of Ola Cabs' parent to CCC.
Rupee recovers nearly 1% from new all-time lows of 91.08 per dollar to hit a high of 90 per dollar. Dealers say a mix of RBI selling and exporters hurrying dollar sales at higher levels helped the rupee recover. Steep fall in crude prices also helping sentiment on rupee.
Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Hormas Patakia. With me as always, Arundhati Ramanan. Arundhati, good afternoon.
Good afternoon, Harbaz. I mean, there's no place to hide on the Lal Street today, right? It's exactly how we were yesterday. We're at the low point of the day. It's red across the screen.
There's some important levels that you have to monitor, and the Nifty currently is below one such important level, and that's the 50-day moving average of 25,789. It continues to hover around those levels, so still not convincingly below it, but the bulls would be hopeful that you still manage a close above that 25,789, which is the 50 DMA level, before you head into the weekly expiry for the Sensex contracts tomorrow. The same is for the broader markets as well. The Midcap index continues to remain at the lowest point of the day. The Nifty Bank is at the lowest point of the day. The small cap index too, no different. So the advanced decline is in the negative. The broader markets are at the day's low. Banks are not lending any form of support either. Of course, there is some movement in the PSU banks, but nothing else beyond that.
Absolutely. And let's talk about those sectors, right? So markets clearly in the red, but those FMCG stocks, which are seeing some gains yesterday, are actually coming in for some profit booking. Colgate, Nestle India, ITC, all of them seeing some cuts between 1% and 2%. Private banks are also seeing big cuts, as Hormas pointed out, not lending anything to the Nifty. ICICI Bank, HDFC Bank, Kotak Mahindra Bank, all of them down around 1%. But on the flip side, we've got those PSU names, some green on the screen, doing all right. That index is actually the top sectoral gainer. SBI, PNB and Bank of India all firmly in the green, between 1% and 2% higher. And finally, those metal names also doing really well today. Zinc, Hindalco, Vedanta, all of them gaining nearly 1%.
And just before we move on, just pull up Indian Overseas Bank. That's the only outlier among the PSU banks that are otherwise doing well for themselves. At the lowest point of the day now is Indian Overseas Bank, 5.5% lower now on the stock at 34.63. The OFS for, beg your pardon, OFS for non-retail investors is open today. Will open for retail investors tomorrow. And the issue price or the floor price of the OFS, 34 rupees, is almost 16% lower than the price at which they had raised funds earlier through a QIP in March of this year, which was around 40 odd rupees. So a steep discount from the earlier fundraise, and the stock resultantly at the lowest point of the day. The big talking point yesterday was the currency. It remains one of the big talking points today as well. And the currency, contrary to yesterday's sharp down move, has seen some appreciation, and it has recovered nearly 1% from its record lows of 91.08 against the dollar to go above the mark of 91. Now, dealers are saying that a mix of RBI selling and exporters hurrying dollar sales at higher levels has helped the recovery in the currency. Now, they also say that the recovery is only partly due to the Reserve Bank of India. A steep fall in crude oil prices is also helping the sentiment on the currency.
Absolutely. And the other big story of the day is the record foreign inflow into India's financial sector. While overall foreign flows are ebbing, the financial sector has seen inflow of over $7 billion in 2025. Another big investment could be on the cards, with Shriram Finance set to mull a fundraise on the 19th of December, a development which comes after reports suggested that Japan's MUFG is set to pick up stake in the company. Gaurav joins us now with more on the story. Gaurav?
Yes. So the much speculated deal can happen on Friday, and the reason being that now Shriram Finance is going to have a meeting on 19th of December where they will consider fundraising, which also includes QIP. Now, why this is important is that we have already seen some speculation happening around MUFG being interested in buying around 20% stake in Shriram Finance, and even the latest numbers suggest that the valuation could be anywhere between $3.2 to $4 billion. Now, if we consider the higher end of this valuation talks which are going on, it will still be 10% higher than the current market price that we are seeing for Shriram Finance. Now, why this is important is that we have already seen for Shriram Finance, they have enough capital. So it is not something in the need of capital because they have their capital ratios at around 20%. But with this new capital, the cost of funds are likely to come down. Second is that given that the MUFG will be seen as a strategic buyer, it will also help Shriram Finance in credit re-rating, which will further bring the capital cost of funds down for Shriram Finance. Now, when we look at the stock performance, we have already seen in the last 6 months, the stock has given more than 27% returns. And even if we consider that, still in terms of valuation, it trades at around 2.2 times price to book of FY27 earnings versus the closest peer, which is Cholamandalam, which trades at around 4.1 times. So there is still some further headroom which is left for investors, is what it seems, at least optically. Now, why this is also important is that earlier the company had denied the facts, but during the last conversation with us, management said that there will be many discussions which are going and there will always be some interested party when we asked about some speculation on merger. So that is something that they had indicated earlier. And given that there is a meeting which is going to happen on Friday, we are hoping to see a big move in terms of news flow. And on back of that, we will definitely watch out on what happens to the stock of Shriram Finance on this Friday.
We'll keep an eye out on Shriram Finance, of course, the board meeting this Friday. Gaurav, thank you for that. Ritu is also here with us, and she will be telling us how foreign investment has picked up in India's financial sector. Ritu.
Well, 2025 is shaping up to be quite the year of foreign capital inflows into the financial sector. So far, in fact, foreign investors have pumped in about $7.5 billion in Indian banks and NBFCs. The largest ever foreign investment, of course, was by Emirates NBD, which acquired a 60% stake in RBL Bank for over $3 billion. And the story could get even bigger if that reported Shriram Finance MUFG deal that Gaurav was talking about goes through, because it's going to surpass all records at an estimated $3.2 billion or even up to $4 billion as per some reports. And that will push the total foreign capital that comes into India in banks and NBFCs this year well past $10 billion. But this year's deals are more than just numbers, because there's quite a few trend shifts we're seeing. For instance, the RBL, Emirates NBD and Samman Capital IHC investments, they mark a shift from minority stake to operational control. The secondary market transactions are also reshaping ownership. For instance, in Yes Bank, SMBC is now the largest foreign shareholder, although not categorized as a promoter. Then you have private equity and sovereign funds. They're also making long-term strategic bets with what we saw with IDFC First Bank and Federal Bank. Now, the investor mix is also quite diverse. There are global banks where you have SMBC, Emirates NBD. There are sovereign and foreign companies such as IHC and ADIA. And then you have private equity institutional funds like Blackstone and Warburg Pincus. What is also striking is the shift from minority stake only to now capital-infused growth. So unlike previous years, the deals this year have been large, they've been strategic, and often promoter changing as well. And that signals that the financial sector is maturing as a global investment destination. That, of course, is supported by RBI's changing stance on foreign ownership in banks. Now, here's a quick look at the headline deals this year. The largest one, of course, RBL Bank and Emirates NBD for 26,850 crores. Yes Bank, SMBC, another 16,330 crores. Samman Capital IHC, 8,850 crores. Warburg, ADIA, with IDFC First Bank, another 7,500 crores. Federal Bank, Blackstone, about 6,169 crores. And the stock price movement for these, companies is also up anywhere between 8 and 35% in just the last 6 months. The likes of RBL, of course, seeing the highest gains. Altogether, we're talking about 65,700 crores in foreign money flowing into Indian banks and NBFCs this year, without even counting the Shriram deal. And we've not seen the last of it just yet, Hormaz.
Absolutely, Ritu. Thank you so much for taking us through those details. But from the banking space to the auto sector, Tata Sierra, the latest launch from the Tata stable, has received a bumper response from buyers with over 70,000 bookings received since bookings opened yesterday. Parikshit Luthra is here with all of those details. Parikshit?
Clearly, Tata Motors is hoping that the Sierra SUV will create excitement in the market and boost their sales in 2026 and FY27 as well. Currently, their monthly run rate or sales stand at about 60,000 units. And industry sources say the Sierra SUV with petrol and diesel options could increase their sales anywhere in the range of 8,000 to 10,000 units as well. And this, according to sources, is also the production plan of the company. Having said that, the bookings began yesterday and 70,000 bookings have come by so far. Most of the bookings, we are told, are for the mid to top variant. The price range for the Sierra SUV is between 11.5 lakhs for the starting variant ex-showroom, and it goes all the way up to 22 lakhs ex-showroom for the top variant. Let's see what kind of excitement it creates in the market, in the SUV market in the months to come. But there will also be an electric variant of the Sierra that will be launched by Tata Motors in H1 of FY27. The deliveries of the petrol and diesel models, we're told, will begin sometime in the middle of January next year.
Parikshit, thank you for that update there. Now, sources are telling CNBC-TV18 that the SEBI will be deliberating mutual fund expense ratios today. Yash is joining in with more on this. Yash.
Hormaz, so of course today is that all-important SEBI's board meeting, and what we've been given to understand is that the market regulator SEBI will be taking up the proposal of mutual fund total expense ratio in today's board meeting itself. What we've been given to understand is that market regulator SEBI is likely to take up the revision in the mutual fund expense ratio as it was proposed in the consultation paper itself. Also, market regulator SEBI is expected to discuss the feedback which came from the stakeholders on the consultation paper around mutual fund TER as it was received by the market regulator SEBI. Also, as far as the original consultation paper is concerned and the feedback which was received from stakeholders, we are given to understand that if at all any changes are presented to the consultation paper, they would be very minor in nature. Just to put some context in terms of what was proposed in the consultation paper, SEBI had proposed reducing mutual fund expenses across tiers, across categories of funds. For the first 500 crore of AUM, it was proposed that TER should be reduced to 2.1% from 2.25%. Next 250 crore, it was proposed to be reduced to 1.9% from 2%. Next 1250 crore, it was proposed to be reduced to 1.6% from 1.75%, and so on and so forth. About 15 basis points reduction was proposed in almost every category in terms of size as far as the mutual fund AUM itself is concerned. Market regulator SEBI had also proposed to revise the cap on brokerage for cash market transactions to 2 basis points from about 12 basis points, and for derivative market transactions to 1 basis point from 5 basis points.
All right, Yash, many thanks for those details. But on that note, it is time for us to head into a short break. More news and updates on the other side. Stay tuned.
You want to talk business? Meet me in the on-board lounge.
Welcome back. You're still with us on Business Lunch. Indigo is in focus today as the Parliamentary Standing Committee on Transport, Tourism and Culture is scheduled to meet today. The committee will quiz Indigo and DGCA officials and examine the massive operational crisis. And staying on with Indigo, the airline has overtaken Air India Group in international passenger traffic in July-September. Shivani Bazars joins us now with all of these details. Shivani?
But yes, Indigo has overtaken the Air India Group to become India's largest airline on international routes by passenger numbers. Now, according to DGCA data, Indigo carried 41.4 lakh international passengers in the July to September quarter, narrowly ahead of the Air India Group, which carried 41 lakh passengers in the same time. This marks a clear turnaround from the earlier this year numbers when Air India was still firmly in the lead. In the January to March quarter, DGCA says Air India Group flew 45.5 lakh passengers compared to Indigo's 39.3 lakh. That gap has narrowed in April to June and then, of course, further narrowed, and Indigo has taken over and moved ahead in the September quarter. Now, this shift comes in the aftermath of the June 12th crash of Air India's flight AI-171, a Dreamliner accident that killed 260 people in Ahmedabad. In the weeks following that crash, Air India cut international capacity by around 15%, particularly on long-haul routes, as it undertook safety reviews and saw a brief dip in passenger confidence as well. Indigo, meanwhile, maintained capacity and frequencies on high international routes, allowing it to capture a larger share of the outbound and inbound traffic. And despite the change in passenger volumes, the Air India Group still operates a wider international network, flying to around 48 overseas destinations compared to Indigo's 44 international destinations. Back to you.
Shivani, thank you for that update there. Meanwhile, the fog across the National Capital Region continues to disrupt flight services at the Delhi airport. At least 10 flights have been cancelled in Delhi this morning. We'll take a short break. More news and updates on the other side.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Welcome back. Now, we have been talking about the bull run in gold prices all through the year, but what's also having a very golden run is silver. The prices hit a record high yet again today, crossing the $66 an ounce mark. Manisha is here to tell us more on that. Manisha.
Well, silver is on a tear where we have seen all-time highs yet again coming into the market today. We've broken 65 and we've also breached 66 on the higher side now. And with that, we are up by nearly 30% in the last 1 month for silver. And when you talk about 2025, it's a 127% of a gain. The gains have come in on the back of one, shortage of silver, a deficit that could continue for a 6th straight year in 2026. It also has been about the dislocation of silver, where it's not freely moving between countries. And then the third thing is about speculative money, a lot of investment, physical buying, ETF buying. Silver has had it all in this year. Silver also is taking support from the fact that the dollar index is now trading at a multi-month lows, leading to buying into more tangible commodities. It has been about safe haven buying, the geopolitics, the kind of debt that the Western world seems to be holding on. That has led to a lot of buying come in for the precious metal prices. Well, from here on, the brokers and the banks tell us that on the higher side, $70 an ounce is a possibility within this year as well. I mean, we are just $3 to $4 away from that. But a long due correction now really seems to be in the coming. No fresh longs should be taken here. Shorts absolutely should not be created because the way the silver is reacting right now. But $60 an ounce seems to be a support right now. For the Indian markets, we are holding well above 2 lakh rupees a kg right now, but the Indians are not buying. So silver in the Indian market is trading at a discount right now, vis-a-vis those premiums that we saw in the month of October. So the buying seems to have slowed down, so has been the case with the volumes as well. But the price moves are quite exaggerated. It's going to be important to see on what Bank of Japan, Bank of England and ECB do in this month to understand on how silver will react before we call curtains to this year.
Right, Manisha, many thanks for those details. But with that, it is a wrap on this edition of Business Lunch. From Hormaz and me, goodbye and many thanks for watching.
Good afternoon. Welcome to Midcap Radar live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me today is Ekta Batra. Continues to be a down day. We have been able to manage to stay at that 25,800 mark, but it's been a day where we've seen levels lower than that as well. Mid-caps are underperforming and a lot of pressure coming in from big names like the banking names and Reliance as well.
Hi, Sonal. Yes, absolutely. As of now, we can see the mid-caps also under pressure, so down around 0.4% at this point in time, with the advanced decline ratio, which is extremely dismal and has been through the trading session. But like you mentioned, the financials are holding up, but we have autos as well as a couple of these insurance stocks, which are under pressure at this point in time. Let's take you through the top stories that we're tracking. Stocks drift lower with the market breadth remaining negative. Industrials, consumer durables and realty are the big drags, while PSU banks eke out gains. Mid-caps underperform.
Meesho is locked in upper circuit after Brokerage UBS initiates coverage with a buy rating. The stock is now up around 95% from its IPO price.
Indraprastha Gas gains in trade after Nomura upgraded the city gas distributor to buy. The brokerage house believes lower tax and transmission tariffs will support margins.
India's largest dialysis service provider, Nephro Plus, makes a flattish debut, listing with gains of about 6%. The management tells CNBC-TV18 that they expect to maintain 25 to 30% CAGR growth momentum and see a huge headroom for growth. All right, those are the top headlines. We'll discuss some important corporate conversations as well on the show. But for now, if we take a look at the markets, at the mid-caps, which are seeing a lot of pressure, the small-cap index too is lower in trade, though we have seen some recovery, but that was quickly sold into as well. The advanced decline ratio absolutely in favor of declines and some pressure coming by for Bank Nifty as well. But the PSU banking index, that is bucking the trend today.
Yes, absolutely. The PSU banks are doing well, and the other space which is doing well is anything which is silver related. So Hindustan Zinc, like we've been mentioning, has been doing well in today's trading session because silver prices are at a record high. But separately, we also have Tata Silver ETF, which is up around 4% We have Nippon India Silver ETF, which is up around 3.7% as well. So both of those are in focus in today's trading session. And like Sonal mentioned, a couple of these PSU banks, say something like Canara Bank, is showing traction on the upside. And just watch out for a couple of stocks such as Wockhardt, which is managing to hold up as well. But let's get to our segment, Mid-Cap Movers, where we take you through all of the mid-caps that are moving around in trade this afternoon. Hormuz joins in to tell us more.
Well, again, it's not a very good-looking screen for the broader markets, at least in today's session. So we'll start off with some of the losers first up. And Gallant Ispat is one such name. It's the top loser among the small-cap names today. 14% lower on the stock, continuing to extend losses. Shakti Pumps, after a breakneck rally over the last 3 to 4 trading sessions, is seeing some profit booking, as is Refex. Refex has had a very volatile last 3 to 4 days, 9% lower here as well. And Polycab has been at the lowest point of the day, is broken below its 100-day moving average as well. No specific news trigger for that move. Still 3.5% lower on the stock today. Some of the others that are not doing well today are the real estate names, and Sobha, Anantraj, DLF, all of them and almost all of the constituents on the realty index are trading with losses today. The newsmakers is a very interesting list here, and AkzoNobel, of course, after the block deal at one point was down 15%, so some recovery from the low, still 13% lower. Indian Overseas Bank with the OFS being launched, Saregama, the street not liking the acquisition announcement that it made last evening, so 6% lower here as well. And IGL bucking the trend, and the city gas players doing well for themselves, as 5.5% higher on this stock as well. Stocks that are doing well on the volumes front, Meesho, of course, very strong volumes in that 20% upper circuit. Aditya Birla Fashion doing well for itself, and Ola Electric, another low for the stock today, another 2% gone after yesterday's 8% fall. And lastly, stocks at 52-week lows. Tejas Networks has had a very forgettable year, and today is turning out to be no different. Another low for the stock. Cohance and Oriental Hotels too are some stocks that are at a 52-week low today.
Okay, all right. Thank you so much for joining us with that list, Hormuz. It's a good time to get in Ajit Mishra, the SVP Research from Religare Broking, for a technical check on the markets. Ajit, good afternoon. What next for the Nifty? We do see some recovery, but that gets quickly sold into, and we've been around the 25,800 mark for a while. What is the next important level to watch out?
Good afternoon, Sonal. Good afternoon, Ekta. So, Sonal, the challenge is that it's been almost 3 weeks now that Nifty has been hovering around this area, means 26,000 we make attempt. In fact, the 20 EMA mark is something where we are seeing actual tussle going on, which is currently around 25,950 zone. So till last week, things were positive. This week around, due to the weakness in Rupee, we are seeing that markets are drifting lower. Now, 25,700, the recent swing low, that's going to be the critical area to watch out for. Because in case if we fail to hold this level, then market would confirm lower highs, lower low structure, which can further push the index towards 25,500, 450 area, which is the 100 days of exponential moving average. So as of now, 25,700 is going to be the make or break area for the Nifty index.
Okay, all right. So yes, hovering around these levels in the past 3 odd weeks. But Ajit, what would the stock recommendations be? Because there are certain stocks which are managing to hold up. There is some amount of traction in specific counters.
Yes, interestingly, Ekta, means if you see that the broader market is not reflecting the overall trend, means mid cap, small cap, they are beaten down very badly. But within the large cap and larger mid cap space, you still find counters which are holding strong. IT is one pack wherein we are seeing sustenance, means Infosys after almost 4-5 days of consolidation, where we see the potential of further recovery. So 1650 is what we are eyeing. With the stop at 1580, one can go long Infosys even at current levels. On the other hand, private banking space, wherein we were seeing that ICICI was underperforming. Today, we have seen a fresh break below the long-term averages. So this may result in further decline in days to come. So 1310 is something that ICICI may test in the near future. So with stop at 1370, one can go short in ICICI.
Okay, all right. Thank you so much, Ajit, for joining in with those technical picks and the market levels. For now, we'll slip into a break. When we come back, we'll connect with Aditya Virwani of Embassy Group as the NCLAT has hauled the bankruptcy process, which was initiated by NCLT. We'll discuss that and a lot more. Stay tuned.
Fly Emirates, fly better.
Welcome back. Well, the National Company Law Tribunal has admitted Canara Bank's plea to initiate insolvency proceedings against Embassy Developments as the company is liable as a corporate guarantor for loans issued to Sinnar Thermal Power. This particular order has been stayed by the NCLAT in their recent order. To understand more what the outlook is and what are the legal repercussions of this move, Aditya Virwani, who is the Managing Director at Embassy Group and Embassy Developments, is joining us now. Aditya, good afternoon. Thank you so much for joining in. Well, the stock is sharply lower despite the clarification that you have issued to the exchanges that NCLAT has stayed the order. If you can give us some clarity, how long is this stay for? How long does usually these stay orders stay for? And what is the next legal step that Embassy Developments can take? Because the investors definitely need some clarity because there is a financial exposure here, right, in terms of the guarantee that you have provided.
Yeah, thank you for having me on. But let me put in perspective where we are with this. So on 11th of December, we were admitted in NCLT. The same day at 2 p.m., we got our stay. And this is a matter that pertains 15 years ago with an entity that has no relation with Embassy Developments, nor does it have any relationship with any Embassy Group entity. It is relating to a company called Ratan India and a subsidiary called Sinnar Thermal that had a NCLT proceeding that actually got concluded on the 28th of November. And all of its creditors, including Canara Bank, were part of that. We actually were not even a corporate guarantor. And this is the entity, MC Developments, erstwhile India Bulls, was not even a corporate guarantor. We had committed that we would fulfill an equity contribution, which anyways got fulfilled by the primary obligator, which was Ratan India. So it is a very strange order. We feel it's also strange that Ratan India, the primary obligator, was not even part of the NCLT order. But we are happy to get a stay. Our next hearing is on the 22nd of Jan, and we feel quite confident that if we're able to explain the technical details of this, the NCLAT will definitely understand.
So Aditya, just to clarify, what exactly is the relationship that Embassy has with Sinnar Thermal? None.
Actually, there's no relationship. We're not a related party, and we have nothing to do with Sinnar Thermal. That is the entity that has gone default, and the insolvency is against them. We were simply just a equity backstop committer. And we were the second backstop after the first, which was the promoters of Sinnar, which was Ratan India. In fact, they have actually fulfilled their entire equity contribution. So this is the situation.
Okay, so you're not guarantors as well for the loan that they had. Just trying to understand. They went into NPA in 2017. This issue, as you said, dates back to 17 years. Have you asked for any clarification from the NCLT or NCLT as to why your name at all was dragged into this matter? And have you had a word with the exchanges as well? Because on the back of this, you were put into ASM.
Yes. So a few things there. One is also the invocation of this bankruptcy happened during a COVID monitoring period, which is actually barred as per Section 10A. So very strange that that also happened during that period. But yes, we have been engaging with the stock exchanges, with both NSE and BSE, trying to clarify this point. It seems like it's a technical glitch. When an entity goes into NCLT, gets admitted, they have to live by what their protocols are. We have gone back to them and we're engaging with them, and we think that they'll understand the matter and we should be able to resolve the stock exchange situation.
Okay, so maybe Jan 22nd is when you'd probably get more clarity. That's when the next hearing is.
Yes, that's when the next hearing is. And, I'd like to say that the company is in a great place today. Q3 is going to be a really bumper quarter for us. We can expect roughly 1,500 crores of pre-sales, which would be double of what we've done for the first half of this year. We're also committing to stay on track to our 5,000 crores of guidance, which would be double of what this company has done from last year. So actually, we feel pretty confident about where the business is. The liability is a 370 crore liability. Right now the net worth of this company is 10,000 crores. Our debt is 3,500. So we're at a very comfortable debt equity ratio of 0.35. We feel that in the worst case that we need to fulfill this liability, the company is in a great financial position to do it. But we do feel our merits are very strong. We feel good about 22nd Jan, and we're hopeful that NCLAT will understand our situation and this will be behind us.
Aditya, do you think this could be in any way related to erstwhile embassy developments, that's India Bulls Real Estate or Equinox, and that is now coming on to you? I'm just trying to understand, because investors also want to understand, will this liability come on embassy at all? If you had any relation before the restructuring in form of a guarantor.
Oh, absolutely. So this is regarding Embassy Developments Limited, which was erstwhile India Bulls Real Estate. So in 2010, India Bulls Real Estate was a guarantor to an equity backfill, like I mentioned, to this loan, a second guarantor after the first, which was the promoter entity. Now, two things important. The promoter entity has actually already fulfilled his equity contribution to this of roughly 3,000 crores. So actually our equity backfill should have dropped off back then. Now, the second thing is the first guarantor has not even been admitted in the NCLT, which we are very surprised about that matter. Nevertheless, we will have to address this with NCLAT in our judiciary system, and we will explain this fully and well. And we feel that, for the various different reasons I explained, the company is in a pretty good place. Even in the worst case scenario, we feel we're very good. A 370 crore liability is not the end of the world for this company. There are bright days ahead for this company.
Okay. All right, Aditya. Well, hopefully there should be more clarity in terms of your communication to the exchanges as well as on Jan 22nd. Thanks very much for joining in and speaking with us. So that is Embassy Developments clarifying that they do not have any relation with the company mentioned, which is basically Sinar Thermal at this point in time. And they will be clarifying to the stock exchanges. They're sticking to their 5,000 crore guidance as well going forward and seem to be quite bullish in terms of the second half in terms of sales. We'll take a short break, but up next we'll get you more stocks in focus. Stay tuned.
You want to talk business? Meet me in the on-board lounge.
Welcome back. Well, for the markets, it's weak. So we have the Midcap index, which is at the low point of the day, down around 0.5% at this point in time. The advanced decline also trending a bit lower. I just want to point out that in terms of specific stocks, we have a couple of gainers which do stand out from the broader market. So say something like a Dilip Bilkol is showing some amount of traction. That stock is up around 5%. IGL is doing well. But Patel Engineering is also showing some amount of traction. So that stock is up around 4.6%, along with Thangamayal and TD Power Systems. So all of these stocks are showing good amount of traction in terms of the volumes as well as the price action. On the downside, just watch out for, say, stocks such as IOB. We have Saregama, which is in focus, Akzo Nobel, which is also showing some amount of weakness. Maybe that stock should come up for you. So Saregama as well as Akzo Nobel, all of these stocks showing pressure. Shakti Pumps, which had a good run last week, is also coming in for some selling. We need to wrap up on the show, but stay tuned. You have your stocks coming up next.
Hello, good afternoon. You've tuned into your stocks coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much, as always, for tuning in. Day for the markets, it's been a muted day so far. Nothing exciting that's happening here because we are still around the 25,800 levels. We're not managing to sustain to 25,800, right? Every time we touch it, then we again fall back to that level. So that's something that we'll be watching out for in today's trading session. We surely did open up in the red and then a green, and then we moved on to the red side. Again, we are almost near the day's lowest point, even as of now, 25,797, down 63 points in today's trading session. Broader end of the market, that's not doing well as well, when you look at it, 0.7% of decline that's coming in from the Nifty Midcap. Small cap also is trading with cuts of almost 0.6 to 0.7%. So that's what we'll be keeping an eye out on. Markets again are at the day's lowest point, and advance decline ratio today clearly in the favor of declines versus advances. So that's what we're seeing. Maybe a third day of decline that we could see for the Nifty. We'll wait out for that in the next 1.5 hours of where the market goes. But this is a show where we solve all your stock related queries, and that's what we'll be doing. We're joined by experts for today. We have Saumil Mehta, who's the head of alternate research capital market strategy at Mirae Asset Sharekhan, as well as Astha Jain, research analyst at Hem Securities. Saumil as well as Astha, good afternoon, and thank you so much for joining us, as always, to answer all the stock related queries. Let's get started with the first query for today. We have Shashank Jain, who's writing to us from New Delhi. He's holding 100 shares of Trent. This is at a price of 4,500 rupees per share. He wants to know the long-term outlook of the stock. Astha, good afternoon, and what's your outlook for Trent? This stock, gave fabulous returns in the last few years, but in 2025, it saw that correction coming in, right? So now they've bought it at 4,500 levels. Stock is currently at 4,000. What should they do for the long term here?
So view for the long term is positive because if we listen to the management now, they are very much optimistic and they have launched certain, youth focused brands, etc. So now the initiatives they are taking along with the digital management, which they are doing, I think the stock have a potential to move from here. And 4,500 is our target for this counter. So here the horizon should be long term because in the short term, we might not see such a great moves, but in the medium term, I think 4,500 can be set as a target. So hold is a strategy from our side for this counter.
Hold as a strategy. That's the view coming in from Astha. 4,500 in the medium term is what she's expecting for Trent. So, Amen, on the charts, what's the indication coming in for Trent? They bought it at 4,500. Should they even look to add more? If yes, at what levels can one look to do that?
The view still remains negative. It's a low top, low bottom formation on all time frames. So the view definitely is negative. From here, if I see in 2023 when the rally started for the next 2 years, it went from 1,200 to on the higher side 8,200. So that was a very, very good rally. Now the entire rally has retraced by 61% exact around 3,890 odd levels. So that is a very, very crucial level for, I think, around these levels, I'll be expecting a basing out pattern for a trend. And once that happens, we need to revisit and then, take a long call on this. But from here, I would not suggest to exit or go short because these are very crucial levels for the stock. And I think here a basing out pattern would form.
Okay, so keep an eye out on those important levels over there for Trent that Saumil has mentioned. Let's move on then to the next query for today. We have Raman Srivastava, who's writing to us from Mumbai. He's holding 150 shares of Shakti Pumps. Price is 700 rupees per share. Currently, the stock is at 716. He's asking we should hold the shares for a period of 1 year from now. Your view on this one, Astha?
Yes, definitely a hold is recommended for this counter with a price target of 820, 830. Now talking about their numbers, the numbers they have shown were strong despite the fact that there were certain macroeconomic conditions. This company has faced, inflation in the raw material prices and due to monsoon also, the things were delayed, but still they were able to post very, very strong set of a number. And in fact, what is major, focus of this company is their rooftop solar business, because now this business has started gaining some traction according to the management. So it can be one of the strong growth driver going ahead. So my idea here is to stay invested in this counter with a price target of 820 to 830.
Okay, we'll keep an eye out on those levels over there. Saumil, your view for Shakti Pumps?
Positive in the long term is very similar to a trend actually. Started in 2022, the rally started in 22 from 70 rupees to 1300 levels on the higher side. And now the lows were around 560, 570. And that's a 61% retracement of the entire rally, which is a great level to, have as a bottom. Now, the basing out pattern is been forming right now in the on the daily charts, and we've seen good momentum as well. I think once it is above 820 to 23, it will break out for all medium to long term levels. Here, my suggestion would be to hold on. My targets would be above 1000, 1100 in the medium to long term.
Okay, we'll keep an eye out on that. Let's also see Sammaan Capital. We have some flashes at the bottom of the screen for you all right now. This was that probe that was happening into the Sammaan Capital's erstwhile promoters. The Delhi police has registered a fresh FIR by the EOB wing. The Supreme Court has directed CBI to take the final call on registering an FIR in this case within 1 week from now, and the Supreme Court has directed the CBI to collect documents from the from the MCA, SEBI, ED, so the registration of the FIR can be considered. And so the Supreme Court now will take up the case in the second week of Jan 2026. That's the latest update that we have coming in on Sammaan Capital, that the probe that was going on the erstwhile promoters. But let's move on then to the next query for today. We have Navneet Singh, who's writing to us from Ahmedabad. This is an investment query. He's asking if he can buy JSW Energy at the current levels, around 475. Your view on this one, Astha?
So JSW Energy is looking very, very strong. Yes, and that's why we have seen a strong momentum also in last few days about this counter. So talking about the space, we are positive on the space, but the main question is whether to buy it at this point of a time or not. So here, what I believe that these are not the good levels to enter into this counter in the light of the fact that this counter has seen a strong rise. So now I think some dips can be awaited for this counter to make any sort of fresh entry into this counter. Now, if I talk about the fundamentals, fundamentals seems to be okay. Whatever numbers they have presented in the Q2 were decent. In fact, the company is on the track to meet its capacity expansion targets. So that seems to be all right. So we believe that this counter is well poised to move more upside from here. But buying at the current level is not advisable. Maybe at the level of 450 or 455, one can enter into this counter. However, price targets which we are giving for this counter is somewhere at around 520 to 530 at the initial levels.
Okay, we'll keep an eye on the levels over there. And Saumil, your view, JSW Energy, when could they look to buy this one? Current levels is a good time?
Negative on the stock. Actually, it's been trading below 200 daily moving average since end of 2024, and it's been struggling. Negative on the stock till the levels of 400, 420. So that will be a very crucial level to watch out for. I think that will be a right time to enter this stock. Revisit the stock. I'll be expecting a basing out pattern around those levels. So 400, 420 would be the right level to enter the stock.
Okay, 400, 420 would be the level to enter the stock. That's the word coming in from Saumil. Let's move on to the next query for today. We have Aniket Parekh, who's writing to us from Ahmedabad. He's holding 107 shares of Power Finance Corp, PFC. That's at a price of 405 rupees per share. Wants to know the long-term story for the stock. He can continue to hold this, but should he look to add more at these levels as well? Asta, your view for PFC?
PFC is looking good to us in the long term only, not in the short term. And in the long term, we are giving the price target of more than 400 at the current levels. Now, talking about the fundamentals of this counter, what we have seen that there was a muted loan growth, and there were reasons behind it because some of the elevated repayments which this company has to do, and that is why we have seen that the loan growth was not that much positive. But going ahead, we believe, although their loan book was up, it was up around 2% Q on Q, if I am right with my numbers. So it was up around 2% Q on Q. So going ahead, while we believe that there were reasons behind this low growth in their book, but going ahead, we believe that definitely the company will be able to show better numbers. And on that basis, we are positive on this counter in the long term. Recommend a hold on this counter with a price target of more than 420 to 430 at the current levels.
Okay, and Saumil, your view coming in for PFC, they bought it at 405. Long-term investor, they want to also know if they can add more. At what levels, if yes?
I think I would not suggest averaging because of the losing counter. The trend still remains negative. Monthly, weekly charts, all low top, low bottom formation. The next level to watch out for as support is around 300, 310, and I'll be expecting this stock to keep correcting till at least 300 levels, and then probably over around those levels we can revisit the stock and then enter the stock. But at this point of time, view is negative, and exit would be my strategy actually on this one.
Okay, view is negative. Exit would be something that Saumil would look at. Forget adding right now. But on that note, we're going to slip into a very short break. And after the break, we'll still be continuing with the stock-related queries. Stay tuned in.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Welcome back to your stocks on CNBC-TV18. Let's keep it going with the stock-related queries. The next query for today has come from Prashant, who's writing to us from Bangalore. He's holding 70 shares of Sterling and Wilson. Price is 716 rupees per share. And he's also holding 50 shares of Tejas Networks at a price of 1,290 rupees per share, making significant losses on this one. What should he be doing with this now, Astha?
Talking about Sterling and Wilson, there were issues with the gross margin because in H1 of FY26, what we have seen, the gross margins were only 10%, and that was lower as compared to the corresponding quarter. But I think, and there were the reasons behind it because some of, the commencement of some revenue recognition in the high value Turkey domestic orders have, create such kind of pressure in the margin. And in fact, the revenue recognition was also not very much strong, or the revenue growth was not very much strong. Being one of the leading, solar EPC company, they have got a very strong customer base. Their global presence is very strong. So, but company is not able to show it in their financial performance. My idea here is to exit partially from this counter because we are not, assuming that in fact going ahead also in the coming 1 or 2 quarters, the company will be able to show a strong financial performance. So exiting partially is what we can recommend in the Sterling and Wilson. Now talking about Tejas Network also, in fact, unfortunately, both these counters are not looking very, very strong at this moment of a time. In fact, Tejas Network also, what we believe that although this company has a vision to become, global tier, top tier company in the telecom space, networking space, but the kind of performances they are showing, it is not matching to those expectations as of now. So both these counters are not looking that much strong. I recommend exiting partially from both of these counters.
Okay, exiting partially from both of these counters. Somil, your view, Sterling and Wilson as well as Tejas Networks.
Very similar view, negative on both the stocks actually. Sterling and Wilson has been falling for a little while. It has just broken a quarterly low, which is a very negative sign for the stock. I think the stock next level on the downside would be around 180, 170 levels. So negative on the stock. My suggestion would be to exit the stock definitely. Tejas Networks. Tejas Network, very similar, low top, low bottom formation on all the time frames. It has just broken a very crucial level of 510, which was a previous swing low. Now the next level on the downside is 370. So I'll be expecting the stock to go till 370. So my suggestion would be to exit, and view would be negative on both the stocks.
Okay, negative on both the stocks over there, even on the technical front. Let's move on to the next query. Korean is writing to us from Kochi, holding 1,730 shares of Embassy Office Parks REIT. Price is 284 rupees per share. Wants to know the 3-year view for this one. Should they continue to hold? And should they add more, or should they just book out profits right now? Astha, your view.
So now the time horizon matters, and this is 3-year perspective, which the investor is talking right now. So definitely from 3-year perspective, one can add more, but not at the current level. I would recommend to add more at the lower levels. Right now, it is quoting somewhere at around 430 odd levels. So maybe at around 400 or 380 odd levels, we believe that those were the levels where the one can add more. Now, if I talk about the fundamentals of this company, fundamentals is looking very strong because what we are seeing that they will continue to strong, very, very strong, healthy distribution levels, because there is, improvement in some leasing traction also, which this company is facing. We believe the kind of financial performance, in fact, they have recorded, that was also very good. 13% growth in the revenue year-on-year basis is a decent jump, which they have seen in their financial. So I believe on the basis of all these factors, this is a good long-term story to bet upon, provided the entry should not be made at the current level. We expect this counter to fall more. So maybe at the lower level, one can enter into this counter.
Okay. That's the view coming in there for Embassy on the fundamentals. On the technicals, what's your view, Somit, Embassy?
Negative on the stock as well. I think from here on these levels, there are very crucial resistance around 450, 460 levels. So I'm not expecting the stock to go above those levels. Now on the downside, the levels would be around 414 and 376. So ending diagonal pattern has been forming, and it is at the very upper end of the pattern. So I'll be a little negative here, and I'll suggest to book partial profits here.
Okay, surely that's a view coming in there. Let's move on to the next query. We have Sivaraman, who's writing to us from New Delhi, holding 1,475 shares of NLC India. Price is 280 rupees per share. What should he do with this? Continue to hold or sell and book out their losses? Asta, your view.
So definitely a hold on this counter, not a sell at this point of a time and booking losses. And we are recommending a hold on this counter with a price target of somewhere at around 280 to 300. And these are the targets which we are giving from the long-term perspective, not from the short-term perspective. So what I believe that this counter is looking good because the expansion which they are making and which they were announcing are broadly on track. So that is one of the point which we are finding positive about this company. And in fact, the kind of expansion they are doing along with the, some sort of recoveries in their financial performance, which we are expecting on the basis of these expansion will definitely yield strong numbers going ahead. So overall, a hold from my side for this counter.
Okay. And your view on NLC, Somil?
My view would be hold as well. They're very crucial levels around 220 to 25 levels. So I'm not expecting the stock to go below that. Short term, yes, a little bit of selling pressure, but I think 200, 225 level should be a very crucial level. Now on the upside, I'll be expecting the broad range, which has been there for a little while now, to break on the upside. So the targets right now in the medium term outlook would be 270, 280 levels.
Okay, surely we'll keep an eye out on those levels over there for NLC India. Thank you so much, Somil, as well as Asta today for joining us on the show. That was the last query for today. And viewers, thank you so much for sending us those queries as well. Do not forget, you can keep sending us your queries. We have an email ID as well as a phone number as well now. So you can send us your queries on that number that will be on the screens for you shortly. You can either SMS us, send us your queries in terms of WhatsApp. And if you do want a caller query as well, do let us know. We'll do that. But a quick check in terms of the markets before we wind down. 25,800. That's where the Nifty holds on to. About that mark picked up a bit of a pace in the last half an hour that we're seeing from the day's lowest point. It tried going up. Whether it sustains, that's what we'll be keeping an eye out on as well. Broader end of the market too is bit of a decline there, but yes, a sort of a mild uptick is what we're seeing as well. But with that, we will wind down this edition of Your Stocks. Thank you so much for tuning in. Up next, you have the last hour of trade that is still left, and for that, you have Closing Bell to take you through that.
to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Hang Seng, that's holding on to gains. A very slight bit of a positive bias, 0.09%.
It is empowered for a very good thing. That is disgorging wrongful gains.
26,028 as of yesterday's close on the Nifty and 59,299 on the Nifty Bank as well. Nifty is starting unchanged, almost unchanged, 25,870. The Nifty Bank is blinking red and green, 58,973.
Nifty, for example, around 50% of the companies have a positive correlation to the rupee depreciation.
For Nifty companies as well, FY26 consensus has already cut their earnings by 11 percentage points.
Now down about 128 points on the Sensex, 43 points on the Nifty as we speak.
The average order value has declined, and that's by design because the company has been passing on efficiencies to the customers.
Given that MUFG, if it enters in Shriram Finance, this will also make a case and headroom for further credit re-rating.
Continues to be a down day. We have been able to manage to stay at that 25,800 mark.
So far, markets, of course, treading water, not really here or there, down, of course, about a 0.25% lower. So the rupee, the dollar rupee, of course, got showed up a little bit in the morning, and that did show up for a brief bit on the equity indices as well. But I mean, it's not stayed. The impact has been just fleeting in that sense. So 65 points lower, 25,793. There is no additional kind of news or anything of that sort. Which is like the dominating driver, is just a continuation of what we've had here in markets for the last few sessions now, which is a bit of a drift. I just want to quickly put up Samman Capital. The case was in the Supreme Court today, and we'll have Ashmit, our colleague, join in just a bit. I think the Samman stock is, the last I checked, was down a little bit, 2.5%. And I think it's taken a bit of a small dive after some of those details I saw flashing came through. But more context, I think that's important with, as I said, Ashmit coming up in just a bit. This is Closing Bell. We are coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. Reema and Surabhi here in the studios, and Nigel is joining us from the newsroom floor. Guys, afternoon.
Hi, afternoon. We've had quite the high flyers, right, today. I think Meesho is right on top, where the market capitalization is now approaching 1 lakh crore. 97,600, I think, at last count on Meesho. So after a blockbuster listing, the stock continues to see gains. Shriram Finance has been active since morning, but on the way down, you've got softness coming through in Axo Nobel. That's a double-digit down take. And then Shakti Pumps has been all over the place, mostly up over the last couple of days, but today some profit booking. But I think the word to describe, as Prashant said, markets are just drifting today, but mostly in the red, so drifting down.
Absolutely, and I think Meesho just takes the cake. I mean, it's breathtaking. I've completely run out of words and adjectives to describe what has happened. Today was the UBS call, and UBS called for a target of around 220. And the stock's already getting there in one day. You're discounting, I don't know how many quarters and how many months ahead. It's that kind of a market, but absolutely stupendous. By the way, the breadth of the market is negative. There's no denying that or taking away from that. The Midcap index is down 0.6%. So for all the Meeshos of the world out there, something like IOB, where there is an OFS from the government, diluting a bit of its equity, 5% lower over there. Axo Nobel, which saw a large block trade, is down about 12-13% as well. So these are some of the parts of the market where it's still a little tentative, to say the least. Some newsmakers today, IGL on the upside, continues to hold on to a lot of those gains because this one nation, one transmission tariff for gas, that's a reality. And there are some positive brokerage comments on IGL. Some of the brokers think the recent fall was excessive. The concern around the Henry Hub prices going up, that was a bit excessive. So the stock is pulling back. There's Hindustan Zinc and names like Swiggy, which are undoing some of the damage. So mixed trends, but overall, I guess, still directionless at the headline level.
Absolutely. And I think we'll talk about some of these names which will be mentioned as we go along. But let me quickly tease out what's coming up here over the next 60 minutes or so. So it's, global cues, not very much to write home about, slightly weakish. Rupee, of course, showing a bit of a rebound, 0.75% higher, 1% earlier, so it's given back some of those gains. PSU banks, IT stocks are holding out against the selling, but broader markets, of course, are seeing some cuts. Asset management companies in focus. Sources tell CNBC-TV18 that the SEBI's board meet today evening will consider those sort of draft rules with regards to mutual fund expense ratios, etc. And Yash says that, well, the push is going to be to kind of sort of stick with what was proposed. Shares of Meesho, as we just pointed out, continue to surge, and UBS, of course, coming out with a call, and will 220 rupee price targets already there. Actually, Shriram Finance is the other one to look forward to. Friday board meeting, and we'll have that fundraise announcement, perhaps the market's expecting. So 860 on that one coming through. So. Enough and more single stock action, which is out there. How should you position yourself? That's a question. Rahul Sharma, Director and Head of Technical and Derivatives at JM Financial Services, is with us. Rahul, good afternoon. Good to have you here. Is there a trade? Indices first.
Yeah, so it's definitely a ground for both the Nifty and the Bank Nifty. However, we are approaching a crucial support area of the 50-day moving average, which is placed at 25,765 odd. Now, this moving average has not been violated, or rather closed below this. We've not seen a close below this since 6th of October. So clearly, a lot will depend on how do we navigate this support area. In case we do break that, the next possible targets for the Nifty could be 25,300, 25,200 as well as the downside. So close watch on this make or break area for the Nifty. As far as Bank Nifty is concerned, that has been relatively stronger so far. But having said that, even Bank Nifty could turn bearish if we break the 58,800 on the spot. We are very close to that, just 100 points away from that. In case we do close below that, we could see a meltdown happening in the Bank Nifty as well, where the next targets could be around 58,200 odd in the immediate future. So both Nifty and Bank Nifty continue to grind down, but they are approaching crucial support levels, especially for the next 10 to 15 days that we have left in this series, or rather this calendar year so far.
What?
Yeah, sorry.
No, just wanted to ask, any stocks that you're looking to trade now, that you're tracking?
Yes, so we are sticking with strength. Even in this market, there are some stocks which are holding their setups head and shoulders above everything else. One of them is in the metal space. National Aluminium is one of those stocks which looks good on the charts. The momentum remains high on the metal space. Nalco could head towards targets of 295 to 300 on the upside. Can be looked upon for trading, buying opportunity at these levels with the stop loss placed at 273. On the flip side, something that is looking bearish is Bajaj Finance. So Bajaj Finance is attempting to break down from its current consolidation area. And the bias remains bearish for downward targets of 950 odd on the downside. So from a positional perspective, one can look to go short on Bajaj Finance, have a stop loss placed at 1020. And financials, like we are seeing in Fin Nifty, is sort of leading the downtrend in this kind of a market. So we feel that there is more upside, more downside to be had in the likes of Bajaj Finance.
Thank you very much for that. Stocks had a good run, up 46%, Bajaj Finance, since the start of the year. Rahul sees some downside. There are two key events to watch today post-market hours. One of them is the TCS Investor Meet that starts at 4 p.m. We'll try and get you snippets of that. And secondly, this SEBI board meet, where Yash has picked up from his sources that SEBI will deliberate on the mutual fund expense ratio. Very important for all the AMCs listed here. Yash joins it with what he's learning that could be on the agenda.
Well, that's correct. All important SEBI board meeting, underway as we speak, and the press conference addressing all the issues approved is expected to happen at 5:30 p.m. today. But the most important issue on the SEBI agenda would be to deliberate over the mutual fund total expense ratio norms, a consultation paper for which had come at the start of the month. What we've been given to understand from our sources is that SEBI is likely to take up the proposal of mutual fund total expense ratio in today's board meeting itself. My sources in market regulator SEBI suggest that SEBI is likely to consider this particular change or revision when it comes to mutual fund total expenses in the same form as it was proposed through the consultation paper. SEBI is also likely to discuss the inputs which have come from various stakeholders on the revision of the expense limits for mutual fund companies. And according to our sources, very minor changes depending on those stakeholder views are expected to be done and presented before the board today. We, of course, have to wait and watch whether it finds the final approval from market regulator SEBI's board or not. Just to put things in context, what were the changes which were suggested through the consultation paper? SEBI had proposed reducing the expenses limit for mutual funds for the first 500 crore AUM to 2.1% from 2.25%, next 250 crore to 1.9% from 2%, next 1250 crore to 1.6% from 1.75%, and accordingly there was a 15 basis points reduction which SEBI had proposed through the consultation paper depending on the AUM size. Also, SEBI had proposed to revise the cap on brokerage for cash market transactions to 2 basis points from 12 basis points and derivative market transactions to 1 basis point from 5 basis points, which currently exists.
Okay. All right. Yash, thanks very much for that. That's an important story, and I think we'll have, I guess, some clarity later today at that SEBI board meet, which is going to happen. I think Gurmeet is with us, but what we'll do is, at Gurmeet, I'm sure we'll have a view on this. He's very much attuned to what's happening in the space. But there's news out of the courts as well. The Sammaan Capital case was in the Supreme Court, and it got heard today. And not very good news coming through from there. Ashmit, take us through what happened.
Well, this case was clearly in focus. The stock was clearly in focus on account of the Apex Court hearing, the Supreme Court hearing. The reason for that being that in the last hearing that took place, we had seen the Supreme Court come up with use very sharp language with respect to the investigating agencies, asking why they had a quote-unquote friendly approach, asking why they were reluctant to go ahead and to investigate this matter. In fact, pushing the three agencies, that's SEBI, the ED, as well as the CBI, to go ahead to register an FIR to move forward with their investigation. Now, importantly, the update on that was given in this hearing today was that an FIR, in fact, has been registered. It's been registered by the Delhi Police, by the EOW wing of the Delhi Police. This can now form the basis of an ED investigation. The ED requires an FIR for proceeding with an investigation. As far as CBI is concerned, what is the CBI doing? Well, that's another question that the Supreme Court asked, saying that the CBI is now been given 1 week's time within which they have to collect documents from the MCA, from the Enforcement Directorate, from SEBI, and firm up a position on whether or not they want to move ahead with registration of an FIR. Now, bear in mind that Sammaan Capital, at the last hearing itself, had clarified that, look, we've got nothing to do with this investigation. This investigation is into the conduct of the erstwhile investors, of the earlier promoters who have absolutely no exposure to Sammaan Capital. But nonetheless, this is something that the Apex Court is eager to proceed with, is eager to seek an investigation on, and is nudging the investigating agencies towards moving ahead and registering FIRs and proceeding with their investigation.
Ashmit, FIR against who? I mean, against... so, do we know who all have been named and just the entities here?
Well, the scope of this investigation, and this is something that, in fact, the counsels for Sammaan Capital were also telling us, the scope of this investigation is purely with respect to the conduct of the erstwhile promoters. So that India Bulls Housing Finance, their promoters, the erstwhile promoters, is what the investigation is going to dive into, is going to look at. And that has been the thrust of what Sammaan Capital has been saying inside the court, outside the court as well, to us, their lawyers as well, saying that don't put us under the same umbrella as the companies that are and the promoters who are under investigation. We've got nothing to do with them. That's the clarification that Sammaan Capital is.
No, Ashmit, my question was the Delhi police FIR is against who? Who's been named? Do we know?
Well, the details of the FIR are yet to emerge. They've only been filed recently. In fact, on record, these details were not even available before the Apex Court. We're given to understand that only last night is when all these details were compiled together and put in the form of an application before the Apex Court. So, yes, those details are important. Those details are awaited. We're yet to get more color on those investigation details.
Yeah. No, absolutely. And I think that is a critical point here, right? I mean, because if it is against the erstwhile promoters, then the Sammaan and the issue, of course, with Sammaan is, we've got an investor who's committed capital into the company. So in that sense, in some way, as Sammaan itself is saying and his lawyers are saying, they're not involved. So that transaction, and I mean, basically can be like a parallel, almost like a ring fence thing for someone. We'll have to see. The details of the FIR in that sense will be important. Or will Sammaan itself be dragged into this entire quagmire once again? Something to watch out for. Ashwin, thank you very much for that. Gurmeet is with us. Gurmeet, good afternoon. Good to have you with us here. Thanks for joining in. I want to start with the first thing, which Yash put out as a story. The mutual fund TER norms, what was suggested and what Yash is essentially saying is most likely they'll push ahead, at least try to push ahead with what was proposed earlier without too much dilution. Just your thoughts.
So, Prashant, I think some tweaking in expense ratio now, I think, is an ongoing process because the size of the industry has grown. If you see the SIP AUM in equity now, as per the last month, is some 16-17 lakh crore. That's almost 35% of the equity AUM. So as corpuses grow, I think some moderation in expense is likely. What I would expect from SEBI is to put one formula in place. So there is certainty, because if you keep revisiting the formula basis slabs, then it creates a bit of uncertainty. So hopefully in this consultation paper, you'll have a final slab. And I think too much micromanagement on expense doesn't really serve the purpose, because if expense keeps reducing, the distribution fee also keeps coming down, and then your overall goal of reaching beyond B30 also gets impacted. So if you see now 40% SIPs are coming beyond B30. So SEBI is trying to balance it by giving more incentives for the B30, which is beyond top 30 cities, and maybe optimize. So the larger funds where the size is more than 25-30,000 crore, the impact is more. And that can dent, likes of larger fund houses like HDFC, Kotak, ICICI, SBIs of the world, because some of their funds are more than 50,000 crore assets, whether those are hybrid funds or flexi cap funds. So it's a bit of a negative in the short run, but eventually with the growth industry seeing, it gets reset. And industry would prefer a clarity that, every 2-3 years it should not be really tinkered with. But overall, I don't see much impact coming.
Gurmeet, hi. What does one do with Meesho? If you hold it, great. But for fresh investments, at a market capitalization in 98,000 crore, is there still anything left if someone purchases today?
No, I don't think so. I think it's this is how unfortunately the market is. Remember, Grow was 200 a few weeks back. We were discussing, and if you enter then you are now stranded at 145. I think this market is when it comes to pricing good, it's pricing it very well, and when it comes to negative movement, it's going extreme both ways. I think it's a great business, nothing about it. But till the time the monetization happens and what they promised they achieve over quarter on quarter, I think there's some way to go. So I'm not a entrant at this price. In fact, I'd be happy to look at places where there has been a very healthy correction, like Grow, likes of Eternal, where the model is now stabilizing. We know that they are, for example, quick commerce, they are largely 3 players now, with one of them with 46% share, and you have a little bit of growth runway coming in. So I'll better off looking at them and then going after something which is hitting upper circuit.
Yeah, but, Gurmeet, that's the perfect logical, fundamental, stance that you've taken. I have a different question. What is up with our market? I mean, how does a newly listed stock move from 100 to 200? How does it double in, 7 or 8 trading sessions? So is it perfect price discovery, or is it now becoming imperfect price discovery? I mean, we all need to think about this, because Zepto is listing next week. And, almost all the experts agree that discussing the business is one part of it. But the way the price is moving is leaving investors absolutely confused. What do you think is going on here?
I think 200% with you, and I think, there is movement sometimes which is defying logic, both on the downside and upside. Just look at some of the defense names, for example. I know about 3 names which have got huge orders in last 30-40 days, and the stock is actually down 10-15%. Similarly, let's say, for example, I'm taking a name, not comparing it. Let's say, for example, there was a news of today, Apple looking at CG Power for the chip supply. The stock hasn't reacted, right? And you have something. So I think it is excess liquidity chasing very few pockets. And I think that is driving up prices. Look at ICICI Pru IPO.
Yeah.
3-4 lakh crore bid for a 10,000 crore IPO. So I think the market has become like that, where people are looking at more trading opportunities, if I can put it that way. More also from an investor point of view. People probably are saying that the market's not done anything. Let me see where there are a few pockets, but it backfires. When you chase momentum like this, it backfires very quickly.
Absolutely. I mean, best of luck to whoever is investing with this sort of a momentum, because it works both ways. On the way up and the way down. We know that. Okay, hang on, Gurmeet. We'll have more questions for you in just a bit. But the financial sector continues to be in the spotlight. And a big investment could be on the cards for Shriram Finance. Now, the board is looking at a meeting. They will be considering a fundraise on the 19th of December. And this comes in as reports are suggesting that Japan's MUFJ, Mitsubishi UFJ Group, is set to pick up a significant stake in the company. Some of these reports are saying the stake could be as much as 20%. Gaurav is joining in with more details. Gaurav, this has been on for a while. Where are we now?
Well, as you said, the most speculative deal of this year, at least in terms of financials, this could happen and this could come live on Friday. And the reason being that now Shriram Finance is going to have a meeting on Friday where they will consider fundraising, which also includes QIP. Now, why this is important is that we have already seen series of reports who suggested that MUFG is interested in buying around 20% stake in Shriram Finance. In fact, the latest report suggests that the valuation could be anywhere between $3.2 to $4 billion. Now, if we consider $4 billion valuation for 20% stake, it leaves roughly around 10% upside even from this level. Now, why this is important is that this is not actually the capital which is required by Shriram Finance. They already have 20% capital adequacy ratio. Now, this is important because with this new and fresh capital, the cost of fund is likely to come down. And at the same time, given that MUFG will be seen as a strategic buyer, there is some room for re-rating in terms of the credit rating. And that is the reason why cost of fund could come down even further. Now, if you look at Shriram Finance and the performance, we have already seen the stock rallying more than 25% in the last 6 months itself. And even after this rally, if you look at valuation, it currently trades at around 2.2 times price to book if we compare it with FY27 earnings. Now, if you compare it with its closest peer, which is Cholamandalam, it is still trading at 4.1 times. So there is another further headroom for growth, even if you look at valuation and even if we consider the 25% plus rally that we have seen in the last 6 months. If you look at the management commentary, earlier they had denied, but at the same time during our last conversation with the management, they said that there will be many discussions going on and there will be some interested party always in the company. So they did not deny that the deal is happening, but at the same time they did not admit. So definitely all eyes on Shriram Finance and what happens on this Friday in the stock.
No, got that. Gaurav, thank you very much. Very helpful. Gurmeet, the Japanese are coming in full force.
Across, Prashant, just see the number of deals which is happening, and I think that's where probably the sunshine news is, considering amid all gloom we are seeing on FPI selling. Shriram Finance also, Prashant, if you see, the operational performance has been very resilient. I think their margins actually grew 8-9 basis points last quarter as they utilized the surplus liquidity. The construction finance equipment portfolio is not doing that great, but should pick up now. With monsoons, erratic monsoons behind us, the gold loan and the vehicle portfolio, which is their strong points, doing very well. They're doing some very good job on wealth management also. They're stitching together a nice team, a lot of good people joining, a lot of RSUs being given as ESOPs. So I'm pretty hopeful. It's just that the price right now, because the news is so much, you may see a one-day reaction when the deal actually materializes, but it trades at a fairly good multiple. Balance sheet is 2.9 lakh crores. So you can't grow like 20% here. You will probably grow at 15-16%. So I think it's a steady NBFC to have in the portfolio. But just from a news-based trigger, I think some of it may have already been the price.
Thank you, Gurmeet, for joining in. Prashant, I recently met a very large VC investor in India. And he visited Tokyo. And again, I asked him, I said, looks like there is a lot of Japanese interest.
You met him in Tokyo?
On the flight. All right. So I asked him, I said, looks like there's a lot of money, right? I mean, are you looking to raise money to invest? And he said, there is Japanese interest in India, but only when they can control the investment. They are not willing to part their money to an Indian fund manager to make the investment. So when they come to India and commit their money, it will be by setting up an office here, getting their key people in, and then having the Indian operation. So they need to control it. For Japanese people, trust is very important. So, there is interest in India, but the way they're going to direct it is not hand it over to some Indian guy to run it, but actually control the processes, control the operations, and control, when they're putting the capital in. But we'll get into a break on that note. On the other side, we'll continue to talk markets. Tushar Pradhan of Hexagon Partner joins us next. Welcome back. Still sluggish, 25,800 though on the tape, down about 50 odd points. But let's brighten it up by talking about individual stocks where you are seeing large price and volume action. Harmis is now joining in. Harmis.
There are certain stocks that are still brighter, even as the broader markets are dull and the benchmark indices likewise. But Vedanta, Water and Infra, it's a recent listing among the first of the year this time around, is up 15% today. It's the biggest single day gain. On an intraday basis, the stock was up around 17-18%. That was the biggest single day gain since its listing. Volumes are the highest in 3 months. We have had close to a a crore shares that have already been traded on the stock. The 20-day average is just a lakh. So it's gaining on very strong volumes today. It had retested its IPO price of 294 and it's rebounding from those levels. And it has also ended up crossing an important level, a 200-day moving average of 344 on the upside. Roto Pumps is another name that is seeing double-digit gains today. The stock is up 12.5%, the biggest single-day gain since July last year. Today's volumes are the highest on record for the stock. And take a look at the volumes today. 5.7 crore shares have been traded today. The 20-day average is just under 3 lakh shares. Now, that's the kind of volumes with which the stock has moved today. The stock has moved above its 50-day moving average of around 65 or 66. And today's turnover, which is around 400 crores as we speak, is almost the same as its free float market cap, which is close to 430-440 crore. But the stock has been an underperformer this year and down around 27% so far. Apex Frozen, the stock continues to move higher, has gained in 4 out of the last 5 sessions, extending its gains now 17% higher on the stock. There was a block deal as well that took place during the course of the session. It snapped an 11-day losing streak last week and has built on to the to gains from those levels. More than 1.5 crore shares already traded, the 20-day average of around 15 lakh shares. It's taken a support at 260, continues to do so over a period of time, and it rebounds. And courtesy of today's gain, the stock has turned positive for the year. And lastly, on the downside, Gallant Ispat is the top loser on the broader market indices today, down 13%. The biggest single-day fall since May of 23, down in 4 out of the last 5 sessions. Among the top losers in the broader markets, the stock 12.5 lakh shares traded, 20-day average of 2.5 lakh shares, broken below its 200-day moving average as well today. Why is that important? Because it has not traded below the 200-day moving average since March of this year, but it's decisively broken below that in today's session. And despite that, the stock is up around 50% so far this year, turning out to be the 3rd straight year of positive returns.
Okay, all right. Hormas, thanks very much for that. Interesting list as always. 45 points lower, 25,811 is where the index is now trading at. I just want to make a quick reference to, not sure if this is, okay, it's not new, but PB Fintech, maybe we can pull this stock up. It's not as if it's sold off hard now, but it's sold off hard nevertheless. Look at that, 3% cut on top of yesterday's near 6% sell-off. So that is coming in for some serious amount of selling. Once again. So 1765. Some of the other insurance stocks like SBI Life, etc., also given back gains. But of course, this one, nothing like this one, in the entire pack. Tushar Pradhan is with us, Director, Hexagon. Tushar, good to have you with us here. Thanks very much for joining us. Any thoughts on a name like PB Fintech, Policy Bazaar? If you've looked at details, it's a story we carried all day yesterday. I'm sure you're familiar with what's happened here. I mean, the basic idea is to bring down commissions and powers being given to IRDAI, if they so choose to exercise those powers, that they can cap commissions now. Your thoughts?
No, so without talking about the company specifically, I think the direction where the regulation is going is to kind of give the market a sense that it's not going to be blue sky from here. Even if you are disrupting the market by providing, a portal where a lot of customers can access it easily and having established such a model, I think the fear that the market currently has is that is the model as sound as it was initially thought of. And I think that's really what is causing the jitters. But I think, as we all know, over time, all of the participants in the market find their own level. So whether you are face-to-face seller, whether you have a sales force, whether you are a portal, whether you're a broker, I think each of them will figure out their way of a business model. And I think that is what they're willing to give you at the moment. So I think they are just probably reacting. The market is reacting to the fact that their model would probably now need to be revisited. Of course, the fine print in the regulation has to be seen, etc. So it's probably a reaction. But as I said, markets is a great leveler. We just wait for, the winners to come over time.
It's just one thing. It's not as if anything has happened yet, right? The powers have been given. Now, the question many are asking is, well, all of this is in the bill because maybe the IRDA asked for the powers, and that's why it's in the bill. So maybe at some point they'll exercise it. But as of now, it's just there in the, it enables the regulator to act, but nothing has been done. This is, of course, the market, of course, trying to make sense of it and saying, well, perhaps something will happen and the IRDAI will do something about commissions, which has been publicly sort of concerned about, not just overall, EOM, which is expenses of management, which is commissions and operating expenses, but, specifically commissions as well. Rima.
Tushar, hi. Just big picture question to begin the conversation. What would be your top 3 portfolio bets for 2026?
Well, as I said, again, it's very fraught with danger to predict anything. But I think it is turning pretty significantly positive from the way I look at it. Because if you look at the start of 2025, it was a much more difficult market to predict than it's now in 2026 for 2 reasons. One is that the market hasn't really gone anywhere, which means that your top line remains the same. And your earnings have grown at a single-digit rate over this last 4 quarters. But going forward, I think the situation is likely changed because your confidence in the earnings growth coming through not only in the next 2 quarters, which is finishing your financial year, but going into the next year, which is FY27, I think there is a lot of confidence in the forecasts for most earnings to kind of jump back. So at best, you are going to get some increased volume in earnings coming through, which will either normalize your inflated PE, which was carried over for the last 2 years, or you will actually now make a base case PE multiple and then go forward from here, which means that the potential for making money is actually in your favor going forward. Of course, the market has to believe that. Market does move on sentiment, etc. But I think I would still put, financials, capital goods, manufacturing, I think right up there in terms of, each of the sectors which are likely to do well from here, because they are the beneficiaries of this increased volume in earnings.
Look at what's happening with Samman Capital. I'm not sure if there is any details which has come through, but the stock actually is recovered. Yeah, it's come up quite a bit from the lows. Low was about 142, and stock's at about 146 right now. As I was talking, I was sort of chatting with Ashmit earlier on the air. We don't know exactly what the FIR is about and who is it against, who's been named. If it is erstwhile promoters who are already out and have got nothing to do with Samman Capital, so then this becomes simpler in that sense and is positive. So I'm not sure if that is, somebody got a copy of the FIR or whatever, but I mean, stocks are recovering as we speak at this point in time. This, Indigo was down 10% last week off the low. It's come up a little bit off the lows. Again, when a big market sort of almost a monopoly, right? I think in about 70% of the sectors Indigo operates in, it's pretty much a monopoly. You think, and it's of course undergoing a bit of a rough patch. How would you look at something like this?
Yeah, I think I'd like to bring in a classic, the word itself. When Warren Buffett actually doubled down his bet on Coca-Cola when they launched, a new version of their drink, and all seems to be lost at that time because there were protests. People were really unhappy with the new thing, and they wanted to bring the old flavor back, and they brought it back in the name of classic. Now, that is a very, very pivotal moment in terms of one's conviction. So it is not about market, adjusting to the reality. So we cannot push the market to do what we believe is right. But I think individual conviction in terms of whether you think this is a near monopoly. India is a great growing market for aviation. There are going to be significantly more airports. There are going to be significantly more aircraft. Significantly more passengers through in the next coming few years or so. So I think it's a math that everybody has to just figure out for themselves. The current situation, of course, being driven by market sentiment, etc., can be a great opportunity. But as again I said, it's a very evolving market. Whether we know of any new entrants coming into the market, whether the markets open up to allow for more licenses to be carried forward, who knows? I think given the situation, clearly there is overreaction in the markets. But I would again think twice before jumping in because this has just fallen off a cliff. Because there might be some follow-up in terms of the penalties which haven't really been open yet. So we still have an evolving story here. I would wait and watch, would try to price it at a reasonable, value metric. Knowing what the background is, I think, every investor needs to take his own call.
Got that. That Coke example is interesting. Is an interesting one. Thank you very much, Tushar, for joining us. Good speaking with you. Have a good one. Good getting that perspective, and we'll speak again. We'll take a quick commercial break here. We'll get you some trading ideas on the other side, so that's coming up in just a bit. But lots of individual other stories as well. We'll try the spotlight once again on Vedanta, and there is a exclusive coming up, I believe, on Vedanta as well. Stay tuned.
Welcome back. Well, it's that time where we get you some final trades for the afternoon. Rahul Sharma is back with us. Rahul, so how's it looking now? Indices, any fresh calls? And otherwise, final stocks, what will you go with?
Yeah, so indices are pretty much flat with no real breakdowns seen on either of the indices. However, PSU banks have seen good amount of buying in today's session. And our top pick is Canara Bank at these levels. The stock has seen an expansion in volumes For a BTS trade, one can look to buy for a target of 153, 154. Stop loss placed at 148 on the downside. Apart from that, it's Titan that is also looking good. Yesterday, the stock saw good volumes, big price candle. And today, I've seen quite a quiet day, but the structure of the stock is still very positive, and one can look to buy Titan for a target of 4,000 rupees as an immediate one on the upside. Stop loss placed at 3870.
Thank you very much for that. Let's get to Meesho. Issue price was 111. It had a blockbuster listing, and after that, stock continues to trade higher and higher, and today up 20%. Manglam is now joining in. Manglam, tell us about this UBS note.
Well, it's doubled from the day of its listing, and it's just 5 sessions, right, in which the stock has doubled from its issue price of 111. And today's up move is attributed to, the note that has come in from UBS. The important part out here is not very different from what the management had said to us, during the IPO as well. The first part is that their asset-light, negative working capital sort of business model lends itself to good free cash flows accumulating for the company as against other new age players, and that's something that the management had said as well. Despite the reported EBITDA loss and net loss, the company did say that they have free cash flow to the tune of 1,000 crores, and that's something that they believe will grow going forward. Add to that, they also believe that the net merchandise value of the company can grow upwards of 30% CAGR, and that's something that the company has been showcasing over the last 2 to 3 years, a CAGR of between 28 to 30% as well. Importantly, we're looking at contribution margins improving as well. This as the company passes on efficiencies to consumers, which we can see in lower average order value and increased trade frequency. But more importantly, the transacting users, which currently stand at around 20 crore, have a headroom all the way up to 51 crore in terms of numbers being added to annual transaction annually transacting users. So all these factors working in Meesho's favor, the long runway of growth. But importantly, one must make sure that in the next few days as well, we would see these kind of moves on the stock, largely because in the early days of an issue, only 6% of the equity is available for trade. So this creates a large impact cost on either side, up or down. 6th Jan will be an important day for Meesho because that is when the first of its lock-in ends, and there would be a large chunk of trade stock which would be available for trade. So lack of liquidity along with positive business news is also causing an exaggerated move in the stock. So just watch out for that one.
Okay, all right, Mangalam, thanks very much for that. That's Meesho in focus there. Well, around same time, yesterday we were talking about how NCLT is essentially given the approval for the Vedanta demerger. It's a big boost for the mining giant. To understand more about the latest developments and how it will impact the future business of the company, Nigel caught up with Anil Agarwal, the chairman of Vedanta. Listen in to a slice of that conversation.
Well, over the past few years, I've had the privilege of interviewing Mr. Anil Agarwal annually. In 2025, we had almost missed out until NCLT's approval of Vedanta's demerger proposal became a defining moment. So rather than wait till 2026, this milestone calls for an immediate discussion. We're therefore pleased to have Mr. Anil Agarwal, who joins us on the show. Well, Mr. Agarwal, first, congratulations, sir, on the NCLT approval. After a brief delay, the street was waiting by, and the NCLT has given the green signal. So congrats to you as well as the team.
Look, thank you very much. I'm grateful and thankful to the NCLT and the judiciary and the entire government, and everybody was together, and we are here today.
All right.
I'm very thankful to each of them to help us to be here.
All right, Mr. Agarwal, NCLT approval has come through, but there are a few unanswered questions. So let's get straight to that. What's the expected timeline for completion of this demerger? And by when can investors have, the new entities to be listed by your expectations?
It should take normally 3 to 4 months. And we believe by March, this should be done.
Got that.
We will not leave anything unturned to make sure this happens.
March 2026 to April 2026, 3 to 4 months from now on should be around then. We got that, sir.
Yes.
But with the demerger underway, does Vedanta now, you have the option of divesting or monetizing an individual asset? Could steel be one such candidate that you could look to divest?
It's too small to talk. We are in big picture. Let's talk about big thing. this is a process. If demerge identity and CEO, they say what need to be done, they have to restructure it. But I want to remain on the top level.
Okay, and at the top, sir, you have done a good job actually in the big debt reduction at Vedanta Resources. I think that's nearly halved in the last few years. What are the debt reduction targets from here on Vedanta Resources? That's already down by half.
Yeah, we have very structured program. Whatever this is happened all the multinational company in the world. So this is a structured program, and in 3 to 4 years' time, we'll be completely paid off all the debt on VRL.
Got that? All right. So in 3 to 4 years, we could have, Vedanta Resources that will be debt-free. Got that? Now, if you could tell us, sir, how big is this entire value unlocking exercise for Vedanta Limited? If I look at it, the current market capitalization is ballpark around 2.2 lakh crore odd. In your view, what should be the group's sum of all parts valuation once this demerger is completed?
See, this is the need of our India is growing 1.4 billion people. There is no other place like this. And we are in a sector which is growing almost double digit. This is a win-win for everybody. This is a win-win for everybody. I'm looking for thousands of industry comes because we produce raw material. Whether it's the aluminum, copper, oil and gas, zinc, anything you talk about, we produce. And these are growing tremendously to be processed. So each of this identity can double the production comfortably because demand supply gap is there. And we can do brownfield expansion which is going on each of this sector, and we are going to produce most of our production now through the renewable power, which will be the green metal. We will produce green metal, very, very keen. So looking at that, we are going to produce oxygen-free copper, we are going to produce aluminum, alloy, which will be used for every sector. So each sector has a tremendous scope, and it's end-to-end. Whether it's a mining, 3-4 processes, then smelting, and then value addition.
Right.
So this is the I feel that all of us, again when I'm using the word, is going to be 100% double capacity of each of our business.
Okay, you can catch that entire conversation later this evening. It comes up at 5 p.m. only on CNBC-TV18. Right, let's move on and welcome in Siddharth Khemka into the conversation, Head of Research Wealth Management at Motilal Oswal Financial Services. Sid, good to have you in. Let's start right there. Vedanta, you just heard Mr. Anil Agarwal saying that it'll all be probably complete over the next 2-3 months. He says that there is a very clearly planned and well-defined debt reduction plan as well. What do you think of this 5-way demerger, and what's the advice to investors?
Yeah, hi, good afternoon. I think it's a step in the right direction with the multiple commodities business. Each commodity has a different life cycle and economic cycle, and that creates a lot of confusion, especially for some of the large investors, institutional investors, which look to play certain economic cycles. So I think the demerger will create those synergistic business and will lead to attracting the right kind of investors for the separate businesses. Also, it could lead to unlocking of value for a retail investor as well, because a lot of holding company discount that will go away for some of these separate businesses. Overall, I think it again will help the company to deleverage, which has been a major concern that despite some of these commodities doing in an upcycle, debt levels has been pretty on the higher side, which over the last few years the company has brought down under control, but still needs a further reduction, which this would also help them. Finally, we believe that with all these things, there is a probability of some of the individual companies getting a credit rating upgrade, hence lowering the cost of debt as well. So overall, we like the businesses separately as well, and the demerger will only unlock value going forward.
Okay, all right. Siddharth, stay with us. There's about 9 minutes to go for market closing. We'll take a quick commercial break here, come back and continue this conversation with Sid Khemka on the other side. Stay tuned.
Welcome back. Less than 5 minutes to go before we wrap up trade. Siddharth Khemka is still with us. Siddharth, Shriram Finance, all eyes on the, if a deal is announced with MUFG, board meeting on 19th. But after, 45% rally, 50% actually since the start of the year, is all the good news in the price?
So yeah, I think if you look at not only they have benefited from the upcycle in the auto sector, they have also benefited from the cut in the repo rates as well as the enough liquidity provided by RBI throughout of 2025, which most of the NBFCs I think benefited out of that in NIMS improvement. And on back of that, we saw a sharp jump in the share price. So currently, our target price is about 860, which is closer to the CMP. I think the new deal that the fundraise that can raise the book value as well as the return expectation and the growth expectation going forward. And hence, we remain positive. However, I would not suggest fresh entry until we get the final prints of the fundraise. Which could lead to further upgrades in this in both the growth estimates as well as in the target price. But nonetheless, very strong business model, market leader in its space, strong financials, and should continue to do well.
Okay. By the way, today a couple of these intra names have done well. Dilip Bilkon, for instance, is ending with a gain of around 6%. The other recent listing, Acus is up about 13%. And then, of course, Meesho tops the charts with its 20% gain. Some interesting movers on the green side. Otherwise, the mid-cap market is negative. Siddharth, recent listings. I think our colleague Hormas was pointing out even Urban Company. Originally, I think the day started well. Let's pull up the Urban Company stock as well. So they're all gravity-defying, many of them at least. Would you buy anything or would you keep anything in the portfolio? There you see a lot of volatility on UC today as well. Siddharth?
Well, I think some of these new age businesses, there has been hype on either way. So while some of them where the profitability, path to profitability is very clear, market has liked those kind of stories, and where there is a much more of hype built into the numbers, plus the path to profitability is not that clear. I think that is where the street is keeping their hands off. So a mix of a lot of these new age businesses, we would not have a direct coverage on them per se. What we can say is that among the quick commerce, e-commerce space, we continue to like some of the legacy businesses like, for example, Eternal and Swiggy. There has been a lot of chatter in the market about the fundraise and the probability of increasing discounting and all those things. But we believe that the competition has matured a lot. Even Zepto, which is the latest entrant, is looking to come with an IPO, and hence there will be a sharper focus on profitability going forward. So I think the fundraise by Swiggy is a positive step in the right direction, building a strong balance sheet for the competition going ahead. So both Zomato, which is Eternal, and Swiggy is something that we like from this quick commerce, e-commerce space.
Okay, Sid, stay with us. We're going to just wrap up things and then come back to you for markets forward. Finally the close was about 30 points lower. So this is a very, very flat day, but, Nifty Bank, something similar, right? I mean, 60, 65 points lower, which is, again, absolutely flat. The mid-cap index ends about 0.6% lower, so a little more meaningful here on the downside. Small caps even worse off, about 0.8, 0.85% down. And as I said, market breadth is negative. It's basically a clean 2:1 declines to advances ratio. That is the overall picture. I mean, PSU banks, perhaps one area where there was it kind of stood out in a falling and drifting market. IT stood out, and of course, metals as a pack also did well. On the downside, defense and real estate are two areas where there was pressure as a pocket. That's the overall sense today. Rima.
Well, a couple of big stories. One is Meesho locked in an upper circuit of 20%. UBS initiates coverage, target price 220, and stock surges towards a 1 lakh crore market capitalization. Shriram Finance also ending with a 2% plus rally ahead of the board meeting on 19th, where they will consider a fundraise. Other gainers include SBI leading the PSU banking pack, Hindalco, Eicher Motors, Wipro, Coal India, also topping the charts. On the way down, a couple of these insurance companies were weak in trade. So Max Healthcare, HDFC Life, SBI Life, private sector banks, HDFC Bank, ICICI Bank also put pressure on the overall banking space. So the Nifty Bank ended flattish, down 85 points. Private sector banks were weak, but on the flip side, PSU banks did well. Trent, Bajaj Auto also in focus, and keep your eye out on TCS. Investor Day starts at 4 p.m. Let's see whether they have any headline-grabbing announcements to make.
Absolutely, we'll do that. On the downside today, mid-cap markets have been weak. Ola Electric is ending 5% lower, with Bhavesh Agarwal selling some stake. There's also IOB down 6.5% with the government OFS. Shakti Pumps 11% lower. So quite a bit of weakness. Data Patterns 4.5% lower. Nazara is down 3.5%. So quite a bit of weakness in some of these mid-cap names. Well, with that, we're out of time on this edition of Closing Bell. Many thanks for watching. Stay tuned. Markets Forward coming up next.
The market ends lower for the third straight session, closing at the day's low. The Nifty slips below 25,850, weighed down by heavy selling in financials. The mid-caps underperform. Meanwhile, the Indian rupee stages a sharp recovery, appreciating nearly 1% in today's trade on the back of dollar weakness.
Shriram Finance board will meet on Friday to discuss a fundraise. This comes amid the reports of Mitsubishi Financial Group eyeing a 20% stake in the company for $4 billion.
The new unified tariff structure for natural gas will take effect from January 2026. The move expected to lower CNG and domestic PNG prices across the country. City gas distributor stocks, particularly IGL, reacts positively.
The Vedanta demerger will be completed by April next year, says Anil Agarwal, one day after the Company Law Tribunal waved the green flag. Anil Agarwal also says that the entire debt of the parent Vedanta Resources will be paid off in 3 to 4 years. That's an exclusive. Hello and welcome to Markets Forward on CNBC-TV18. This is a go-to show and your go-to show where we aim to get you all the key data points to gear up for the next trading day. I'm Vinny Motiwala. With me is my colleague Mangalam Malu as well. Mangalam, we're trying to get that green on the screen, given both of us are wearing green today, but that was not the case, right?
It wasn't the case. In fact, for all practical purposes, today the market was expected to show some signs of recovery because we closed very close to support levels. We actually opened higher as well. And then we had the additional support of lower crude prices and an appreciating rupee as well. That wasn't the case to be. In fact, we ended at the lowest end of today's trading range, so to say, back again closer to that 25,818 mark. The only solace that bulls will have is that we didn't go below the 50-day moving average on the frontline index, but the Nifty bank closed below that 59,000 mark. And importantly, we did see the advanced decline ratio for the second day in a row firmly in favor of declines, with over 2,000 stocks ending in the red as against 885 which were in the green. So those crisscross lines never crissed or crossed. In fact, they were firmly apart from each other, with the red line much above the green one.
Absolutely, and that's why that underperformance also coming in from the broader end of the market as well. Apart from that, when you're looking at it in terms of sectors also, most of the sectors today traded in the red except for PSU banks and IT. That managed to hold on to some bit of a green. Metals also some bit of a green that came in there. Pharma, very, very mild green, very mild green. 0.09% gain by the end of the day. So nothing much over there. But apart from that, everything was in the red. So that is something, it is a round off in terms of the market that we have for you all today. We'll watch out for what is going to be happening tomorrow. But here's an exciting lineup that we have in store for you all today. With the top movers and shakers of the day, we'll start with Hormas. Then we'll deep dive into Shriram Finance's fundraise plans, new tariff structure for natural gas, and why Meesho shares hit the upper circuit today. We'll talk about all of that, and last but not the least, we'll also talk about the key market events to watch out for in tomorrow's trading session. First up, let's go across to Hormas now, who's at the big wall to tell us about the top movers and shakers of the day. Hormas, over to you.
Since we are optimists, we try to look at the positives. The positive was that we tried recovering from the lows of the day, closed above the 50 DMA on the index. So we'll start off with an index that closed in the positive today. It was the PSU banking index that outperformed, and that was the case all through the day. And almost all the constituents, barring those low float PSU banks, considering IOBs, OFS, were the ones that were underperforming, but most of the others saw gains of anywhere between 1.5% to 2%. Defense as a space has been under pressure over the last 1 month. The defense index is down 10%. And you can look at the shares like Cochin Shipyard, Data Patterns, Paras Defense, all of them seeing losses of anywhere between 3 to 4% in today's session as well. Now, the newsmakers, of course, headlined by Meesho's upper circuit in today's session. The stock has almost doubled from its issue price of 111. IGL did well in today's session of the PNGRB tariff regularizations. AkzoNobel, of course, after the block deal ending 14% lower. Saregama, the street did not like the acquisition proposal, and the stock ending 7% lower. And Ola Electric, of course, another new low today, sub 33 now on the stock, another 5% shaved off. Real estate stocks also did not have a very pleasant day either, with Suraj Estates, Ajmera Realty down almost 5%, Anantraj, Prestige Estates, almost every other constituent of the real estate index ending lower today. And lastly, stocks at 52-week lows. Tejas Networks, the forgettable 2025 continues for this stock, another 3.5% shaved off. Colgate at a 52-week low. Ramkrishna Forging, these are big names that ended at 52-week lows today, as did Concord Biotech, a recent listing, but a 52-week low nonetheless.
All right. Thanks a lot for that, Hormas. With that, let's take the discussion forward. We do have Siddharth Khemka of Motilal Oswal Financial Services joining in, Jay Thakkar of ICICI Securities joining in as well. Jay, the kind of market move that we've seen, it's been between this 50-day moving average and 20-day moving average, but today had all the reasons for the market to bounce back. We did see some bit of recovery from lows yesterday. At the same time, we saw, the rupee also appreciate after this near free fall that's taken place, and then Brent prices came down as well, crude prices below $60 per barrel. If there was a day for a bit of an up move after the FIS being just 9% long, it was today, but that wasn't the case to be.
Good afternoon to you, Mangalam and Vinny. Definitely, we had these reasons and, rupee appreciating, crude oil prices going down, but then, we have seen stock-specific movement, Mangalam, rather than overall market. So, if we see since couple of trading sessions, then OMCs have been doing good and they have been factoring the fall in the crude oil prices. The same is not witnessed in the paint stocks. If you see paints like stocks like Asian Paints, which did very good last series in the November series, we saw a good short coming out there. Now it has gone sideways despite crude oil prices falling and has fallen to $58. So it's very stock specifically right now. The action in the market is pretty less. If you see the volume wise as well, the breadth is absolutely not in support of the markets. So markets, rather what I read it, Mangalam is it's in a very small consolidation phase. And if I have to basically plot a range for the index, then it would be 26,000 now to 25,500. I think that's just 500 points range within which the index has now gone into. And beyond 26,000, if Nifty moves, then definitely we would see a fresh breakout, a fresh momentum, and basically the breadth improving, and all the reasons thereafter would be, playing out eventually. And the Bank Nifty too, in fact, the kind of pressure which we have it now on the 60,000 levels, Mangalam on the upside. The range is quite broad there. PS2 is definitely having an upper hand, but the range is broad, 58,000 to 60,000. And that's 2,000 points range after a very significant run up. I think this index too has gone sideways. The best part is, Mangalam, that despite all of this, Rupee, when it inched towards almost 91 levels as well, we did not see India VIX or the IVs of the indices. They didn't go up. So that's a positive thing that's clearly indicating that right now, whatever movement we are seeing in the market is more of correction in the short term in nature or a consolidation phase. Once this is over, the probability of an upward breakout is quite likely.
Okay, Jay, thanks so much for that. Surely we'll keep an eye out on those levels over there. Let's move on and now talk about individual stocks. We are at the board of Shriram Finance that is actually set to consider a fundraising plan, and that meeting is going to be on Friday. And this is coming amid the news reports of Japan's MUFG Group plan to acquire around 20% stake in the company. Let's go across to Gaurav, who's here to give us more details on this one. Gaurav, over to you.
Well, yes, we could actually see one of the most speculated deals coming up on Friday, and the reason being that Shriram Finance is going to have a meeting where they will consider fundraising, and this also includes QIP route. Now, why this is important is that there were already many reports which suggested that Japanese group MUFG is looking to buy around 20% stake in Shriram Finance. In fact, the latest report suggests that the valuation could be anywhere between $3.2 to $4 billion for the 20% stake. If we consider the higher range of the speculation that is going on, it still leaves more than 9 to 10% headroom for the stock price. Apart from that, if you look at the stock performance in the last few days, you've already seen the stock has gone up almost by 27% in the last 6 months. And even after that, look at the valuations. It is trading at 2.2 times price to book value. And if we compare it with its closest peer, which is Cholamandalam, it still trades at above 4 times price to book. So definitely there is further headroom for growth as well. Now, how it impacts Shriram Finance is also important. If you look at the capital ratios for Shriram Finance, they are in the tune of 20%, which is higher than the regulatory requirement. So this capital is not something which is actually required by the company, but what it will do is that it will bring down the cost of funds. Let's not forget that given that MUFG will be seen as a strategic partner, it will also leave some headroom for credit re-rating, and that is the reason why the cost of fund is a key thing to watch out for, which is likely to come down from the deal. Earlier, management had categorically denied, but during the last conversation with us, management said that there will be many discussions going on and there will be some interested parties. So they did indicate a bit, but they did not confirm the news. So definitely, we will be closely watching out on what happens on Friday and how it impacts Shriram Finance, specifically given that there is a lot of talks going on around MUFG deal happening in Shriram Finance.
Take that point entirely, Gaurav. This will be something that the street will definitely be watching out for, especially given a lot of the fundamental view is veered towards positive financials. Will Shriram Finance stand to continuously benefit and see the kind of outperformance that it has already seen? Let's see whether that comes about or not. Let's go across to our experts once again. Jay, from fundamental standpoint, rather a chart check standpoint, how does that look? And then after that, we'll ask Siddharth as well what his views on Shriram Finance are.
Definitely, Mangalam. This has been an outperformer within the NBFCs, if you see, and within the Nifty as well. This stock has been trending higher after a fair amount of consolidation. With this stock had actually gone from September 24 until the breakout which happened in October of this calendar year. Mangalam, we saw almost a year of consolidation in this stock between the range of say 500 to 700, 200 points sort of a range, which has provided a breakout on the upside. So definitely 900, 950 looks very much on cards. And, with this kind of a breakout, we have seen a good long build-up happening in this stock. And, there were hardly any shorts. Rather, we saw a long build-up, which is positive. It's just that, Mangalam, I would like to add is that the stock has already run up quite a lot from 720 odd levels to 860. So one can buy this with a staggered approach, targeting around 950 in the short term. But, eventually it will inch towards, say, 1,000 plus levels in the medium term as well.
Okay, and Siddharth, what's your view for Shriram Finance as well? Because this is not the only financial company which has seen all these flows coming in during this year. We've seen all this as FDI coming in for RBL Bank as well previously. Your view here.
So hi, good afternoon, Vinny, and good afternoon, Mangalam. I think the entire NBFC space is witnessing an upcycle, both in terms of the demand outlook as well as in terms of lower cost of funds, with the RBI cutting rates throughout 2025 and providing enough liquidity, which has only improved the NIM's trajectory going forward. Shriram Finance has also benefited from an upcycle in the auto sector. Now their aspiration to grow and expand the new vehicle financing business with the benefits of lower cost of funds, that is something that they are looking to expand. There is also a special emphasis by the management to expand in the gold loan business, which has become lucrative after the gold price hikes, plus entry into the consumer lending business. That should also that is also on the growth plans for the management. To do all that, they were evaluating a potential strategic partner which could support Shriram Finance in not only achieving funds for the expansion plan, but also what we believe is that a credible partner could lead to a stronger case for a credit rating upgrade and hence further lead to lowering of the cost of funds. So overall, we believe that this is a market leader in the financing space with strong growth ahead, and the fundraise would only enhance both the book value as well as the growth prospects. At current valuations, I think while it is closer to our current target price of about 860, we definitely see room for further upgrades on our FY27 numbers and estimates, and we definitely see a 15-20% upside, I think, from here as well.
All right, we take that point. Thanks a lot for that. Let's move on to the next story then. The new unified tariff structure for natural gas will come into effect from January 2026. That's the date which has been set by the PNGRB. These revised norms expected to lower gas prices for CNG and domestic PNG. Following this, Nomura has upgraded IGL from neutral to buy on attractive valuation, and as a result of which that stock in an otherwise wobbly market was up 5%. What does this entail? Sonal joins in with more on that. Sonal.
It is a notification that has come in from the PNGRB, which is the regulator for new unified natural gas tariff structure. Now, do remember, all the details were already known. This is just a notification that has come by to talk about the effective date. So there are no new details that have come by. It is just the final date being announced is something that has gotten the stocks excited and the upgrade as well. So just to give you some more details, tariff zones will be reduced from 3 to 2 up to 300 kilometers, and beyond 300 kilometers there will be 2 tariff structures as well. And CNG and domestic PNG consumers, they will be given priority and they will have to pay zone 1 tariffs, which are the lower ones. So if we talk about both the tariffs, up to 300 kilometers, it is 54 rupees. Beyond that, it's 102.86 rupees. Because they will only follow the first zone tariff, they will see a fall in CNG prices by 1.25 to 2.5 rupees per kg, and PNG prices by 0.9 to 1.8 rupees per SCM. This will lead to higher volumes because ultimately consumers will benefit from this, and that is the reason these regulations were expected to be very positive for the sector. Nomura also has come up with a note on IGL. They've upgraded the stock to a buy, a target price to 230 from 215. They say from here on, margins will get support from lower tax and transmission as well, transmission tariffs as well. Lower tax because it will be 2% now in Gujarat versus 15% earlier. There'll be lower transmission costs because now it's a priority sector in the zonal tariffs. And third, they also expect Henry Hub prices to come off because now they are at elevated levels, and this should start supporting margins from Q1 of FY27, and that's why they are quite bullish on IGL from these levels.
Okay, thank you so much for that, Sonal. But let's move on and get your big exclusive. The Vedanta demerger will be completed by April next year, says Anil Agarwal, one day after the company law tribunal waved the green flags. Anil Agarwal also says that the entire debt of the parent Vedanta Resource will be paid off in the next 3 to 4 years. Listen in.
It should take normally 3 to 4 months. And we believe by March, this should be done.
Got that.
We will not do anything unturned to make sure this happens.
March 2026 to April 2026, 3 to 4 months from now on should be around then. We got that, sir.
Yes.
But with the demerger underway, does Vedanta now, you have the option of divesting or monetizing an individual asset? Could steel be one such candidate that you could look to divest?
It's too small to talk. We are in big picture. Let's talk about big thing. I know this is a process. If demerge identity and CEO, they say what need to be done, they have to restructure it. But let's look at, I want to remain on the top level.
Okay. And at the top, sir, you have done a good job actually in the big debt reduction at Vedanta Resources. I think that's nearly halved in the last few years. What are the debt reduction targets from here on Vedanta Resources? That's already down by half.
Yeah, we have very structured program. Whatever the this is happened to all the multinational company in the world. So this is a structured program, and in 3 to 4 years' time, we'll be completely paid off all the debt on VRL.
All right, just a final one. A quick word, Sid, on Vedanta.
Yeah, Mangalam, I think this is a step in the right direction. There are multiple commodities and each commodity has a different economic cycle. So I think with the demerger in place, they will be able to attract the right kind of investors, not only the retail, but more importantly, the institutional investors will be able to participate in their interest of commodities, be it the aluminium, be it the zinc or the oil and gas business. So I think apart from that, they could also lead to a value unlocking. And most importantly, we believe that with the separate businesses, individual businesses could lead to a credit rating upgrade and the debt lowering plan that could all lead to a good potential upside with the metal cycle, commodity cycle on the upswing over the next few quarters.
Okay, thank you so much for that. And thank you so much, Siddharth, as well as Jeff, for joining us on the show, as always. On that note, we're going to slip into a very short break. On the other side, we'll get to get the top corporate voices along with the key market events to watch out for in the next trading session. Welcome back to Markets Forward on CNBC-TV18. Now let's move on and talk about the top corporate voices that we had through the day. First up, we had Nephro Plus, which debuted on the D Street with a 7% premium to its issue price, but the stock ended flat. Group CEO Rohit Singh told CNBC-TV18 that Nephro Plus is the third dialysis company globally to be listed on the stock exchanges. He added that the company currently treats around 34,000 patients every month and is ranked as the fifth largest dialysis service provider in the world.
They also expect about 20% revenue growth to continue with them. And Patanjali Foods, that too is on our radar. The management joined us today for a look ahead into 2026. They said demand is picking up following the GST rate cuts, with rural demand outpacing urban. And at the same time, we had the uptick, which is expected to continue through all of FY26. The FMCG portfolio expected to contribute up to 50% of their sales in the next 3 years is their long-term target.
And before we wrap up this edition of Markets Forward, let's go across to Gaurav, who's here to tell us what are the key events to watch out for in tomorrow's trading session. Gaurav, over to you.
Well, yes. If you look at the key events, first let's talk about US market, because Mr. Donald Trump is going to address the nation. So that is something that we will be watching out for. Is it going to be something serious? Is it going to be just a greetings for the coming celebration? Let's see how it goes. Apart from that, US CPI data, that is also something that we will be watching out for fundamentally. If you look at the European data, now ECB will come up with the decision on their interest rate. Remember, Street is not expecting any kind of change in this meeting at least. And at the same time, Bank of Japan, now they are also holding their monetary policy meeting. Now that is something a key thing to watch out for. Although the decision will come on Friday, the meeting is ongoing. Street is expecting 25 basis point of increase to 0.75%, and now that will be a 30-year high from the Japanese market, and that will also impact the US market and the bond market because of the carry trade. So that is something which is really a key thing to watch out for. Apart from that, from the Indian market, Prime Minister Narendra Modi is on a visit in Oman, and India and Oman is likely to sign free trade pact. So that is something which is important. And at the same time, from the IPO market, we have already seen many activities happening here. Tomorrow is the last day of KSH International IPO subscription for retail investors. This is actually 710 crores worth of IPO. But if you look at the subscription data, it was subscribed just 30%. But we tend to see large moves coming up on the last day. So let's watch out on this IPO as well, and let's see how it performs and how it works for the investors in the days going ahead.
Right, Gaurav, thank you for setting that up for us. With that, we are out of time on this edition of Markets Forward. We bring that to a close, but you don't go anywhere. Stay tuned to CNBC TV18 for all the news and updates that continue.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. Rupee recovers from new all-time lows, and intervention from the RBI and exporters hurrying dollar sales at higher levels helps trigger the Indian currency's biggest single-day gain in 7 months. Sensex and Nifty declined for the third straight session. All sectoral indices end in the red. Midcaps underperform. Shriram Finance board will meet on Friday to discuss a fundraise. This comes amid reports of Mitsubishi Financial Group eyeing a 20% stake in the company for $4 billion. The Vedanta demerger will be completed by April next year, says Anil Agarwal. One day after the company law tribunal waved the green flag, Agarwal says the entire debt of parent Vedanta Resources will be paid off in 3 to 4 years. That's an exclusive. Lok Sabha debates a new bill that aims to open up the closely guarded atomic energy sector to private players. Ministers of State Jitendra Singh says the bill is paramount to reduce dependence on fossil fuels. Congress questions the removal of the supply liability clause, adds that the bill provides no clarity on the degree of independence of the regulator. In a major escalation, President Donald Trump orders a blockade of sanctioned oil tankers as the U.S. attempts to choke the country's economy, which is heavily reliant on oil. The move comes as U.S. builds up military presence in the region. ChatGPT maker OpenAI is in talks with Amazon about a potential investment of $10 billion. CNBC reports Amazon is also keen on an agreement to sell its semiconductors to OpenAI. Amazon has already invested $8 billion into OpenAI's rival, Anthropic. Chinese AI chip maker Meta X skyrockets nearly 700% on its debut on the Shanghai Stock Exchange. The company had raised nearly $600 million via the IPO. The world's richest man, Elon Musk's net worth touches $650 billion as Tesla stock hits a record high. Musk's net worth is now more than the combined wealth of Larry Page and Jeff Bezos, who are the second and third richest in the world. All right, the top story this evening, the rupee recovered nearly 1% a day after breaching the psychological 91 mark against the dollar and hitting an all-time low. This is the currency's biggest single-day gain in 7 months. So what aided the rupee's recovery? Lata Venkatesh is here to decode for us.
Well, the rupee has recovered and ended higher for the first time since December 10th. So it's been almost 2 weeks of continuous fall and lower close that the currency was seeing. Actually, it started the morning lower, a dollar costing as much as 91 rupees and 7 pies. But at that point, there was some bit of RBI selling. But there was a bunch of exporters selling as well, because 91 was such a lucrative number for them that we saw a very sharp recovery in the rupee, 1 rupee, to all the way to 90 rupees and 02 pies. That was the level of recovery one saw in the rupee. At that point, there were also a lot of stop losses triggered. Many people had not expected such a sharp recovery, and there were stop losses on the way. So at 90.50, there were stop losses triggered. So more people had to come and buy to reduce their losses. And that led to a very decent recovery in the rupee. The other reason why you saw the rupee recovery was also because crude oil prices had fallen below $60, and that is always sentimental positive for the rupee. But at that attractive level of 90.02, there was also dollar buying by oil companies. So the rupee moved in a big range today and settled somewhere in the middle of that range. You can't say all the bad news or the negative sentiment is over, but clearly a relief for the beleaguered currency.
Right. Thank you, Lata, for that comprehensive update. Shifting focus to the markets now, the Wall Street was under pressure for the third straight day. All major indices ended lower, with the Nifty falling below the 25,850 mark. The Nifty was dragged lower by financial heavyweights M&M and L&T. The broader markets saw more pain and underperformed the blue chips. The Midcap index fell over 300 points. Crude oil prices are attempting to rebound after hitting the lowest level in nearly 5 years. The crude market is under pressure this year after top oil producers ramped up production after years of output cuts. Investors are also pricing in lower geopolitical risks and are hopeful of a ceasefire agreement in Ukraine. Many experts believe the American blockade on Venezuela's oil will not have a significant impact on prices. It's also worth keeping in mind that falling oil prices could signal a slowing economy. From crude to the precious metals, prices of silver hit a record high of nearly $66 an ounce. Silver prices have climbed 30% in the last 1 month alone and have increased 127% in 2025 so far. Weakening of the US dollar index, a higher unemployment rate in November from US are boosting sentiment. Shriram Finance gained in trade after the company said its board would meet this Friday to consider a proposal to raise funds. Now, this comes at a time when Japan's Mitsubishi UFC Financial Group is reportedly nearing a deal to acquire minority stake in the firm for $4 billion. Gaurav Javalkar is here with all the details. Gaurav.
Well, yes, one of the most speculated deal can come in the market this Friday, and the reason being that Shriram Finance is going to have their board meeting where they will consider fundraising, and this also includes fundraising via QIP. Now, earlier, we have already seen some of the market speculation going around. MUFG interested in buying Shriram Finance, around 20% stake is what they're eyeing for. And at the same time, recent reports also suggest that the valuation that they're eyeing for is anywhere between $3.2 billion to $4 billion. Now, if you consider the $4 billion mark, it still leaves around 9 to 10% upside from this price as well. Now, if you look at Shriram Finance, fundamentally, there is no need for capital immediately because the capital ratios are at around 20%. So this capital will be seen as a strategic capital which will be flowing in the company. This will actually bring down the cost of funds, and at the same time, given that MUFG will also be seen as a strategic buyer, there is further headroom for credit re-rating, and that is the reason why it is going to be positive for Shriram Finance if the deal comes through. Apart from that, if you look at the stock performance, it has gone up almost more than 25% in the last 6 months itself. But even after this rally, if you look at the valuations, the FY27 based on FY27 earnings, the price to book still stands at around 2.2 times. If you compare it with its closest peer, it still trades at around 4 times price to book. So that is something which also needs to be considered. When we look at the overall market reaction and the commentary, earlier management had categorically denied, but in the last conversation that they had with us, they indicated that there will be many discussions going on and there will always be some interested party. So they did not deny, neither they confirmed the news flow, but at the same time, given that there is a lot of speculation going around and there is a board meeting for fundraise, we will be watching out on what happens in Shriram Finance on this Friday.
Right. Thank you, Gaurav, for that update. Let's shift our focus to the big news maker. Now, the Vedanta demerger will be completed by April next year, says Anil Agarwal. He spoke with Nigel D'Souza just one day after the company law tribunal waved the green flag for the demerger. Now, Agarwal also said the entire debt of parent Vedanta Resources will be paid off in 3 to 4 years.
It should take normally 3 to 4 months. And we believe by March, this should be done.
Got that.
We will not do anything unturned to make sure this happens.
March 2026 to April 2026, 3 to 4 months from now on should be around then. We got that, sir.
Yes.
But with the demerger underway, does Vedanta now, you have the option of divesting or monetizing an individual asset? Could steel be one such candidate that you could look to divest?
It's too small to talk. We are in big picture. Let's talk about big thing. I know this is a process. If demerge identity and CEO, they say what need to be done, they have to restructure it. But let's look at, I want to remain on the top level.
Okay. And at the top, sir, you have done a good job actually in the big debt reduction at Vedanta Resources. I think that's nearly halved in the last few years. What are the debt reduction targets from here on Vedanta Resources? That's already down by half.
Yeah, we have very structured program. Whatever the this is happened to all the multinational company in the world. So this is a structured program, and in 3 to 4 years' time, we'll be completely paid off all the debt on VRL.
The Board of Market Regulators, SEBI, is likely to back the overhaul of mutual fund expense ratio. Sources say the board could make minor tweaks to its consultation paper based on stakeholder feedback. SEBI is proposing to reduce the fee charged by mutual funds from current levels. The proposal is also to impose limits on brokerage for cash transactions and derivative trades. If approved, mutual funds will get cheaper for investors. Nephro went public today with shares listing at 7%. At a 7% premium to its IPO price. The company provides dialysis and renal care with a strong presence in Tier 2 and Tier 3 cities. It operates through strategic partnerships and adopts an asset-light model. The 871 crore rupee IPO was oversubscribed nearly 14 times, led by strong institutional demand.
We have raised the primary issue for future expansion as well. We have historically grown at a comfortable CAGR of 25 to 30% in that range, and keeping that momentum going, we believe that this fresh issue will also help us fund our future growth.
The Parliament today debated a new bill that aims to open up the closely guarded atomic energy sector to private players. Tabling the bill in the Lok Sabha, Minister of State Jitendra Singh said the legislation will help reduce dependence on fossil fuels and achieve 100 gigawatt of nuclear power capacity by 2047. Now, what has sparked a controversy is the bill elaborates operators shall be liable for damages except those caused by grave natural disaster of an exceptional character. Now, liabilities are also exempt during an armed conflict, civil war, insurrection or act of terrorism. Congress questioned the removal of the supplier liability clause and added that the bill provides no clarity on the degree of independence of the regulator.
भारत का भौगोलिक स्तर पर रोल भी बढ़ रहा है, भूमिका भी बढ़ रही है. And if we have to be a global player effectively, we have to live up to global benchmarks, follow global parameters, and adopt global strategies. आज सारा विश्व क्लीन एनर्जी की जाने बढ़ चुका है और हमने भी अपने लिए लक्ष्य निर्धारित किया है कि न्यूक्लियर एनर्जी 100 गीगावाट बाय 2047 जब हिंदुस्तान अपनी आज़ादी की 100वीं सालगिरह मनाएगा.
If we are opening up India's nuclear energy sector to private participation, what you require is an autonomous, independent regulator who can be a neutral umpire. Since there is no clarity in the bill about how independent or autonomous the regulator is, I would definitely want the minister to clarify with regard to this.
Now, Delhi residents woke up to yet another day of dense smog and poor visibility as air quality remained in the severe category. In the region, air quality index had peaked to 349 this morning. The Delhi government has mandated that all companies should operate with 50% work from home staffing. The Supreme Court has directed the authorities to consider shutting down 9 toll plazas to ease the traffic at Delhi's borders. Delhi's Environment Minister Manjinder Sirsa has said all private vehicles below BS6 standards and not registered in Delhi will be barred from entering the capital from tomorrow. He added that vehicles without a valid PUC certificate will not be allowed to refuel at petrol pumps. The restrictions will remain in place as long as stage 3 and 4 of the pollution control measures are in place.
एक तो दिल्ली के अंदर जिसके पास पीयूसीसी सर्टिफिकेट नहीं होगा उसको कल का दिन बाकी है, परसों से उसको पेट्रोल पंप पर तेल नहीं मिलेगा. जिनके पास पोल्यूशन सर्टिफिकेट नहीं है, जिन्होंने पीयूसीसी अपना नहीं कराया, उनको केवल एक दिन कल के दिन की उनको मिल रहा है. कल के बाद ऐसे व्हीकल्स को पेट्रोल पंप पे फ्यूल नहीं मिलेगा.
Indigo's chief operating officer appeared before the Parliamentary Committee on Transport after mass flight cancellations affected more than 9 lakh travellers. The airline has since managed to restore most of its operations after aviation regulator watered down rest rules for pilots and crew. The Delhi High Court has refused to entertain a PIL against Indigo seeking compensation of up to 4 times the airfare. The PIL also sought a judicial probe into the airline. The High Court also noted that it was already hearing a similar matter against Indigo. Tata Motors' all-new Sierra has received a bumper response from buyers, clocking over 70,000 confirmed bookings since reservations opened yesterday. In addition, around 1.35 lakh customers have submitted their preferred configurations as they move towards completing booking formalities. The SUV marks the revival of the iconic Sierra nameplate and will be offered in multiple configurations priced at around 12 lakh rupees. Deliveries are expected to begin from mid-January 2026. The Supreme Court has granted bail to former DHFL promoters Kapil and Dheeraj Wadhwan in the 34,000 crore bank fraud case. The brothers were accused of cheating a consortium of banks and siphoning off loan funds. The court cited prolonged pre-trial detention and granted bail with strict conditions, including personal bonds, passport surrender, monthly check-ins and travel restrictions. And Delhi police registered a fresh FIR against the former promoters of Sammaan Capital in a matter involving suspected financial irregularities. Now, the Supreme Court had directed the CBI to take a final call on filing the FIR within a week. And on that note, it's time for a short break. Coming up next, world's richest man Elon Musk's net worth touches $650 billion as Tesla stock hits a record high. More on that when we return. Welcome back. Amazon is in talks with ChatGPT maker OpenAI to invest around $10 billion in the firm. The deal could potentially value the artificial intelligence firm at over $500 million. The agreement could also include the use of Amazon's chips. According to CNBC, the talks between the two firms are very fluid and subject to change. Now, Jared Kushner's Affinity Partners has decided to drop out of Paramount's hostile takeover bid for Warner Brothers Discovery. Now, Kushner is the son-in-law of US President Donald Trump. The Paramount offer had come days after streaming giant Netflix said it had reached a deal to buy WBD's film studio and streaming service HBO Max. Shilpa Ranipeta joins us now. Shilpa, there's a lot happening in the high-stakes battle for Warner Brothers.
Well, you're absolutely right. You know, it's one new twist every day, and in a major twist that came overnight in the Hollywood mega merger battle, Trump's son-in-law, Jared Kushner's investment firm Affinity Partners has withdrawn from the Paramount Skydance bid to acquire Warner Brothers Discovery. Now, in a statement to Bloomberg, Affinity said that with two strong competitors vying to secure the future of, quote-unquote, this unique American asset, it will no longer pursue this opportunity, though it still believes that there is a strong strategic rationale for Paramount's offer. Now, Affinity, along with three other Arab wealth funds, had already agreed to forego all governance and board rights as non-voting equity investors. Now, its exit leaves the Ellison family and the remaining financiers to carry the bid forward. Meanwhile, there's more happening. The Warner Brothers board is preparing to tell shareholders to reject Paramount's $108 billion hostile tender offer with a filing expected as early as Wednesday. Now, the board argues that its $72 billion deal with Netflix actually offers higher value, more certainty and better terms than Paramount's latest $30 a share proposal. Now, reports say that the board's formal response will highlight valuation, financing structure and deal terms as core deficiencies in Paramount's bid. Now, the final filing is actually still awaiting final board approval. Meanwhile, Warner Brothers shares were trading at around $29 on Tuesday, signaling that investors expect Paramount will still need to sweeten its offer further. As for what happens next, the door is still wide open. The Ellisons could return with a revised counterbid, and Netflix may also choose to respond. Meanwhile, inside Netflix, executives said that the hostile bid was expected from Paramount. And in a memo to employees, Ted Sarandos and Greg Peters reiterated that Netflix has a solid, superior deal, which is good for shareholders, consumers and jobs, and that they're confident of regulatory clearance and the deal closing. Netflix also emphasized that WBD's theatrical business is core and there will be no studio closures or downsizing that will happen, and that Netflix now intends to fully enter the theatrical business once the deal is complete. And the stakes couldn't be higher. Whoever wins WBD gains control of HBO Max and one of the world's most valuable content libraries, from Harry Potter, the DC Universe to Friends, Game of Thrones, and thousands of iconic film and TV titles. Back to you.
Right, thank you, Shilpa, for that update. We will keep a track on this deal. Of course, shifting focus now, the world's richest man, Elon Musk's net worth touches $650 billion as Tesla stock hits a record high. Musk's net worth is now more than the combined wealth of Larry Page and Jeff Bezos, who are the second and the third richest in the world. Rachna Dhanrajani is here with more on what's sparking this massive surge in Musk's net worth. Rachna.
That's right. Elon Musk's net worth now stands at about $650 billion. Here's why. Tesla stock has hit record levels, buoyed by investor optimism around robo-taxis and autonomous driving. This has come even as the company reports a slowdown in electric vehicle sales, its core business at the moment. But markets are increasingly valuing Tesla as a future AI and mobility platform rather than a conventional car maker. And that shift in perception has lifted both the stock as well as Musk's personal wealth. A key point to note here is that Musk's wealth does not come from a traditional salary. Instead, his compensation is almost entirely equity linked, tied to long-term market cap and performance milestones of Tesla. So when Tesla's valuation rises, his wealth moves with it, sometimes by tens of billions of dollars in just a matter of days. Apart from Tesla, a recent private share sale has pushed SpaceX valuation close to $800 billion, adding significantly paper wealth without a public listing or fresh earnings disclosure. XAI's rising private valuation has also added another layer to this momentum. Together, these moves explain why Musk's wealth can now swing so dramatically in just short periods. But let's take a step back to look at Musk's journey. He became a billionaire in early 2000s with the PayPal sale. But the real acceleration started in 2020 when Tesla's stock surge pushed him past the $100 billion mark for the first time. Since then, his fortune has repeatedly risen and fallen with market sentiment, crossing $200 billion and $300 billion in 2021, dipping sharply in 2022 and climbing up again as investors bet on autonomy, space and AI. The $600 billion moment then is less a sudden breakthrough and more like the latest chapter in a wealth story shaped by markets that are increasingly willing to price the future well ahead of the present. Back to you.
Right. Thank you, Rachna, for that update. And with that, it's a wrap on this edition of Business 360. News and updates continue right here on CNBC-TV18. Thank you for watching.
Talk Money.
Hello and welcome to a brand new edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. Passive mutual funds are becoming a very important part of the Indian investing landscape. These funds now comprise almost 17% of the mutual fund industry's total assets under management. Now, just to remind you, passives, as these funds are called in short, now they are funds which do not rely on a human being to pick stocks or bonds or any security that this fund is investing in. These funds instead simply mirror an underlying index for portfolio construction. So how can we investors make best use of these low-cost funds to boost our portfolio performance? What's the right way of incorporating these passives in our portfolio, and why should we do it in the first place? Well, joining me on this very interesting discussion are Pratik Oswal, who is Chief of the Passives Business at Motilal Oswal AMC, and Aditya Agarwal, co-founder at Wealthy.in. And of course, Aditya works with a whole host of mutual fund manufacturers and companies within the wealth and investing landscape. Gentlemen, thank you so much for joining in. I'll tell you at the outset that on this show, we have done a conversation on passives in the past as well. So I think investors will quickly do a refresher. But I think the fact that these funds are simple, they only mirror an index, I think that part has been understood. What we now need to really understand is the way this industry is growing. There are so many different kind of passive funds coming in. So how do we start our fund selection process? Let me get some opening thoughts though. Pratik, you come in, and you're in the business. You've seen the plethora of NFOs all through this year. What is your take on where we are in the so-called passive revolution?
Thanks, Surabhi, for having me. So, obviously, so passives, as we know, are pretty large in more developed markets like the US and Europe. Out there we are seeing more than 50 to 55% of the mutual fund industry is purely passive, and the rest is active. So it is a pretty large part of people's portfolios in most of the world, at least the developed world. And now we're seeing that it's getting some sort of mainstream sort of acceptance in India as well. If you look at passives, 10 years back, it was less than 1% of the entire mutual fund AUM. Today, it's close to 18 to 19% of India's mutual fund AUM. So it's grown significantly. And we're also seeing that, it used to be mostly, institutional participation that was there in passive funds. But since COVID, we're seeing increasingly, adoption of passive funds towards retail and also HNI investors. So overall, we used to see a very narrow acceptance of passive funds, but as of today, I think it's happening from all over. So I think there's a growing awareness of passive funds coming in, and we believe that today, most investors, are probably, looking at having one or two passive funds in their portfolio, at least the equity part of the portfolio.
Oh, absolutely, and the numbers are staggering, right? The rise of passives has also been nothing short of extraordinary, because some of those numbers, and they're on the screen as well. Over 6x of an increase, 6 times of an increase from just before COVID to now. So the adoption is also, really on the rise. Aditya, let me ask you, I mean, what do you feel when you see things around? A bulk of this passive AUM is still in the very simple funds, right? The funds which are mirroring the Nifty 50 or the Sensex. But what are the trends that you've observed over the last couple of years?
No, I think rise of passives is actually a great news for our industry. It just shows that Indian investors maturing. But I would say that last at least 12 months, the hero has been the gold inflows into gold ETFs and gold-rated index funds. And passives by nature is meant to be a simple product. So it's great that the products that are getting adopted for their simplicity. So, for example, Nifty 50, we all know, but gold also, if you look at it, essentially it's tracking commodity prices. So an index fund or a passive low-cost fund is the best way to sort of invest in it. So I think I'm really encouraged by the fact that gold, which is the second largest asset class after real estate in India, is actually finding its way into financial products through the way of the simplest financial product that is, an ETF or a fund of fund that holds ETF. So I think that's something that definitely is very encouraging. Obviously, as you mentioned, there have been a ton of new launches on index side, especially in 2025. And, where there are various strategies that we have seen, thematic, multi-factor, single factor. But yeah, I mean, those are, I would say wait and watch, because I think in my mind, simplicity is the single biggest feature of index funds. And that is what, customers are adopting right now for.
Yeah, absolutely. In fact, let's pull up the data. Just the flows coming into passive funds, again, illustrates the point that the investor is getting far more nuanced. and wants to look at products which are low in cost and offer perhaps similar returns as the index. So this year alone, if you look at the monthly data, in May, the average flows were around 5,500 crores. It picked up in July to about 8,000 crores. August, the number crossed about 11,000 crores, 19,000, 16,000. And November, the total flow, that's index funds, that's specifically index funds. But if you look at the overall flows coming into passives, then the latest numbers are reading closer to 15,000. So very steady flows coming in at a time when the equity market has been, fairly volatile and range bound, one would say. Now, Prateek, we all know that cost is a huge advantage, right? Passives typically, also tell us, I mean, you're on the manufacturing side of it, so you'd have the numbers at the back of your hand. But typically for ETFs or index funds, costs are in a few basis points here and there compared to what, 2.5% average expense ratio for actively managed funds?
Yeah, so I think a big draw towards, I would say, passive funds is cost. That's one of the draws, though. It's not the only one. I think the biggest draw, I would say, is simplicity. What Aditya said, I think today, because of the plethora of funds out there, if someone wants to buy a mid-cap fund, they don't have to choose between, 5, 10, 15, 20, 50 mid-cap fund. They can just buy the mid-cap index and, invest it. So I think growing awareness and also low cost and also I think simplicity is, pretty much a good reason. Also, what we're seeing is that, if you look at Indian markets today, they're a lot more efficient than it was, say, 10, 15 years back. So the sort of outperformance that we've seen, especially in the large cap side, has been quite muted, especially in mutual funds. So, for example, in the last 5 years, there has been more money that's come into passive large cap schemes than active large cap schemes. Which shows that people are looking at performance a lot more strongly. People believe that low cost will probably lead to a situation where they might end up making higher returns. It's also a simpler strategy. When I talk to investors, when someone wants to invest for say 15, 20, 25 years, it's very hard for you to really select one particular product. I think if you go passive, it's pretty much going to be there. If you look at the US, the S&P 500 index, which is the world's most popular passive fund, has been around for half a century, 50 years. And, I think whoever's invested in that has done pretty well. So I think the growing awareness, also obviously low cost is a big add-on. Although I would say that, low cost is probably not the main reason. It's probably returns, and people are seeing that the returns between active and passive are fairly comparable today than they were, say, 5-10 years back, and I think that's where the demand is.
So it's the returns mix and the cost mix.
Yeah.
On returns, actually, let's pull up some data, and this is always extremely interesting. Now, viewers, is something called the SPIVA report card. It's S&P indices versus active. Now, this is basically an industry study that's put out twice in a year, where the provider of the study compares the performance of actively managed funds, where there's a human being involved, so there's a higher cost involved, versus simple passive funds that are only mirroring the index. Year after year, this study has been indicating that the underperformance of active funds is diminishing, or rather is increasing, and the outperformance is diminishing. And the numbers are on your screen as well. This is the 2025 mid-year report card. According to the SPIVA report, 65.6% of large cap funds underperformed over a 6-month period. But let's look at longer term. We typically invest in mutual funds for 3 years, 5 years, right? So on a 3 or 5 year basis, the underperformance of large caps is 66% in 3 years, 89.7% over a 5-year period. So that is what I guess Prateek was alluding to, that this underperformance is something that people are beginning to question. But Aditya, weigh in on this performance debate. The active fund managers typically argue back, saying that at least in the mid-cap and small-cap market, there is a lot of merit in going with an active fund over a passive fund. However, there are passive mid-cap funds, small-cap funds galore. And that's where I sometimes wonder what's the right approach. What would you say?
No, I would go for active fund. So by the way, just a word on the SPIVA, right? Because, in India, as we know, SEBI rationalized indexes, only a few years back. Whereas SPIVA uses a mix of indexes, so I wouldn't really go by the long-term benchmarks comparison with SPIVA. But yeah, it's still a very good heuristic to use. I think active, because, Prateek, I think mentioned it, that we are still, as a country, we are a developing economy. There are still inefficiencies in the market. And that inefficiencies allow a fund manager to actually show his or her mettle by doing the right kind of research, doing the bottom-up research and finding gems which will get lost in an index fund just because, they can only sort of mirror what their actual weight in the index is like. So I would say that, for mid cap, small cap, even thematic, I still am a firm believer that active fund managers can really create that alpha. And whatever extra we are paying in terms of expenses, that they more than justify by creating that 3 to 5% alpha sometimes. And, I think if you look at even that Favour report, even the 1 year, 2 year data that you have, 70% mid and small cap funds end up outperforming the index. So I'm personally a firm believer. And that's what, by the way, investors also, when we have that conversation with investors, they also kind of buy that pretty reasonably. That I understand that, if a fund manager is convinced about a mid-cap stock potentially becoming a large cap tomorrow, they can take a much larger bet on that stock versus where an index where everybody is treated equal. So active and small and thematic, I think these three areas is where I personally would bet my own money also on active fund managers.
Okay, so there you go. You're hearing divergent views, and that's what a lot of industry experts have been telling me through the years. It's not active versus passive. It's active and passive. You have to have a great blend to have a smart portfolio that's cost efficient and yet delivers the desired returns. Now, how to build this perfect mix, this perfect cocktail? This is exactly what we'll discuss with our experts after the break.
Let's talk money. Let's talk money.
Welcome back. You're with us on Let's Talk Money. And this week, we are talking passives, how to have the right passive portfolio in place for 2026. And remember, when it comes to passive funds, there are so many categories. Equity is just one of them. Then you can buy gold and silver through passive funds. You can get into foreign equity through passive funds as well. So there's a wide variety of choices. We just need to know how to pick and choose. So I'm going to ask both Prateek and Aditya to now don advisors' hats, as if you're advising people in your friends and family circle, and help us make that portfolio. And it's a complete open canvas. It can be an all-passive portfolio. It can be a blend of active, passive. But let's hear out our experts' views. So Prateek, why don't you go first? For 2026 and beyond, if you have to devise a medium risk portfolio for someone in their late 30s, early 40s, how would you go about it?
Yeah, so if you look at portfolios today, almost for most investors, most investors would have close to a 0% allocation to passives. And I've always believed that in a country like India, like Aditya said, you should have a balance of active and passive funds. In fact, I'm almost on his side, where I believe more of your portfolio should be in active, because there is a lot of opportunity for outperformance in active, especially in mid and small caps, which is where I think companies are growing at a much higher pace, and the scope for stock selection tends to be much higher. So if I had to build a portfolio, and this is obviously very generic advice, I would probably do 50% active, 50% passive.
Okay.
In passive, I would keep it super simple. I would do a Nifty 500 product, which is
Nifty 500 broad.
Yeah, it's my favorite product, to be honest. It's
okay.
If you ask anyone at MO also, they'll say it's the best product.
And why so?
It actually follows so if you look at the philosophy of passive, if you look at guys like Vanguard or Jack Bogle, who sort of created this indexing as a philosophy, the philosophy says buy the market. And I think the best representation of the market today is Nifty 500. Unfortunately, Nifty 50 is not a very good option. In fact, it's the worst option because it does not represent the market anymore. So even you guys, when you talk about indexes, you guys say Nifty, but you also talk about small and mid-cap indices. So, both have very different. So I think if you're able to buy a broad-based index that covers the entire market, I think that is good enough for your passive portfolio. So Nifty 500, say if you're, I'm a big believer of international diversification. So there's something as simple as an S&P 500 would be adequate for international diversification needs.
Okay.
And maybe a 5 to 10% holding in gold and silver. So combination of gold and silver. And maybe 15 can be active, mostly mid and small cap, I would say. So that's a good mix when it comes to portfolio construction.
So a broad market index to play India, passive. Broad market index to play one of the biggest global markets, that's the US, S&P 500. And passives to play gold and silver.
Yes.
That's Prateek's recipe. Very interesting and quite convincing, I must say. Got that. Aditya, your turn.
Actually, this is exactly what I was going to say as well.
Wow. So, our panelists agree.
If you're a DIY investor, it makes sense to maybe go 60% passive, right? And 50% in a broad market index. It could be a mix of Nifty 100 and Nifty 500. And 10% gold or silver, whatever is your sort of preference. Because, especially I would say gold is, more like cash. So it's like holding currency in your portfolio. And the remaining 40% can be a mix of actives, where largely mid and small. And, if there is an opportunity to diversify in the passives, then probably 10% towards internationals, because I think internationals as a space will keep growing. I hope that AMCs also launch more products where we go beyond just US, because, there are several markets where there are growth opportunities and which are underpriced. So yeah, I would say I would broadly agree with Prateek on that construction of that portfolio.
How lovely. We have, unanimity of views on the table over here. But, okay, let me, drill a little deeper then. Aditya, both of you, like investing in international markets through passives. But help us out here. And lots of viewers write in because hardly any funds are open because of that, industry-wide $7 billion cap. So if someone wants to take global equity exposure, which are the passive funds that are taking money?
Off the top of my head, I think there are. Prateek, is your AMC taking money in international funds?
No, not really. Unfortunately, not.
Yeah, that's the problem, right?
Yeah, it's
a hard one to keep track of.
Yeah.
It's a hard one because some AMCs stop, then they start again. And I think there were a couple of NASDAQ 100 ETFs which were open for subscription. But as I said, it's a very dynamic environment. It's very hard to pinpoint right now exactly. Top of my head, I don't remember which one.
Okay, no worries, no worries. We'll come back and revisit that topic. It's one of the most often asked questions to me as well personally, and people writing in saying, how do we invest in global markets? Very few routes available here in India, at least through the mutual fund route. But gentlemen, we haven't touched upon the so-called smart beta or the multi-factor products. Now, again, for viewers, quick crash course, how human fund managers decide on certain filters and then they select stocks. It could be a fast-growing company. It could be a stock with a lot of momentum. Or it could be a value stock where the valuations are extremely low and extremely cheap at this point in time. Similarly, these factors or filters decide how a factor-based passive fund, rules-based fund selects stocks. So Prateek, help us understand this because there are a lot of these factor-based funds that have come up in the last 2-3 years. What do you think of them? Are they suitable in the Indian context? Do they get too complicated? Because neither of you, singled out factor-based funds in your perfect passive portfolio.
Yeah, so, personally and also as a, as an AMC, we are very positive on factor investing. I think it's, we've invested a lot of, research, R&D and a lot of effort in sort of educating people on the benefits of factor investing. In fact, if you look at global markets, the biggest category of investing is your broad-based indexes like S&P 500 and NASDAQ. The second biggest category is actually factor investing. Active funds come after that. So it's a very massive space globally. We're seeing in India also, if you look at factor funds, I think if you're looking at close to 40 to 50 times, 50x growth in AUM in the last 5 years, 4 to 5 years time. And we're expecting this category to grow at the same pace going forward. So there's a lot of interest coming in factor investing. We believe that factor investing comes in between active and passive investing. Even though the construct is passive, the expectation that an investor should have is to outperform a broad-based benchmark like a Nifty 100, Nifty 500, which it has. If you look at performances of most of these factor funds, there are four. I mean, there are many factors, but the four most popular factors are momentum, value, quality, and low vol. All of them have really outperformed over the long run. However, having said that, there are, just like most active funds, there are also periods of underperformance. So, we would definitely suggest a portfolio of factor funds to any investor who's able to put in the time and effort to understand.
Because then you have single factor funds and some of them combine factor. There's low volatility and then there's momentum and a lot of things coming together. So at times it gets a bit much. But from your perspective, what kind of factor-based funds make sense?
I think the ones, the multi-factor ones tend to be the least volatile in terms of performance. So I would say any strategy which combines factors, investors tend to have a slightly better experience. But we believe that, factors can be added to the portfolio as a single factor. So if your portfolio, for example, very few portfolios have a momentum exposure. They tend to have a very high exposure towards quality and maybe growth and maybe value. Momentum is sort of missing, so maybe a momentum factor can come in. Or if some portfolios don't have a value strategy, it makes sense to have a value factor. So you can either combine it as a standalone strategy or you can add it as a complementary fund to your existing portfolio. So both ways work.
Yeah, but it sounds like something you'd want to discuss with your advisor very clearly. See what complements your portfolio. There are no straight answers here that kind of fit the bill. It's very portfolio specific in terms of what you already have and what is it that you're seeking in terms of returns. Aditya, coming to you now. Final thoughts, throw in a word on these factor-based funds, if you will. And then the most important question, 3, I was going to go with 5, but I'm going to say 3 passive funds that everyone should consider in the new year.
Oh, that's a tough one. So anyway, so on factor, I think, idea of index funds is to simplify. Index funds are ideal for DIY investors or large portfolio investors. So by looking into factors, you are again introducing sort of a variable where you have to look into your portfolios on a regular basis because every factor goes through its cycle, right? So it just adds that extra bit of complexity, and the whole purpose was to keep things simple, to earn market returns, and certainly introduce a variable where you have to spend that much more time on rebalancing your portfolios, every once in a while. So that's why I'm not a big fan of factor strategies. It's better to sort of trust active fund managers for stock picking. In terms of funds that you could pick for 2026, I would say that MOSL has a pretty good basket of index funds. So while mid-cap and small-cap, I personally prefer active funds, but I do have personal allocation towards mid-cap 150 as an index. And definitely Nifty 500 is something that could be a part of your portfolio. And I think gold and silver continue to remain as index funds, which can be considered. So it could be Axis Gold Fund of Fund that can be considered as an index fund in your portfolio. So I would say those are my 3 picks for 2026.
Okay, all right. Very interesting conversation and a very helpful one as well. I think it gives everybody a lot of food for thought as we look at our portfolios fresh after the New Year party and then decide how to start incorporating passives bit by bit. Thank you very much, Prateek and Aditya, for joining in, and wish you both seasons greetings and a fabulous 2026 ahead. Thank you for joining.
Thank you so much.
Thank you so much. Well, that's it on this week's edition of Let's Talk Money. Keep sending us your feedback, comments and queries. And we're not done yet. We will be meeting again before the new year. So see you again next week.
Let's Talk Money.
Well, over the past few years, I've had the privilege of interviewing Mr. Anil Agarwal annually. In 2025, we had almost missed out until NCLT's approval of Vedanta's demerger proposal became a defining moment. So rather than wait till 2026, this milestone calls for an immediate discussion. We're therefore pleased to have Mr. Anil Agarwal, who joins us on the show. Well, Mr. Agarwal, first, congratulations, sir, on the NCLT approval after a brief delay. You know, the street was waiting by, and the NCLT has given the green signal. So congrats to you as well as the team.
No, thank you very much. I'm grateful and thankful to the NCLT and the judiciary and the entire government, and everybody was together, and we are here today.
All right.
I'm very thankful to each of them to help us to be here.
All right, Mr. Agarwal, NCLT approval has come through, but there are a few unanswered questions. So let's get straight to that. What's the expected timeline for completion of this demerger? And by when can investors have, the new entities to be listed by your expectations?
It should take normally 3 to 4 months. And we believe by March, this should be done.
Got that.
We will not leave anything unturned to make sure this happens.
March 2026 to April 2026, 3 to 4 months from now on should be around then. We got that, sir.
Yes.
But with the demerger underway, does Vedanta now, you have the option of divesting or monetizing an individual asset? Could steel be one such candidate that you could look to divest?
It's too small to talk. We are in big picture. Let's talk about big thing. I know this is a process. If demerge identity and CEO, they say what need to be done, they have to restructure it. But let's look at, I want to remain on the top level.
Okay. And at the top, sir, you have done a good job actually in the big debt reduction at Vedanta Resources. I think that's nearly halved in the last few years. What are the debt reduction targets from here on Vedanta Resources? That's already down by half.
Yeah, we have very structured program. Whatever the this is happened all the multinational company in the world. So this is a structured program, and in 3 to 4 years' time, we'll be completely paid off all the debt on VRL.
Got that? All right. So in 3 to 4 years, we could have, Vedanta Resources that will be debt-free. Got that. Now, if you could tell us, sir, how big is this entire value unlocking exercise for Vedanta Limited? If I look at it, the current market capitalization is ballpark around 2.2 lakh crore odd. In your view, what should be the group's sum of all parts valuation once this demerger is completed?
See, this is the need of our India is growing 1.4 billion people. There is no other place like this. And we are in a sector which is growing almost double digit. This is a win-win for everybody. This is a win-win for everybody. I'm looking for thousands of industry comes because we produce raw material. Whether it's the aluminum, copper, oil and gas, zinc, anything you talk about, we produce. And these are growing tremendously to be processed. So each of this identity can double the production comfortably because demand supply gap is there. And we can do brownfield expansion, which is going on each of this sector. And we are going to produce most of our production now through the renewable power, which will be the green metal. We will produce green metal, very, very keen. So looking at that, we are going to produce oxygen-free copper. We are going to produce aluminum, alloy, which will be used for every sector. So each sector has a tremendous scope, and it's end-to-end. Whether it's a mining, 3-4 processes, then smelting, and then value addition.
Right.
So this is the I feel that the all of us, again when I'm using the word, is going to be 100% double capacity of each of our business.
Okay. Got it. All right, Mr. Agarwal, as you're saying, you're focusing on backward integration. There is a lot of focus on the cost side, value addition, and you have the tailwind in terms of prices as well. There's a bit of a melt up happening on metal prices. Currently, the company is valued at around 2.2 lakh crore. But there's going to be a sum of all parts, once these entities are separated. According to you, what could the value unlocking opportunity be? If I sum all the parts of all these individual listed companies in the next few months, what could the approximate market capitalization look like from around 2.2 lakh crore?
I'm working towards each company should be the Vedanta. Same value, I'm working towards that. It has that kind of potential. It has a tremendous potential. We have a phenomenal asset, technology. We're working through latest technology. And I have no doubt that I can't say no doubt in the sense we are working towards creating each company to be valued what Vedanta has today.
So each entity could probably be valued at 2 lakh crore odd. That's the ambition, that's the aspiration.
And that's a fact. Because we have the asset and there's a demand. It's not that we are producing, either we have to import or we have to fulfill the demand. I have the resources, I have the complete organization, and I have all the machines, we are working on it. And if we don't do it, we'll be full.
Got it.
We'll not do the justice for India and for the demand.
Interesting. Each vertical could be valued at 2 lakh crore. Well, let's see how that goes. Well, one quick question, sir, with regard to how comfortable are you? You all had said, I've spoken in the past to the Vedanta management, asked them about these corporate guarantees that will have to be furnished to get this demerger going through. And they have sounded fairly confident. Now the tick mark has come, but some corporate guarantees will have to be furnished. Comfortable on that front?
Yeah, it's a small thing. This is whatever is required in the process. We have to work with the system in India, and I find that the India's ease of doing business is in a very high scale.
Okay.
Everybody understands this was the largest probably demerger happened in India. So this is not a matter to talk. We'll take care.
Okay. All right. What about copper, sir? What are the long-term plans for Konkola, copper mines, KCM? Is there a possibility of KCM being merged into the listed entity Vedanta, or for now, that's not on the table?
At the moment, we are talking 5 companies. Konkola is not part of it. Konkola has a separate company, so we can talk about Konkola has its own plant. It's a beautiful copper deposit in Africa. And we are contemplating to list at very high demand because the critical metal and high demand in US market. So we will be contemplating to list at the US, but we'll talk separately on that.
All right. That has nothing to do with the current listed entity for now, but probably listing that copper asset at some point of time is something that you could look at. Got that. What's the outlook, sir, on silver prices? In the medium to the long term, silver has been a big outperformer. Do you see meaningful percentage gains on silver from here on? Or do you believe silver, now it's broken up after 45 years, it could be actually a multiplier rather than percentage gains from the current levels?
See, what we are doing what India needs. India never produced silver. We are the one who did the tremendous bringing the technology, because there was no technology available to separate the silver. So we started working, we started producing small tonnage here and there. Now, what we have planned, we are going to, today also we are catering about 25 or 30% demand of India. I'm looking forward to cater very keen to 100% demand of silver of this country. That will create at least 1,000 industry and the small player, jewelry player. I'm looking at job creation. The silver will create tremendous job creation and we'll be able to not spend foreign exchange to cater our demand. And today we are producing about 800 ton, but my aim is to produce 2,500 ton silver, so we can cater the demand of India.
Okay, all right. 2,500 tons by when?
Maybe 3 years.
Got it. Final question, sir, before we let you go. The street always gets a little bit cautious. They believe Mr. Agarwal is very aggressive. He's very ambitious. But they're a little bit cautious because sometimes, you know, the ambition is to go into an unrelated business. Any plans on that front, you know, getting into something that's unrelated to the current businesses that you are in?
I am the only one, last 30 years, 35 years, I have not changed my business. I always remain business of starting with the cable and move into the raw material. And till today, not a single business you can say they have not diversified, but we never diversified. We always remain 95% our business is below the ground. So we are entrepreneurs. When some opportunity comes, we look at, we evaluate how can we create value for our shareholder. But fundamentally, our record says we have never changed our business.
As of now, there are no new business verticals that you're looking to get into. Is that correct?
Perfect.
Well, Mr. Agarwal, always a pleasure talking to you. Thanks a lot for joining in on CNBC-TV18.
Welcome back to News Center. The government has notified the scheme for manufacturing rare earth magnets as reported by us earlier. What's next now? The government could invite bids for the scheme. As per sources, this should take place as early as January next year. Interested bidders will have to submit a detailed project report to show technical capabilities, indigenous expertise or global tech tie-ups. An inter-ministerial group supported by India Rare Earth Limited, Bhabha Atomic Research Centre and CSIR will soon be set up to frame the bid criteria. Startups, established companies, first-time players are all likely to be invited to bid for the scheme. As of now, companies like Intellis, Ashwini Magnets and Midwest make rare earth material in India. To understand what these players make of the scheme, which has now been notified by the Government of India, I'm now joined by Soumya Kukreti, CEO and Director, Midwest Energy, with Midwest Advanced Materials as well. Thank you very much, Soumya, for being with us. How do you think this scheme, which has now been notified, will incentivize the private sector to set up supply chain in India?
Yes, definitely the scheme is very helpful and it's coming at the right time, I feel. Midwest has been working on rare earth for the last 7 to 8 years and we're getting into production now. And I think the timing is perfect. And as a capacity, yes, we need, I think, somewhere from 5,000 to 20,000 tons as a country. But to start with, I think this is a perfect scheme and perfect timing from the government.
All right. Could you give us a sense that when it comes to Midwest Energy and Midwest Advanced Materials, what is your progress in terms of making high rare earth magnets in the country? How far are you from operationalizing a manufacturing plant?
So currently we have set up a 500 ton per annum finished magnets plant. That's from oxides to the finished magnets, which is at the final leg of it. And February is when we go on production scale, complete scale. Right now trial runs are running. And we also approached OEMs and we've given us samples and all that is done. And the next step is we are going to have a 5,000 ton plant in like 24 to 36 months. That's the plan. And we will be focusing more on the heavy rare earths and the high quality magnets.
Right. Could you also give us a sense on whether Midwest is going to be applying for the rare earth manufacturing scheme of the government?
Yes, we will be applying for it.
All right. In terms of the kind of investments you've made in acquiring technology, getting the machinery in the country, could you give us a ballpark figure on what's gone into getting the plant ready so far, and how much are you looking to raise in the next few years?
So far for the 500 ton plant, we've spent about 250 crores. And for the next 5,000 ton plant, we're looking at 2,000 crores. And we will be raising in the sense we're already listed technically. We have reverse merged into a different company, which will be live in January. So we'll be raising some funds from there as well.
Right. It has also been said that when it comes to manufacturing rare earth magnets in the country, while there is a lot of rare earth as a raw material in India, we do not have the refining capacity, neither do we have those technology partners. How are you bridging that gap?
So Midwest as a backward integration, right now this is like we are in the forward of the value chain and the backward, we're going back to mining. So we'll be doing mine to magnet, and we do have a technology to refine and to mine. And we're looking at about 24 months from now, we'll be complete mine to magnet in-house.
Right. Could you also give us a sense if you have foreign technology partners, whether they're European or Japanese for that matter, or the US?
No, we don't have any foreign collaboration. We're completely in-house and with some of our Indian corporations as well, Indian technologies as well, but it's completely Indian.
Okay. Could you also give us a sense of what is the domestic demand like as of now? How is it set to increase in 2026 and beyond that? What are the kind of industries, the companies that you would like to cater to?
So right now the demand is anywhere from 5,000. It's really not exact values, but somewhere from 5,000 to 20,000, big range to talk about. That's the demand we're looking at. And the industry is looking at mostly automobile, wind, the MRI segment. These are the main industries where we're looking at of catering magnets to.
Right.
And also for automobile, we would like to create new grades as well. Just not the standard grades, because when we came up with the client, when we met the OEMs, a lot of other demands we have seen. So we will come up with own grades as well, working with them closely with the industry.
Soumya, what we'd also like to understand is that how will you be cost competitive compared to imports from China, imports from Japan, or any other geography for that matter?
Yeah. So any other geography, I'll just keep China aside. Rest all, I think we can compete easily because they are much expensive. China is the world leader and they've been there for many years and the quantities are huge, the volumes are big. Right now, we cannot compete with them, definitely not. So when we did our numbers, we started as a 500-ton small plant, pilot plant, and then we thought we'll do 2,000, 5,000. But our numbers were, I think at 5,000 ton, we will match the Chinese, but we'll also better the quality than them at that point. That's our target.
All right. So what is the kind of initial cost per magnet that you would be going to market with next year?
So cost of the magnet is something like varies on grade, the size, the end use and everything else. But right now, I think we'll be around 20-30% higher than Chinese price.
Okay. Just to also understand from you, what perhaps is the most difficult aspect of setting up a mine to magnet plant in the country and having this capacity here in-house?
Actually, frankly speaking, everything. Every part of it has been very difficult. It's so technology driven. So much of learning went into it. So many problems to solve. It's a day-to-day firefighting thing what we have done. And whatever we've done till now, I think it's a very meaningful journey. And I think we're going to reach the end of it. So, and then more to do. There's a lot of R&D still coming up. A lot of things we want to change and we want to better China in. So definitely we are working towards that.
And what about
ongoing,
your Okay. What about your raw material sourcing? Where is that happening from?
So initially we will be sourcing from IREL, the oxides, and then unfortunately India doesn't have HREs and we need a lot of HREs. That's where we are working on right now. Only China controls most of it. As I said, we want to be mine to magnet in 24 months and we have some concessions around and we're also looking for more. And we will be self-sufficient with our own HREs in next 24 months.
Right. When it comes to equipment that you're using for refining the rare earth and making magnets, where has that manufacturing setup really been imported from?
So we have not imported any machinery as such. We have actually designed the plant and components have come from various parts of the world, from Japan, Taiwan, China, Europe, multiple places. And we've all designed and made it in-house. It's all in-house built. It's all made in India, technically.
Right. Could you give us a sense on how the rare earth risks are going to either subside or increase in 2026? Because we saw China clamping down on rare earth magnet exports April 2025. For India, they've still not lifted those restrictions. In fact, some companies have been given licenses, but they've not received the consignments, is what we hear. So how do you see the risks in 2026? Are the risks going to increase or are they going to ease up? How are you able to map the global supply chains of high rare earth magnets right now?
So for high rare earth, I see it's a big risk because I don't think China is going to open up that easily for the heavy rare earths, especially. The non-HREs, I think they'll be okay too because they're already producing too much. The risk, definitely there's a risk every time because whenever they want to ban, whenever they want to give. So I think we should just get self-sufficient. And as the government has given the scheme, I think now more will coming up. We cannot cater to everything. It will take at least 5 to 10 years to match up the demand. But I think we have no options, I guess. We just have to work towards it.
All right. My final question to you would be, what would be your expectation from state and central governments in terms of supporting the ecosystem to allow you to be cost competitive? Because if the industry has to be successful in the long run, you have to be able to provide magnets at the highest quality and at the most competitive prices.
Right. So the PLS scheme in principle is pretty good. It's right timing and all. But the only thing which we feel the drawback is the 1,200 ton capacity, which they're capped at. Because with that, definitely the costs are going to be higher and we cannot even meet the R&D because a lot of R&D has to go in. We definitely would request the central and state government more of R&D work to be done. So if some incentive can be given on the other side, because we ourselves in-house spend more than 30 crores on R&D. So we are going towards that and to betterment the product as well. So I think it'll help if they can incentivize more on maybe on the upper limit of the production capacities or on the R&D, something together. Because a lot of ecosystem has to be developed for the magnets in India, which is just starting now.
All right. Thank you very much, Soumya, for joining us with the story that Midwest Magnets has for the rest of the country, and what more can the government do in order to incentivize the ecosystem so that companies like yours manufacturing high rare earth magnets can do so at competitive prices. With that, it's a wrap on this edition of News Center. More news and updates continue right here.
CNBC-TV18 Insurance Dialogues with Kotak Life.
Welcome to Insurance Dialogues. Insurance has become an important part of India's financial landscape, one because of a rising middle class which has understood the importance of planning for retirement, and because of the thinning down of the extended family system and the rise of nuclear families. But most of all, insurance has become important because the government has given its full backing by cutting all GST on insurance. Today in our Insurance Dialogues episode, I have with me someone who is best placed to tell us the journey of insurance in India, life insurance in India. I have with me Mahesh Balasubramaniam, Managing Director and CEO of Kotak Life. Mahesh, thank you very much for joining us on Insurance Dialogues.
Thank you, Lata. Thank you for having me on the show. and it's a pleasure to interact with you and all our viewers. It's a very, very important year for Kotak Life Insurance. First of all, we are celebrating our 25th anniversary as a company, and it's a time where we feel a lot of gratitude. At the same time, we are delighted that so many customers have reposed their faith on us, and our journey of building trust and credibility and sustainability continues.
This is 25 years. What is the one quality that, or one or two qualities that has sustained your company for these 25 years?
First of all, I think the brand name Kotak signifies a lot in the market today. And I think we have stood by the Kotak values of building trust, credibility, and sustainability in whatever we do. And also by making sure that we conduct ourselves as a responsible financial institution. I think that legacy, that core values of Kotak continue to be embodied by all the institutions in the Kotak group. And Kotak Life operates with that focus as a North Star for us.
Oh, absolutely. I mean, when you have the word Kotak, trust comes with it. So I can see, that must have been very helpful. Let me come to where I began. The government itself has put its backing, given its backing to the insurance industry by cutting all GST on it. How do you react to that?
No, I think it's a landmark move by the government. And we in the insurance sector are indebted to the government for, first of all, making sure that this product sector called insurance is affordable to millions of people. The way I look at insurance is, I'm sure you and I are from the same generation. There were movies called Roti Kapda Makan at some point of time. Then there was Bijli Sadak Pani as one of the things that was spoken about. I think now today it's Wi-Fi. And one more important thing along with that is Bima. Right? It's very, very important. Life insurance and insurance as a subject matter is very important for people. And I think the government is really, we're thankful to the government for understanding this and bringing about financial inclusion in the insurance sector by making sure that the individual life insurance premiums are completely exempt. This is going to make sure that the products are more affordable. I'm sure this will also raise a lot of awareness about insurance in this country. And end of the day, if you all have to move towards insurance for all, which is one of the motives of the 2047 Viksit Bharat objective, I think this is a very important stepping stone for that. And we in the industry are extremely grateful to the government for paving the way for better financial inclusion and making sure that insurance penetration and density in this country grows in leaps and bounds.
Absolutely. I mean, 18% less in our premium is definitely going to attract, that percentage more of people. Now, let me come to, the way people approach insurance or the way you want them to approach. Do you think that the industry should, or even Kotak Life, should concentrate more on looking at it as retirement planning rather than a financial product?
No, insurance actually signifies multiple things. First and foremost, let me go back to when we celebrated 25th year, right? 25 years in a life insurance context is actually few steps. At the core of this, therefore, lies offering customers protection. And life insurance plays a very important role in preserving what you have. While India is chasing a lot of growth and instant gratification, and a lot of other things are coming in with F&O, and people today like Blinkit. We are in a Blinkit and Swiggy world where everybody expects instant gratification, right? But one thing that people need to really remember is that preservation is at the core of whatever we do. Before you grow, you need to preserve what you have. And preservation, protection, and inculcating a culture of long-term savings is what life insurance brings to the table, right? And today, this is something that is a little bit neglected by people because they don't understand the value of protection. Protection and preservation means what? If you are not there, what are the two risks that people face? One is dying young. Second is living long. India today has an average age of 28, 29 years. I think we are the youngest democracy in the world, youngest country in the world, right? Which also means that our GDP per capita income is growing. We are right now at about $2,400. Maybe it will become $4,000 in 2030. There is rising expectations, rising aspirations. Human value is going up in India. And therefore, if you're not able to protect it when you're not there, what happens to your family? What happens to their lifestyle? What happens to the children's education? So the what if is a very important question which needs to be answered. And life insurance provides you the opportunity to make sure that you're prepared for all the eventualities. As we call it, it gives you the hostla to go and face your life hamesha. Right? So the hostla comes from life insurance. And therefore, the preservation aspect is something that is very critical. And preservation, as I said, is protection. Protection from dying young, which is term insurance. Protection from living long, which is retirement. So India is one of the most underinsured markets globally. If you look at a population of 100 people who probably need retail individual protection, it'll be surprising for you to know that 85% of the people do not have the cover for retail individual insurance. This is called a protection gap, and this gap is assessed at about $17 trillion in India today, right? At the same time, the life expectancy is going up. On the other hand, you have people growing older, right? By about 2030, about 190 million people would be, or close to 200 million people would be reaching the age of 60 and above, who will also require retirement solutions. So the retirement gap is a whopping $85 trillion by 2050. So that's the kind of gap we are talking on living long and dying young. Then there is a third dimension of people who are borrowing. India is a consumption-led economy, and we know that the total advances in the banking system is close to about 190 lakh crores as put out by the Reserve Bank of India. And approximately 30% is retail advances, which would make it about 60 lakh crores. Then we have a whole host of NBFCs and other institutions which are also lending in the individual space. So the overall credit life insurance, where people take an insurance to protect themselves against what you call death. In the event of death, the loan gets repaid. That's the product called credit life insurance. So there again, if the credit market is growing at anywhere between 13 to 14%, that market is going to keep growing as well. So overall, I think India needs a lot more focus on protection, both for the young people and also for the aged population. And we all know Japan today, Korea, all these are aging population. And the government is facing the brunt of having to manage the burden of providing for such an aging population. And also you should realize India is a largely self-employed country, right? In fact, on the global pension index today, we rank a very low 45 out of 47, right? The largest gap is the adequacy of income, adequacy of pension that you have, which can take care of your years behind after your retirement. And also, while retirement sounds like a feeling where people say, okay, I'm done with my life, I think with affordability going up and aspirations going up, people call it second innings now.
Actually, I was going to ask you that. I read in one of your products that people after retirement don't look like they're signing off. Many of them are willing to start something afresh. So you'll work that also into your
Absolutely.
products?
60 is the new, 40?
40.
Right? That's what everybody is looking at. So I think our products therefore need to be designed to make sure that we are able to provide the customer enough corpus which is generated in his earning years so that it can take care of not only leading a happy life, leading a contented life, also leading a happy life where he wants to travel abroad. And today, if you look at the developed economies, I think the retired population contributes a lot to the lifestyle consumption of services, right? So I'm sure more and more Indians would want to travel abroad, would want to experience the luxuries of life which they missed out in their earning years. And with nuclear families coming in, I think they also feel the responsibility to provide for themselves, because I don't think today the society is moving in a direction where you're finding more and more elder care centers coming up, geriatric care coming up. I think Indians would like to be Atmanirbhar in terms of taking care of their future retirement rather than depending on their kids or children or grandchildren to take care of them. I think that is where the life cycle planning is very important. And the retirement solutions today that we are working on, along with most of the other industry players, is to make sure that the lifestyle of the customer continues uninhibited beyond the earning years.
Okay.
And for that, you have to plan today.
Oh, yes. I have to take a break at this juncture, but no conversation on life insurance can be completed without the two magical words, artificial intelligence and data and digitalization. Those questions to Mahesh Balasubramaniam after the break.
CNBC-TV18 Insurance Dialogues with Kotak Life. CNBC-TV18 Insurance Dialogues with Kotak Life.
Welcome back to Insurance Dialogues. I've been speaking with Mahesh Balasubramanian, the Managing Director and CEO of Kotak Life. We spoke about what were the values that have brought Kotak Life to this 25th anniversary of theirs. We now want to talk about other issues like, importantly, artificial intelligence. So Mahesh, that's where we pick our conversation back. To what extent are you able to integrate artificial intelligence in your choice of customers or products?
Well, actually, the core of life insurance industry over the years has been analytical science.
Yes.
Because life insurance is all about predicting
Actuaries.
what is going to happen. Actuaries is all about analytical science. So analytical science embedded with machine learning and artificial intelligence goes hand in hand in terms of the way the industry will progress in the future, right? Today, in fact, AI we want to use in such a manner that it helps us in better quality of decision making, speed at which we take the decisions, because data analytics can really help you take better qualified decisions, and it takes lesser time than what you would have normally taken.
Yeah.
So these are two areas which are driving our entire approach to AI. Beyond all that, I think putting the customer at the center of what we do, bringing in the empathy quotient where customers feel the difference because of the use of technology is something that is very important. And that is where across the life cycle of the customer, right from customer being a prospect, where we use artificial intelligence today, we have started using in preparing customized bespoke pitches for the customer.
Okay.
Right? I know about you, so therefore can I use AI to prepare a customized product pitch for you, which is relevant to you. Starting from that, giving those sales aids and on call tools to the sales guys to go on the front end and offer our propositions to the consumer. We use a lot of digitization in the entire process. Okay. Today, I'm almost the entire industry, including us, I think we are all ready and we do issue policies without collecting a single paper. 100% digitization is there. And not only at the point of onboarding, you want to settle a claim, you want to get your maturity payouts, all that can happen today in a paperless environment. Another area which has really taken us, we have leapfrogged is the use of WhatsApp. Okay. Today, 85% of our services are happening on mediums like WhatsApp, and instant servicing is happening, which is untouched by anybody. And that is increasing the customer satisfaction. In fact, our net promoter scores have really shot up, right? Because customers are able to do it themselves if you provide the tools to them. So that is one more area we're working.
If AI comes in too much, will it, not have the human touch, the empathy?
Yeah. So let me tell you one use case which we are very happy about. We have an AI app called Kavya, which is actually our employee AI app, right? On a WhatsApp medium, this Kavya is actually an individual who's an AI agent who's really interacting with all our employees 24/7 through WhatsApp, checking the mood of the employee, whether there are any stress levels, whether he feels burnt out, how does he feel today, how does he look at the company from his career progression, what are the things that he would like to probably want the company to react to his requirements. So all that happens on an AI platform just by a question answer. And this has thrown up so many insights to us. And this data is then available to the supervisors to really understand the employee engagement and the employee happiness quotient. So it has helped us build better EQ with our employees because we're able to understand our employees better. And Kavya is now today the most used tool by employees to express their views and for us to understand the pulse of the employee. When it comes to customers, there are a lot of stories in customer engagement or customer service, which we have used social media, we have used digital footprints, etc. Let me give you a story. There was a customer whose maturity payout had to happen. And we were not able to contact the customer because this policy was taken 10 years back and obviously the customer contact details, etc. were no longer relevant. But we traced the customer and went to his house. We realized that the customer had shifted, right? And now how do you make the payout? So our team actually got into tracking this customer through social media, through Facebook, LinkedIn, etc. The footprints were identified. And then we found one person who looked like our customer. Then we corroborate that. We looked at the nominee details and checked whether there is a footprint for the nominee. And then we realized that the nominee and the customer were related. In social media, we could pick up that. Then through social media, we pinged the customer. Thanks to social media, he responded. Then he gave us the full details and the payout was made. This is a great example of using technology with empathy, right? Because you are here to solve a customer's problem.
No, I agree with you, Mahesh, and I hope this story is heard by the government because one of the big problems they have is how to ensure that unclaimed deposits reach the rightful owner. So this is really an effort which we should showcase. Now, to come back to, the customer himself,
you have a health app. Now, why would you want the health app? And is this largely because you don't want to be a one-time transaction company?
Typically, in a life insurance company, we collect annual premiums. Customer pays 10 premiums, 15 premiums, and thereafter he gets a lump sum or an income after that, right? So what happens is during the course of the engagement with the customer, we don't have too many reasons where we can go back to the customer, right? Because life insurance is a category unlike banking or broking, where the customer sees multiple transactions in his account. Here, the number of transactions is far and few. Then how do you really build engagement with the customer? How do you keep your consistent dialogue? If we can step out beyond the financial services and look at various other ways which we can add meaningful value to his life, health and wellness comes out as one of the most prominent things, because while all of us are very, very happy to settle claims and we are in the business of settling claims, hey, can we actually prevent claims from happening? Or can we delay the eventuality? That is going to add far more value to the customer's life. And that is where we said health and wellness is a great platform. This has been demonstrated globally as well by many companies. So we said it's time rather we had a health and wellness app. In fact, we put it out in the public domain for all people to use. Our customers are also using that. But we said, let's put it out in the public domain for anybody and everybody to use a health and wellness ecosystem. Here we have orchestrated a complete health and wellness ecosystem for anybody who wants to use it. This includes nutrition, integration with your wearable devices. It includes discounts on buying medicines, diagnostics. So we have orchestrated an entire system for the customer. And this, we believe, is going to help us build better engagement with our customers and multiple reasons to have dialogue with our customers rather than just placing that renewal premium call saying that, sir, we now need to collect your renewal premium. So this is one of the ways of solving the engagement problem in the life insurance.
Let me come to your employees. I was impressed when you started speaking about AI that you also use it for the welfare of your employees. How do you manage talent at a time when there's so much competition?
No, I think the talent, requirements have changed so much from the time when I joined Workforce till today. Today we are all in an integrated world with so much of rapidly changing technology. We are what we call a VUCA world. Things around us are volatile, ambiguous, uncertain, etc. And the pace at which technology is coming in is something that has never been there before, maybe even a decade back. Every new application today the number of days or number of months to hit million customers keeps on reducing. It's becoming number of days now compared to years and months. So the most important thing we look at in our employees is a couple of characteristics. One is the ability to learn. Ability to learn, because you come in with a particular degree or you come in with a particular domain expertise. But if the paradigm is changing consistently, how are you able to unlearn, relearn, and reinvent yourself consistently? So that is something that we look forward to an employee's ability to learn and also provide them an environment to keep on learning. Second, the era of hierarchical structures is gone. Today, we are all talking about networked organizations. And if you talk to a technology team, the most commonly used word is Scrum teams. Now, what are Scrum teams? Scrum teams are basically teams which are able to learn on the job. They are able to quickly come together across domains and solve a particular problem by quick iterations and making sure that they are able to cross-functionally collaborate and deliver what is the objective, right? I think today, most of our problems, most of our critical things that we do in the organization, we actually form task forces, which are nothing but Scrum teams, which are empowered to go and find a solution to a particular opportunity or a particular problem. So therefore, ability to work in teams, ability to collaborate, ability to give and share ideas rather than functioning in silos is one important trait also that we are looking at in employees. Third is diversification in terms of having a well-diversified workforce. In fact, today the younger generation is teaching to the older generation. It is reversed because things are changing so much. I learned so much from my daughter and my son because they seem to be far ahead in the new world compared to what I was. So it's also important to have that learning happening, reverse learning, where the seniors actually learn from youngsters. So when we put them in such cross-functional teams, it also helps the seniors understand what's happening in the real world and how connected the world is compared to what they were when they started in life. That's keeping us agile and nimble in terms of learning new things.
This is another way in which you preserve your talent by recognizing them. I see 20 plus years of excellent service.
Yeah, I think we are blessed to have a lot of employees who have worked with us for a lot of years. In fact, we have a thing called Careers for Life. In Kotak, we don't say we offer a job. We offer your careers for life, life being life insurance and of course for your life as well. And that theme has played out over and above all these years. And we are very blessed to have a lot of employees who have worked with us. In fact, we have employees who have been with us from day one of the organization, 25 years. There are employees who have been there. There have been employees who have been before even the company started, because they were part of Kotak Mahindra Group elsewhere before the company actually got formed. So I think that speaks for our culture, and I think it's something that we are very proud about. At the same time, we also try and get as much lateral talent as possible wherever required, so that we are having a nice, boiling
nice
pot,
combo,
melting pot of having existing employees and new employees coming in from not only insurance domain, but other domains as well, so that we learn from what other industries are doing, apart from just looking at financial services.
Well, a final question. What is your vision for the next 25?
I think vision for all of us in the insurance sector is insurance for all. In fact, 2047 is what we want to achieve. We probably want to achieve it faster. At Kotak, I think the vision is to really be a very customer-centric organization, which delivers valuable solutions in the insurance space to our consumers, understanding their needs which they have, and understanding needs which they not have right now, to be proactive and ability to then work with them and provide them solutions. All this under the umbrella of Kotak's philosophy of trust, credibility, and building sustainability, and building scale with relevance in whatever we do. And when we say relevance, relevance to our customers, relevance to our distributors who carry our solutions to our customers, and relevance to all our stakeholders, including our shareholders, regulators, and everybody else in the ecosystem of which we are part of.
Thank you very much, Mahesh. I came here to understand more about insurance and what Kotak Life does for insurance. But I'm going back with a lot of lessons on HR, lessons on how you manage your employees. And I'm particularly impressed by your app, which is not only for your customers, but
the Happy You app.
Okay, Happy You app.
Yes.
All right. That's something which we should check out, since it's not even restricted only to customers. And then, of course, the way in which you'll think about retirement, not merely to have a source of income, but to be able to enjoy the things you couldn't enjoy in your working life. That's it on this edition of Insurance Dialogues with Kotak Life.
CNBC-TV18 Insurance Dialogues with Kotak Life.
which has been redressed. The third important point which has been taken by the board today is in respect of certain amendments, certain requirements relating to public issue to enhance ease of doing business and increase the engagement and participation of retail investors. So the first of all is that this issue of how to focus retail investors as well as the others to focus on IPO's important points. IPO documents being DRHP, being very, very big documents, it's difficult for them to focus and know. So therefore, we wanted it to bring a focus, and consultation paper was that, okay, let's have a summary, offer document summary, and then that should be highlighted. Now, the board has, of course, taken a view that instead of that, we can have similar objective fulfilled through abridged prospectus. Because abridged prospectus is also a requirement under the law, under Section 33 of the Companies Act. With application, you have to give an abridged prospectus. So this is a legal requirement, so we cannot remove abridged prospectus. So what we say is the abridged prospectus, we have now said that this will be XYZ. Like, we have created all important points which are required, and we have given that format that this abridged prospectus will be containing all these important points. And this will come, today this is not being offered at the draft stage. So we are saying that the draft stage also, when you have a DRHP, at that stage also there will be a draft abridged prospectus, which exactly will bring everything together, and it will be available with a QR code, so that, and this was one of the suggestions from public feedback, so that all the public announcements related to that IPO will get that QR code so that the people can easily access that abridged prospectus, which will now get all the information which your eyeballs need quickly. And idea is that the people are able to read through they are not able to read through the voluminous IPO thing, but still we need people who are doing a lot of research. For them, I think we need to give everything. But for the people who quickly want to really assess all the relevant information, we have indicated that it should be placed in the abridged and with a QR code so it can be easily done. So the only change is from the document which was sent for public consultation and today is that there we wanted the summary to be highlighted and abridged to go. Here we are saying that let the abridged will be retained and it will come at the draft stage itself. And then I think in consultation with Ministry of the Corporate Affairs, we can remove change that and offer document summary can be removed from there so that not to be repetitive. I hope it is clarified, but I will also clarify you while you are taking questions. Then the next, I think there was one more thing in this. There was a very important, enabler now to bring in an automatic lock-in for the pre-issue capital. So there are shareholders, there are promoters whose shares are locked in for 6 months, but there is also a requirement that those who are even not non-promoters, their shares also will be locked in for 6 months. The problem happens that if the things are pledged, then how the pledge will work, and that was leading to many of the companies not being able to get that clearance from those shareholders, those who have pledged it, so that these lock-in requirements could be filled up. So we are making a provisions in the changes in the ICDR, and based on that, there will be a possibility that directly the depositories can do the work, and pledged work can release of or taking off the pledge will automatically lock in will be possible through the depositories. So these are the two proposals relating to which will have impact on IPOs and IPO processes. Then the next proposal is to permit debt issuers to offer incentives in public issues to certain category of investors. So currently the issuers of debt securities are not able to offer incentive to any persons for making an application on the issue, except for commission or the brokerage. But if the issuers want to give certain facilities, certain discounts, that's not permissible. So we are, in order to promote retail, buying for the bonds or the securities, the non-convertible securities, we are making the amendments to make it possible for the additional interest or a discount to the issue price to be given to certain category of allottees. For example, senior citizens, women, armed forces personnel, namely serving and retired defense personnel, and widows and widowers of such personnel, retail individual investors, or any other category of investors as may be specified by the board from time to time. So this will enable something which is already possible under the equity segment to also be possible for the segment on the debt side, non-convertible securities. The next item is relating to Regulation 39 and 40 of the Listing Obligation and Disclosure Requirements Regulations. The basic thing is in removal of, the first is 39, in which we are now bringing in a simplified way in which the physical, in which the transfer deeds executed before 1/4/2019 could be dematted. Now, as you know, after 1/4/2019, no transfer is possible other than demat. But if the physical securities were there and transfer was there, there was a up to 2021. It could have been, it was possible to lodge it and then get it converted. Now, some of the difficulties have been faced, and those difficulties are being addressed in these regulations. So, before 1/4/2019, if you have lodged the claims and if you have, it was in one case something rejected or returned earlier, then we have given already a special window has been opened from July 7, 2025 to January 6, 2026 to allow relodgement of transfer deeds which were executed and lodged prior to the deadline of April 1, 2019. However, if we also have some cases where transfer deeds were done before 1/4/2019, but they could not lodge it before the time 2021 which was given. So therefore, we are opening this window for them in order to come in and lodge it. Please note that it is a pre-1/4/2019 transfer that we are talking about. Post that, transfers in physical securities are not allowed. The next is the aligning the timeline for transfer of unclaimed amount by an entity having listed non-convertible securities with Companies Act. So this is where, as you know, that there is an Investor Education and Protection Fund, IEPF, and investor, then it is also there at Ministry of Corporate Affairs. It's also available with the SEBI. So in case of companies, any unclaimed amount of maturity and interest has to go to, after 7 years, has to go to that fund. There was inconsistency that here there is a debt, for debt securities there is a principal and there is also an interest. So interest is accrued over a period in several tranches. And the 7 years timeline was to be, as per the rules of the IIF, was coming from 7 years from maturity. So this was not very clear. This is being aligned so that there is no confusion. This will also enable many people to claim interest from the issuer itself, because there is generally a little more difficulty in getting that from the IEPF. That's a separate set of rules. So now it will go, the accrued interest which is there, it will go to an escrow whenever it is to be paid. If not paid, 30 days. Within 7 days, it goes to escrow. But it doesn't immediately after 7 years go for that. It waits till the maturity. From the maturity, it goes 7 years. The matured principal plus all the interest which is there together can go until the time it remains in an escrow with the issuer, which means that the claim would be possible from the issuer as and when the people are able to track it and trace it. So generally, due to various reasons, the interest is, people are not able to get the interest. It may be change of address. It may be they would have shifted locations. They may not be aware of the physical thing, and as and when they are aware, they can go and claim. But that amount should be available, and that amount will be available in escrow with the concerned issuer. So, so this is basically to realign to align with the IEPF rules. Then the next decision was relating to the regulation of activities of credit rating agencies. So the credit rating agencies, which are regulated by SEBI, can also fall under the purview of other financial sector regulator. They may be, for example, rating loans, etc., which is a purview of RBI. They may also be doing some work relating to, say, unlisted securities, which is not really being in the purview of SEBI. So there was a difficulty faced by the industry in terms of not being able to, because of our provisions, which said that they can do so only if there is a guideline by the concerned financial sector regulator. Now, in absence of a guideline, they could not have done it. There are in many areas where there are no guidelines from that concerned regulator, which means they were not able to do it. So we are making it now clear to enable them to take up such activities, but making it very clear that what would be the disclaimers and conditions which will lie, which means that basically they'll segregate certain business processes in a manner where investment protection and other benefits of SEBI will not be available in relation to non-SEBI regulated activities that they do, and they have to make it explicit. They also have to intimate. They have to have a separate email IDs, etc., for those clients. And subject to that, they can actually take up those activities. So this is something which is an important area in which they can do, and that will also be good for the economy, because in many cases there would be unlisted entities also for listed players also. There could be subsidiaries. So in which case they normally rating, when it is done, it's also done on a company on issuer and consolidated basis, including subsidiaries, including unlisted entities also, which was a difficulty so far as they were concerned, that our regulations were in a way preventing them from doing so. So we are removing that. It's an ease of doing business measure, subject to, of course, the due risk mitigation, which they will do. Like if they have to take up additional net worth would be required if certain other regulator says so. So that will not be merged with this net worth. So there are certain safeguard measures. Subject to that safeguards, they can do that. The next item was relating to high-value debt-listed entities. As you know, HVDLEs, they are the ones who have been classified today with an outstanding, of non-convertible debt of 1,000 crore or more. Now, this limit is actually very low in relation to the debts that many of the entities raise, for example, NBFCs, etc. So there is a constraint on them. So that's being raised to 5,000 crore. And so this is an ease of doing business. What happens with the HVDLEs is the additional corporate governance requirements. And those corporate governance requirements would be extra cost also to them. And obviously more onerous measures, and will dissuade them otherwise to do that. So that is one set of proposal. The second set of proposal is to make those corporate governance measures consistent with what is obtaining on the equity side. Because what has happened is that last few boards, we have relaxed those requirements there on the equity side. But consistently, we have not done it here. So we are aligning it with that. So if for example, if you have a issuer who is also on the equity as well as on the debt, there's a consistent provision should apply instead of. So we have basically harmonized it with whatever ease which we have given it. For example, RPTs, whatever scale-based RPTs we have applied there, we are also applying it there. So this is basically kind of a catch-up and harmonization. The other is raising the threshold from 1,000 to 5,000 with a view to further enabling this sector to raise the debt easily. The last important proposal was relating to the high-level committee on conflict of interest. So the board deliberated on this matter, and and acknowledged that there is a comprehensive review which has been carried out by HLC, and expressed that we need to have a detailed discussion on the recommendations in the ensuing meeting, keeping in view public and media comments, certain concerns expressed by employees, operational modalities, and the way forward. So, thank you, friends.
First of all, congratulations on the overhaul of the two major regulations that you mentioned. First, on the stockbrokers regulation, what I have noticed, apart from the reduction in the paras and the total length, you have fixed the responsibility on stock exchanges. Is there any other change which happens after this?
No, it is basically to make it clear that it is for the stock exchanges which have to be the first line of regulator. And many of the things, they have to come through the stock exchanges, not directly. So that is the point which has been made clear.
Also on the mutual fund regulations, is there any timeline of implementation as well which has been kept in mind?
Mutual fund will be 1st April onwards, and because now it will take some time to notify, and it will be applicable from 1st of April.
Will there be, transition kind of effect, or one go the implementation will happen?
One go.
Chairperson, as far as the mutual fund PER regulation itself are concerned, as far as the brokerage side of it is concerned, to of course given some relief in terms of what was put in the consultation paper is not as aggressive as to that. What has been the thinking behind that? What was the presentation that came from the mutual fund industry and stakeholders? Second thing, one constant understanding that we get from mutual fund is that they say that the difference between a smaller fund, a newer fund, younger fund versus an older fund and a bigger fund is very steep. And the thinking is that since something is doing very well, it means that it's been accepted very well. But the lower TER is there on that one. It should be the other way around, and at least the steepness should reduce. What is your view on that particular aspect?
I think the telescopic way of doing things is more friendly to investors, and they should continue, because if you are able to have a larger AUM and you have bulk, obviously you are able to meet with some cost more effectively because it's a percentage. So the telescopic, I think, is a well-established thing, and it should continue, and we have to look at the investors.
So on the same mutual fund, you have changed from TER to BER now. What goes behind the main change? It is something like base rate which we used to have in banking system. Something like that over and above it can be charged depending on the scenario.
Yes, the point is that all these charges will be visible, because when one can say that you have everything clubbed is much better for me. कि मुझे आप एक बताइए बस कितना, इतने सारी चीज़ें कि नहीं है. लेकिन जब आप कॉम्पोजिशन में जाते हैं तो उसमें भी काफ़ी क्लैरिटी मिलती है, डेटा मिलता है कि कौन कितना है, और उसके बाद कल आप यदि मान लो टैक्स बढ़ गया या कम हो गया, उसमें हम फिर TER में फिर बार बार एडजस्टमेंट करते रहेंगे. तो जब आपने देखा होगा इन्वॉइसिंग भी होती है, पहले जब भी इन्वॉइसिंग वगैरह होती थी बहुत सारे कॉन्ट्रैक्ट वो डिस्प्यूट्स पे चले जाते थे, जब वो कहते थे कि आप इसको ऑल इंक्लूसिव बताइए, इंक्लूसिव ऑफ टैक्सेस बताइए। तो इंक्लूसिव ऑफ टैक्सेस में इंसिडेंस क्लियर नहीं होती, कस्टमर को भी क्लियर नहीं होती। तो इसीलिए आपको ज़्यादा से ज़्यादा जो कॉन्ट्रैक्ट्स होते हैं वो डिस प्लस जीएसटी होगा, क्योंकि जो पास ऑन होते हैं टैक्सेस, दो तरह के टैक्सेस होते हैं। एक डायरेक्ट टैक्सेस होता है जो पास नहीं होता, जो इनडायरेक्ट टैक्सेस होता है जो कस्टमर्स को पास होता है वो विजिबली दिखना चाहिए, तो अदरवाइज नहीं तो क्लैरिटी नहीं होगी आपको कि देन देयर विल बी आल्सो पॉसिबिलिटी ऑफ फजिंग थिंग्स।
Hello and welcome to Startup Street. I'm Arundhati Ramnan, and with me as always is Shruti Mishra. These are the top headlines from the startup world. SpaceX startup Vedanta has closed its Series B fundraise of $50 million from 361 Asset, SBI Investments, Co Japan, and Ronnie Screwvala. The fresh capital will support global expansion beyond India and the United States, the establishment of new manufacturing facilities for optical systems and satellite production.
Shilpa Shetty-backed D2C brand Wicked Good has raised 20 crore rupees in its latest funding round from existing investors, including Ori's venture partners. The fresh capital will be used to expand its presence across modern trade, general trade and digital platforms and accelerate product innovation.
Decode Age, a longevity science organization, has bagged 14.48 crore rupees in its pre-Series A funding round. Funding will accelerate science-led longevity solutions, microbiome platform and research-driven supplements for healthy aging.
ChatGPT maker OpenAI is in talks with Amazon about a potential investment of $10 billion. CNBC reports Amazon is also keen on an agreement to sell its semiconductors to OpenAI. Amazon has already invested $8 billion into OpenAI's rival Anthropic.
The world's richest man, Elon Musk's net worth touches $650 billion as Tesla stock hits a record high. Musk's net worth is now more than the combined wealth of Larry Page and Jeff Bezos, who are the second and third richest in the world.
Well, those were the headlines we've been tracking for you this evening on What's Brewing Today. Critical minerals and urban mining company Attero has announced a 150 crore rupee expansion to scale up e-waste recycling, copper recovery and R&D infrastructure across the country. Now, with India generating over 3.8 million tons of e-waste every year and tighter EPR norms pushing waste into formal recycling channels, Attero is betting big on automation, robotics and advanced recovery technologies. To stay ahead of the curve, how does technology turn trash into critical minerals? And how can India build a globally competitive circular economy? Joining me now is Nitin Gupta, the co-founder and CEO of Attero. Nitin, welcome back to Startup Street. Like I mentioned earlier, you've announced a 150 crore rupee expansion covering new e-waste recycling facilities in Pune, Bengaluru and Faridabad, a copper recycling plant in Rajasthan and a stronger R&D center of excellence in Greater Noida. Now, once these plants are commissioned, what new annual processing capacity does this add, Nitin? And how close does it take you to your long-term national capacity vision?
First of all, thank you for having us, Shruti. It's always a pleasure to be here. Good evening to all your viewers as well. So, Shruti, with the expansion of e-waste facilities across Pune, Bangalore, Faridabad, and the copper refining plant in Rajasthan, along with the Greater Noida R&D facility, our e-waste capacity will increase by 1 lakh tons per annum, taking a sort of expanded capacity to 2,44,000 tons per annum. Our 3-year goal is taking the capacity for e-waste recycling to 500,000 tons per annum. So with this expansion, we will be almost 50% of the expected goal that we have in 3 years, Shruti.
Nitin, you often say recycling today is a technology game. So tell us, how have robotics and automation changed outcomes compared to traditional recycling methods? In fact, your Rupee facility already uses robotic battery dismantling. What kind of efficiency gains are you seeing there? And will the new plants match or exceed that benchmark?
Absolutely, Shruti. So technology is the critical factor in generating profits and ROCEs in the recycling business. Without technology, we'll not be able to get the extraction efficiency that we have. At Attero, our extraction efficiency is more than 98% for 22 plus critical minerals or metals that we extract, with a purity that is as good or better than virgin mining purity.
Yeah.
And at a capex per ton, which is 40% lower compared to anybody else in the world, and the lowest opex per ton as well. Robotics and automation basically help us improve our profit margins, and the new facilities that we're building are going a step ahead. Is put in place in every step of the way.
All right. Nitin, these new plants also support your digital platforms, Metal Mandi and SellSmart. How do digital marketplaces and take-back platforms fit into what is otherwise a capital and infrastructure heavy business?
So essentially, Shruti, the entire scrap supply chain is and was informal in nature, right? What Attero has done over the last 1 year is that we have launched 2 digital platforms. One is SellSmart, which essentially gives the consumer the option of having sort of ability to sell his or her electronic waste at the best price possible from the convenience of their home. Along with that, because our sort of electronic waste contains a lot more digital data, the data privacy is 100% ensured. And because all of this electronic waste is recycled using Atero's patented and globally best technology, there is no environmental degradation, right? CellSmart is today present across 19 different cities and is today doing roughly 1,000 orders a day, doubling every quarter, right? Similarly, Metal Mandi aims to democratize the entire scrap supply chain by giving the best price possible to the local scrap dealer, right? And we are today active across 30 different cities in the country.
Sure.
Both of these platforms will have a lower logistics cost once we have a distributed processing facility that we're building at Pune, Bangalore, and Faridabad.
Okay. Okay. Nitin, you're also planning international dismantling and lithium-ion battery recycling facilities. Is India now Atero's technology and process export hub for global expansion? And how does your claimed recovery efficiency, which is, you claim it to be over 98% with 99.9% purity compared with global peers?
Absolutely, Shruti. So we are essentially looking to make sure that the R&D that we do in India is world-class and gives us world-class solutions that we can export outside India as well. So we're looking to actively set up plants in Europe and US. And our current technology for battery recycling and rare earth recycling is best in class globally. Our recovery rates are more than 98% for end-of-life lithium-ion batteries. Globally, those recovery rates are 80%. So we're recovering at least 25% more revenue from the same input compared to anybody else in the world. We're also doing it at a capex per ton, which is 40% lower compared to anybody else in the world. Our capex per ton is $3,200. Globally, the minimum capex per ton is $5,500, Shruti.
Okay. Now, you expect to add up to 1,000 jobs across operations going forward with this expansion. You also claim today, Atero controls nearly 30% of India's formal recycling market, with the next player at under 7%. Nitin, what are the growth targets in terms of revenue and market share today?
So, Shruti, the good part is that the sector of the market is growing at around 40% year on year, right? So naturally, our growth targets have to be higher than that, given the fact that we're the market leaders and the thought leaders in the space. So our growth targets are continue to grow 100% year on year, profitable growth, grow revenue 100%, and grow the EBITDA and PAT margins more than 100% year on year.
All right. One final question before I let you go, Nitin. The cabinet has recently approved the 7,280 crore rupee rare earth permanent magnet manufacturing scheme, a crucial step in reducing India's dependence on imports. Nitin, where does Atero fit into this emerging value chain, especially in rare earth magnet recycling? And can urban mining become a strategic pillar for securing rare earths domestically?
Absolutely, Shruti. So in our opinion, by sort of creating a circular supply chain, India can meet at least 65% of its requirement through just a circular economy or by recycling, right? Now, in India today, Shruti, there are only two companies that basically extract rare earths. One is IREL and second is Atero. IREL extracts rare earths by mining. Atero extracts rare earths like neodymium, dysprosium through recycling and refining, right? So definitely, I think the scheme is a step in the right direction. For the scheme to be successful, the scheme talks about a 6,000 tons per annum magnet manufacturing in the country. It needs rare earths, and Atero will be a big contributor towards that supply chain, Shruti.
And we wish you the very best for that. Nitin, many thanks for joining us on Startup Street today. Thank you for your time.
Thank you, Shruti. Take care.
On the hot seat today, from satellites that cost billions to defense-grade aircraft out of commercial reach, Earth observation has long been expensive, slow and inflexible. A Bengaluru-based startup wants to change that. Arctis Aerospace is building high-altitude unmanned aircraft that can fly at 45,000 feet for 24 hours, delivering real-time, high-resolution intelligence at a fraction of the cost. The company has just raised $2.6 million in pre-seed funding to build what it calls a zero-infrastructure alternative to satellites to understand the technology, the market opportunity, and what it takes to build frontier aerospace from India. I'm joined by Sripurna S. Rao, the founder and CEO of Arctis Aerospace. Sripurna, thank you so much for taking time out and being here with us on Startup Street. Take us back to when you started Arctis, right? What sort of personal insight or technical frustration convinced you that Earth observation needed an entirely new platform beyond just satellites and defense-led hail systems? Take us through, what you're solving for.
Thanks for having me here on this show. The journey started in IIT Madras, where I graduated from last year. I have been building aircrafts and a lot of long endurance fixed wing platforms. And after spending a lot of time understanding what Earth observation needs and the holy grail of Earth observation, it is primarily to be able to reach any point on Earth and give you dedicated video feed from the sky that can help you make a lot of inferences. Now, currently, the problem in the industry was satellite-based imagery is great to validate data from ground than just be a decision-making pipeline. And that is very expensive at the moment, and not a lot of industries use that. And the value from it is also limited by the physics of it. You are at 500 kilometers. You have to put a lot of satellites in space in order to do persistent imagery, just to get one image every 24 hours. And then the cost of infra is what then trickles down to the customer, and that's why the cost per square kilometer is pretty expensive. Now, what I realized was, while talking to a lot of customers, we came across the idea of zero infra Earth observation, and be having zero ground infra to do any sort of monitoring, surveillance, and inspection. And that is how the idea of this entire company came about. We started building small aircraft, doing some pilots, and then doing dedicated pilots with few customers. And then, we have scaled up to what we are right now.
All right, we're going to talk about those pilots in just a bit, but only a handful of companies globally have ever built aircraft in this sort of an altitude, right? What were the hardest engineering trade-offs in designing this unmanned aircraft that can sort of fly at 45,000 feet for 24 hours? And why was it even more important for you to do everything in-house? Because you're currently building everything in Bengaluru, right?
Yes. So these aircrafts themselves individually are like system integration challenges. To give some context of the scale of the aircraft which you're building, they're going to be 18 meters in wingspan. Now, having structures that can fly for that long, it's like very complicated. You have to understand materials, you have to understand structures, you have to understand, propulsion, a lot of things, a lot of, parameters that come into play, and ensuring that your electronics and like the embedded system, telemetry, all of these work together. And you see the end output is what we are delivering to our customer. And what is the best way we can do that is how we build this entire product on. And that's the reason we're building this entire aircraft in-house. We need to understand every single aspect so that we can make it efficient and optimized for the end use case which we're building for.
Sure.
And that's why we are doing it.
And you've raised this $2.6 million in a pre-series funding round, right? If you could quickly tell us how you plan to prioritize this capital, where will the money go?
Yeah, so we are building these aircrafts right now, and we are at like a prototype stage, and now we have to take this prototype to production and also do a lot of pilots. And that is where this majority of the funding will go into, doing a lot of R&D and building like the framework to build these aircraft, because there are only like 6 to 7 companies in the world who build these kind of aircraft, and we are going to be the 8th one. And these are, if you put it in simple words, strategic importance platforms. A lot of these platforms are used. All the platforms which are built right now in the world are used for defense. We are the first ones who are making it commercially viable. And to do that is what takes us to build these aircrafts.
So you're the first one to make it commercially viable, and you also promised real-time geospatial intelligence at nearly 20x lower the cost of which, we're seeing around the world, right? So which industries commercially, whether it's energy, infrastructure, climate or security, are already showing the strongest pull for this kind of, on-demand sensing?
So this kind of data didn't exist before. That's the biggest USP we have. We are providing you a video from the sky where you can see literally whether your contractors are following SOPs or not, whether they're wearing hazmat suits, whether they're following safety protocols. Like the resolution of data is what is our USP through which we collect through our aircrafts. And that is how we are getting into this. All the companies who are buying satellite data today have had the strongest pull to come and do pilots with us. And that's the biggest validation we ever got.
Sure. And what's the kind of demand you're seeing right now from clients?
So we are working with a bunch of mapping, oil and gas, shipping and insurance companies. Pretty early stages of talks with them, because this is the new kind of data. They need to understand the value they have. We already are providing the same value as satellite at 20x cheaper price. Now we also need to realize that the kind of data we provide, the resolution is also 50 times better. So even if we remove the aspect of price, our data with resolution and the value is already much more valuable than what satellites can do. And that too at zero infra is like the biggest trade-off, the biggest benefit which the customer can have.
And how soon will we see you go from like these pilot projects to actually making it commercially viable? What's the timeline over there, and when do you hope to see this actually generate some revenue for you?
So in the next 6 months, we are planning to have like a fully locked in year-long license with a customer, like a year-long subscription with a customer. And then maybe a year down the line when we can see things scale up at global level. We are not only talking with India, we also have a bunch of international interest coming in, and we are primarily targeting that and going behind that.
So you're primarily targeting your international clients over here to expand globally. All right, Sripurna, thank you so much for taking time out and being here with us on Startup Street. And we wish you all the best on this journey going forward.
Thank you so much. Thank you for having me here.
On that note, it is time for us to slip into a short break. But coming up next, cross-border payments platform Skydo has raised $10 million in Series A funding led by Sasquina Asia Venture Capital. We put the firm's co-founder Movin Jain on the hot seat to decode the details. Stay tuned.
Welcome back to Startup Street. Cross-border payments platform Skydo has raised $10 million in Series A funding led by Sasquina Asia Venture Capital with participation from existing investor Elevation Capital as it looks to power India's $2 trillion export ambition. Serving over 30,000 exporters across 50-plus cities, Skydo is building what it calls a financial operating system for Indian exporters, cutting hidden forex costs, speeding up settlements and automating compliance. Joining me now now is Movin Jain, the co-founder of Skydo, and with me, my colleague Arundhati. Movin, welcome back to Startup Street. Now, what does the Series A capital unlock for Skydo at a time when India is pushing hard towards a $2 trillion export target? And this round will also fund local collections across 20-plus countries in Latin America, Africa, Southeast Asia, and the Middle East. Why these markets move in, and how complex is it to build local payment trails and secure licenses globally?
Hi, Shruti. Hi, Arundhati. Thank you for having me back here. It's always a pleasure. Good evening, everyone. I think this capital unlocks quite a few things for us. And the first one of them is India being the market which we are serving today. It unlocks scale-up of our merchant base from about 30,000 MSMEs today to a few lakhs in the next couple of years. I think the second thing is we want to launch more products. Today, we only do inward payments, that is export payments. We also want to launch outward payments. So we will do that in the next 3 to 6 months. We are also broadening our product offering continuously, including launching multiple currencies, corridors, and payment methods. And lastly, we also have strong plans to expand globally and get licensed in multiple countries beyond India. So these are all the things that this funding round unlocks. And I think the reason that we chose these markets is that Indian MSMEs are also going after a lot of niche markets today, and getting money from these niche markets, from getting paid from your customers, is really tough compared to getting paid from the West. We're already present in several mainstream geographies, and now we're going after some of these niche corridors.
Sure. And, you've also highlighted that Indian exporters often sort of tend to lose 3 to 7% of their revenue to hidden forex markups and opaque fees, right? So how exactly does Skydo sort of change that equation?
So the key thing that we do differently in terms of pricing is, firstly, we are building the lowest cost infrastructure, or rails as we call it, globally, by partnering with the best institutions globally and getting licensed in multiple countries. So building this low-cost infrastructure helps us to present pricing that Indian MSMEs have not been able to access before. Second thing is we offer full transparency of pricing, which means that these MSMEs who usually do not have a lot of bargaining power with their banks and other institutions that serve them don't have to actually negotiate or guess how much they are losing. They actually see pricing transparently on our website, and every customer gets exactly the same pricing. And that pricing is a very competitive price because of which they don't have to worry about this aspect of their business and can really focus on growing globally.
Sure. Movin, like I mentioned earlier, you now serve over 30,000 exporters, process payments in 32-plus currencies, and have grown forex in the past year. What's driving this adoption, and which exporter segments are growing the fastest? And if you could also take us through your current revenue numbers.
Sure. So I think MSMEs in India are increasingly adopting technology. I think one part of this is just secular. I think the tech savvy in the country is increasing across the board. But the second thing is that regulations are also making it easier for these small businesses to trust companies like us. We are regulated by RBI, and that makes it possible for them to place their trust in us. It's a matter of money, and it's not an easy decision for them to trust a startup like us. I think the other thing that has made this possible is we've launched multiple enhancements and broadened our product and also improved our service, which is increasing this adoption.
Sure. And moving for decades, exporters had two choices, right? Traditional banks or global players like PayPal and Wise. So while banks take time, global platforms can charge up to 10%. So what is Skydo doing fundamentally differently to sort of win exporters' trust?
I think one thing we are doing fundamentally differently is full transparency of pricing without any bargaining or negotiation, which means that as a business, you don't have to think about leaving money on the table or thinking that you need to negotiate and spend time, getting a better deal and so on. The second thing is building the lowest cost infrastructure globally to make this possible. And the third is, I think, understanding India's specific compliance and regulation very deeply. For example, providing documents like FIRC, which is very important for tax compliance for these MSMEs and is required by Indian regulations.
Okay, Movin, Skydo, like you mentioned, was among the first to receive RBI's in-principle PACB authorization. How big a competitive advantage is regulatory clarity and compliance in building a global payments platform from India? And as you expand beyond collections and payouts into card acceptance, automated compliance and developer-first APIs, are you evolving from a payments product into a full-stack financial operating system for exporters?
I think regulatory clarity is super important, as you mentioned, and I think I'm really happy that we've progressed significantly as a country and as an economy on that front in the last 4 years. And I think we're really lucky that RBI and the Finance Ministry have taken several positive steps. I think for us, particularly as a cross-border payments player, this is even more important than domestic payments because we have to partner with several global banks. And some of these are huge institutions, Fortune 10, Fortune 500 institutions. And for them to trust us and be able to partner with us, a license from RBI really helps and, changes people's minds. I think the other thing is that Indian MSMEs and their clients are also able to trust us because of the regulatory clarity. Otherwise, it becomes hard for them to, believe that their money is safe. And on the other aspect of going full stack, yes. So we now want to power everything that happens, not just at the time of money movement, but before and after it. For example, accounts payable, accounts receivable, reconciliation, compliance, trade compliance, realization, and taxation. All of those things are things we want to solve through technology.
And in 20 seconds, if you could tell us, your Instalink's product promises card acceptance at nearly half the cost of legacy gateways, right? Why is card infrastructure such a critical piece for Indian exporters, and how large can this opportunity get?
I think this opportunity is already significantly large, a few tens of billions of dollars in terms of total exports from the country annually. But it's growing at a really fast clip and much faster than most other export segments. So that is the reason for our deep focus on card payments and e-commerce payments. A lot of Indian MSMEs are realizing the e-commerce opportunity, and there is a lot of global demand for Indian e-commerce exports, and that's what we want to power. Traditionally, foreign payment companies have, held this market, but we want to make a strong, foray into this.
One final question, Movin, and if you could quickly answer that. You're targeting $5 billion in annualized payment volume within the next 2 years. What milestones, across product, geography, or partnerships will define success for Skydo on that journey?
I think one key milestone is going to be in the next 6 months, we're going to launch import payments, so outward payments. Then we're going to launch our product in multiple countries. We're also building teams globally. We're also going to get global licenses. So we are in the process of getting licenses in Gift City, Canada, and the US.
All right, Movin, many thanks for joining us on Startup Street today, and wish you the very best with all your growth plans.
Thank you, Shruti.
And with that, it is a wrap on this edition of Startup Street. From Shruti and me, goodbye and many thanks for watching.
Hello and welcome. As we look ahead into 2026, markets are navigating a complex transition from post-GST adjustments and earnings resets to shifting consumption patterns and a long-awaited cyclical recovery in markets in key sectors as well. 25 has arguably been a tough year. And of course, expectation as we turn the chapter over into the new one is that it's going to be a little easier. Easier, not easy. Well, adding to the complication, of course, more recently has been the slide we've seen in the currency, the rupee, that is, from 90 to 91 in about 10 sessions, being pushed back this morning as we speak, but we'll have to see. To help us cut through the noise, we are joined by the core of Bank of America Global Research's India Equity team, analysts who advise some of the largest money managers and institutions investing in our markets. Amisha heads equity strategy at BofA. Gunjan Prithyani tracks autos across, two-wheelers, passenger vehicles and tractors at BofA. And Neha Manpuria covers hospitals and pharmaceuticals at the firm. We'll try and break down what 2026 could look like for markets overall and, of course, for some of the key sectors as well. Thanks very much, all of you. Gunjan, Neha, Amish. Appreciate you guys coming down.
Pleasure.
So should we start right at the top? From a strategy point of view, Amish, how are things looking? The consensus is that it's going to be a little easier, as I said, not like an explosive move or anything of that sort, but maybe a little better into 26 over 25. Is that just turn of the year kind of optimism? We all feel a little more optimistic at that time. Is that time of the year, or you think it's grounded in numbers and you can sort of build that case up from bottom up?
I would agree. 26 is looking better than 25.
Yeah.
So let's say same time last year, markets were looking expensive. Earnings growth expectations from consensus was quite lofty. It seemed like earnings will come off. Small and mid caps was driving the rally. In fact, lower the float on the stock, those stocks were doing well, which seemed like momentum trade that will not sustain. So I think all of that is now behind. If you look at so far in this calendar, for Nifty companies as well, FY26 consensus has already cut their earnings by 11 percentage points, and for FY27 by another 6 percentage points. So I think earnings expectations are now sensible, and earnings growth we think is going to accelerate. So as a result of that, valuations are now also looking reasonable. I would not say Indian markets are cheap still, but they are now reasonable. And with earnings improvement and no more earnings cuts, I would argue 26 is much better. And then finally, when you look at the events calendar, what can drive the volatility in the market, we do think that the events are also skewed on the upside rather than downside right now.
Lesser events which can derail the story in that sense, maybe, right? Hopefully. Has Rupee come up in conversations with clients lately? In what way?
It's in the front and the center right now because it's an unknown. And as we know, market always likes to have predictability. So, till the time, and we know the drivers of why the rupee is being weak. So how do you price in? At what price do you say that the rupee is now adequate? Will it appreciate? Will it continue to depreciate? So clearly there are sensitivities for stocks around that. So I think it's in the front and the center of the conversation. If you're a near-term investor, for the long-term investors, they do think that at some point in time, now we are at the fag end of this depreciation, things will settle down, and then they are looking at X of currency, how should they build their portfolios?
So for new investors, foreign investors who are coming in, you're better off buying now if the currency were to be stable from here, in that sense, right?
Definitely would say so. Even otherwise for a foreign investor, I would say that, historically, whenever Fed has cut rates, it has led to EM flows. Whenever dollar has been weaker, it has led to EM flows. If you look at our own house views, we are expecting only 4% returns from S&P next year, but we are expecting 12 for Nifty this year in CY26. Right? So clearly returns also are skewed in favor of Nifty rather than the US. All of that basically points to the fact that logically FII outflows should at least become zero next year, possibly could also be inflows.
So no more money out from equities, foreign money.
Is our view.
Is that view. And but is there any framework to kind of be able to sort of tell as you begin, or is it just like a function of various things, positioning and how much has been already sold, etc.?
So positioning, yes. But just think about it that if you are a multi-asset fund manager, then the way you are likely to look at is debt versus equities. So the 10-year bond yields are currently around, call it 4/4 on an average. So 4/4, add to that the risk of rupee depreciation. So you might be probably expecting, let's say 6/4 as rupee risk-free. And then add to that the fact that you're not buying bonds, you're buying equities, so you need risk premium. So let's say 5% for equity risk premium. So you're expecting about 11+% returns. As far as the markets give you a visibility that is possible, then the preference is more in favor of equities than debt. And then if you switch to, let's say, within equities, if I'm an emerging market portfolio manager, and then where do I allocate money versus India, China, Brazil, etc., then as I'm saying that on the back of the fact that India's earnings have come off, valuations are now looking okay, India at least is one of the alternatives versus throughout this calendar, India was a avoid. So I think all of that put together, whether you are an equity fund manager allocating between markets or whether you're an allocating across asset classes, FII outflows definitely, in our view, should stop.
You know, we had a senior person from Bank of America on the currency side, on the fixed side, on last week, and I asked him towards the end of the conversation, I asked him, what's the one non-consensus view that you have? And he said, well, dollar will appreciate in 2026. Well, I don't know if that's a published view, but he said it on record. He said it. So, yeah, I mean, lots of moving parts. We don't know essentially what's going to happen, but it's a constructive framework, Amish, that you're working with, right? Let's get to some of the sectors now. And Gunjan, autos has been the savior sector in that sense, right? Has done very well, and some of the stocks more than others. What Amish was talking about, that earnings will pick up and perhaps consumption picks up, etc. Are you seeing that evidence after these cuts? I mean, what started after a bit of a pent up because there was that festive thing and the Shraddh period, and there was cuts happen, and right out of that there was of course a big bump in sales. Has that sustained? Are you seeing that being durable? That bump in auto sales being durable, and what segments mostly?
Sure. So yeah, certainly I think GST has been a very important catalyst. If I look at the sector growth, it's accelerated from nearly nothing in the first half to now in the range of 8 to 10%. So to your point, yes, there was a huge bump, almost 20% up during the festive days. But if you actually even normalize for the time the GST announcement was made till date, the registrations are up between 8 to 10% across various subsegments. So clearly there has been acceleration in growth and it's holding on. Our view is when you think from an auto upcycle perspective, everything that matters, be it credit, crude, cost of ownership through GST rate cut, cost of compliance, regulations are a lot lesser going into the next 2 years. A lot of things are aligned, and hence, our view is that growth should sort of sustain going into next year as well. But I think the more pertinent point is, like you started off saying, that auto has been a savior. It's a space that's done well. The pertinent question that we face from investors is what's in the price. I think that's where a lot of positive revisions happened immediately post the GST rate cut. And now it seems like, the expectations have more or less aligned with this 8 to 10% sort of subsegment growth that we are seeing across the various spaces.
In some categories, are we going to very quickly revert back to the same kind of situation which persisted before the GST cuts, which is of too much inventory, etc.? I mean, are you starting to see any of that, or no? It's kind of flowing through well.
So I think, of course, growth will normalize as the base catches up, but I think, 6 to 8% sort of growth looks par for course. It is
volume growth.
Volume growth, yes.
Oh,
so for PVs and two-wheelers, 6 to 8% sort of volume growth looks par for course as we get into a more normalized base next year. Of course, next couple of months, still the visibility of growth is higher, etc. I mean, you could see two-wheelers numbers being in double digit, but that's more of a base effect. So 6 to 8% for fiscal 27 seems par for course. I think the interesting subsegment could be CVs, which has had no implication from GST as such, but it is a second-order beneficiary of any economic recovery. So that's the segment probably to watch out from a next year's perspective, where expectations are still relatively reasonable, and we are starting to see a little bit inflection on that space.
This entire rare earth magnet issue, right? I mean, it's kind of disappeared off the thing, although there's been companies are doing just fine without... So how's it happening? I mean, or it's going to be, it's an issue to watch in 26 as well, or you think it's sorted now?
I think at least it's sorted in the short term. But there are two things playing out here. One is the easing of the supply chain. There's clearly a lot more availability now than it was a few months back. Secondly, if you also look at the EV growth in itself, that's sort of moderated. And that's outcome of, GST, because GST has made petrol vehicles cheaper, and hence that, this whole argument of shift towards EVs has been pushed out for a couple of years. I mean, we're seeing a lot modest growth in the on the EV side. So it's both combination of supply and demand being a bit modest, but I think longer term we'll need to find a solution, which is where, lighter rare earth materials, some of these companies are working towards that. Those are solutions we'll have to watch out. But for now, 3 to 6 months, I don't think that's a big worry in minds of corporates.
Niyam, let's talk about, you track hospitals, you track pharma, right? So let me actually pick up with pharma, which is of course a big export sector. And the obvious question is this Rupee thing, right? Does it make a difference at the margin for earnings?
Not really, not as much as probably it does for the other sectors. While pharma is export oriented, I think the one thing different about pharma is, it's not, US is the largest, but it's not the only market. You also have Europe, you also have, emerging market where currency tends to be volatile. And then you also have your raw material cost, which is usually USD pegged, and some amount of your spending is also pegged to local currency. So the flow through isn't as much, and therefore you don't see pharma stocks react as much to FX moves. I would say less so for pharma.
So what's the big dominant driver going to be for pharma, to your mind? Or is it going to be different things and different kind of subsegments where you'll find places to make money?
Yeah, so I think while we use the term pharma, there are like 3 different subsegments. For the large cap or the US generic focused names, I think the tariff news has sort of died down. Is the possibility completely out? No, you never know, right?
Which is those sectoral
tariffs, the Section 232 tariffs, right? At the moment, what White House has said is there's unlikely that generics would be included in those tariff discussions. Even for branded, we've not really seen anything come out other than the one tweet. So I think the tariff noise has sort of died down. It does not come up in conversation as much. I think for the US-focused names, the big debate is as you get into 2026, you had this very large product limit for most companies, which is going away, right? So how do you fill that hole? So are you looking at how is your US pipeline looking? Are you looking at other growth drivers? We have seen companies use the cash flow from this large drug to diversify their business and enter into newer segments, OTC, medtech, specialty. So I think there's a lot of focus on which of these will be your sustainable growth drivers and drive earnings momentum, probably not next year, but 2 years out. And therefore valuations are, I would say below, long-term mean because there's still a little bit, headline earnings won't look as great because of Revlimid going away, but a lot of focus is on what happens to that, capital allocation that you're making into these newer areas for pharma companies. And I think for CDMOs, obviously, there's a lot of discussion around, reshoring, Biosecure Act, with China in licensing, how that impacts biotech funding, winters, has that improved? So I think there is more action, I would say, happening on the news flow side on CDMO versus the US pharma.
The exporters into the
US.
So,
that's right.
And that's an area of interest for you in terms of CDMO, perhaps over the large cap
yes,
companies.
Yes.
Okay, hospitals we've not gotten to yet. I have to take a quick commercial break, so allow me to do that. I'll just take that, come back, and we'll continue this conversation right here. So let's do that. Take a break, and the BofA Top Equity India team is with me. We'll, of course, dive down into individual some of the ideas and what they like more than others. So all of that coming up in just a bit. Welcome back. This is Outlook 2026, and I'm sitting down with Bank of America Global Research's India top equity team. Amish Shah has, of course, been running us through the overall top-down strategy. Neha has been telling us about hospitals and pharma, and Gunjan, of course, has been putting the spotlight on autos as a space. Thanks very much, guys. We didn't do hospitals, Neha, so just want to start with that. So what's the thesis? I mean, it's been a huge wealth creator, and I think, for those who are looking at the headline inflation numbers which get released, and we do that all the time when hospitals come on board and we talk about medical inflation.
Yeah.
But that is like, from an investment point of view, it's a good thing, right? A bit of medical inflation, not too much, I guess.
Yeah, the debate is out on whether it's a good thing or a bad thing, because the payer pressure is real for healthcare sector across the globe. I think it's not specific to India. I think we're hearing more of it in India now, more in the recent time, because you've seen the kind of growth you've seen in, as we call, revenue intensity or RPOB over the last 5 years. Will that decline? I don't think so. You'll probably see that moderating. There was always also the COVID catch-up, pent-up demand in terms of surgeries, insurance penetration increasing, which allowed people to sort of, move up room categories, and, that improves realizations for hospitals or revenue intensity for hospitals. There is a fair bit of debate on, at what point does it become a pressure for the hospital companies? I don't think it's anytime soon, because, your insurance companies are still fairly fragmented, private sector is still an important, provider of healthcare in
You don't think
India.
anything will be legislated in terms of, not legislated, but basically we've reported on the channel that there have been discussions between insurers, between hospitals, government's been involved, asking them not to take large price increases. Even 2026, and some of the hospitals we've spoken with have confirmed that.
Correct.
So you don't think that's a big overhang from an investor point of view? Does that come up?
See, I think let's not equate revenue intensity to price increase, because revenue intensity is a function of a lot of things: case mix, payer mix, etc. Your price increases is still, low single digit every year, which is what we call as tariff adjustments, right? And given the medical inflation or the input inflation, that's what the hospitals are, mentioning, that's the tariff adjustment that you're taking. So I don't think, that's at, the double digit number that your medical inflation shows. That's not the right reflection of it. And I don't see, that declining at any point of time, so at least in the near term.
In this space, stick with the large ones. Or is there a way to do this? Typically you'll have a company which will sort of, spend a lot, add capacity, then it'll go into a bit of a stabilization kind of phase. Then the next phase of expansion starts. And of course, now we've got lots of options. In the last 3-4 years, so many more companies are in the listed space.
Yeah. So I think you're right. You are seeing the sector go into expansion mode. So the selection would be based on how much capacity are you adding? Is it brownfield versus greenfield? So where could you see margin impact? Is it in your existing market versus, let's say, new market where your risk is higher? Given the entire sector is expanding, so you'll have to be a little more selective in terms of how you choose based on that expansion cycle, rather than, buying the entire sector, which worked perfectly for, last few years. Probably not, not so much this year, but otherwise, in the last 5 years, the entire sector is
You're saying valuations are high, so you got to be a little more
correct,
careful.
Especially as you're going into the expansion cycle.
Okay. No real, cheap names out there. They're all adequately well priced from a near-term
That's
perspective.
correct. They are all, I think, even mid-caps, large caps are all trading. There could be some discount between companies, but they're largely trading much higher than the historical average for some of the companies that have a longer trading history.
Amish, these two sectors, right? Autos and hospitals, pharma, form part of the core overall kind of portfolio, very much so?
Yes and no. So let's say within the auto space, we like the passenger vehicles space, but we are not that optimistic on the two-wheelers. Because broadly we think that the mass consumption categories are still going to see a very shallow growth revival as compared to, let's say, a well-off consumption basket that will do very well. So in the well-off, you will have passenger vehicles come in, but the mass consumption is two-wheelers, where our view is that the consumer will still take time to delever before he starts to consume in a big way.
And what about
we were not that optimistic on pharma. We were positive on hospitals all throughout. Not so much optimistic on the generic pharma space. but for the next year, we have upgraded that to an overweight.
You know, this India, and Neha mentioned that in the tariffs and Section 232 tariffs, broadly the India-US deal, it's kind of gone to the back burner, right? People were in the game of predicting it this week, next week. It's gone quiet. It'll happen. I guess that's the attitude?
Oh, absolutely. So I think, when I was saying that the risks are skewed to the upside, India-US trade deal getting protracted is one of the downside risks that we worry. Outside of the worries about what if rupee continues to depreciate, what if crude prices go up, and what if there is indeed a AI valuation bubble. So those are the 4 risks that we are looking out for. And as we know, India-US trade deal, the direct impact of that on current accounts and GDP is not that very high, but the follow-through effect of that, or the cascading indirect impact, that we do worry, and that is definitely...
What is the BOFA team, say, in Washington, etc.? What's their view? I mean, what's kind of holding this up? I mean, all kinds of theories out there, but is it going to be protracted? Is it going to happen? And how will it happen? When you talk about a deal, is the penal tariff of 25 going to go away? The reciprocal also is going to get addressed. All of it in one shot. What should we expect?
So the feedback that we get from the stakeholders in Delhi is that discussions are all done, and then now it is just about the final signatory. How much time will that take is anybody's guess as of now.
And what about from
similar voices? So similar voices. The idea is that they want to get done with these deals and then focus on the local politics, especially as the midterms come through.
On this AI question which you raised, what's the BOFA global team's view?
We are in the positive camp. So our global team believes that AI valuation is not a bubble. They think it still has legs for growth. And then as the applications of AI starts coming through, they do think that these companies will be able to show a revenue model and therefore continue to demonstrate earnings growth, and the stocks will continue to do well.
Does that come up as a bit of a point that in India maybe? But I guess slowly the view is changing now, right? I mean, it was the fact that we don't have a foundational AI play, etc., etc. But maybe, I mean, no one knows where the value will settle. So maybe adopters will win at the end, and perhaps India is there.
Absolutely. And that's why, if the AI valuation is indeed a bubble, India will definitely outperform the US, which is what we are reflecting as a house view as well when we are talking about S&P going up only 4% next year, whereas Nifty going up 12% next year.
Amish, hopefully no bubble. And even if it's a bubble, as you say, perhaps things are going to look a little better for us because, of course, we've, in a way, paid the price in 2025. Thank you all for joining us. Amish, Neha, Gunjan, thank you for dropping by. And I hope we can do this sometime in the middle of 2026 and take stock of some of the predictions and views that you guys have presented. Thank you.
Thank you.
We look forward. Well, that's it from me. A series of conversations, Outlook 2026, focused on, of course, what will make money, what will work as we flip over into the new year. Thanks for watching.
weather this morning, well, we'll let Squawk on the Street get you caught up with that. Make sure you join us tomorrow. Right now, it's time for Squawk on the Street.
The 10th Global Economic Summit and the 6th World Trade Expo came together on one platform in Mumbai under the theme Accelerating Global Trade, Fostering Partnerships, Connectivity and Resilience. As the summit progressed, the exhibition and conversations explored opportunities that are shaping the future of global commerce. A candid fireside chat followed, featuring insights from the Executive Director of Muthoot Microfin on India's rapidly evolving microfinance ecosystem, in conversation with the Senior Director of AIAI.
How do you see financial inclusion shifting from access to real ownership in Bharat?
Initially, it was just, having an entry into the financial market, right? Now things have changed so much that people want choice, people want to see the access, what they are using with the financial product, right? So, for example, if you look at our microfinance business, where the customer is focused on how she needs to repay the amount, what the amount she has to save up at the end of the month, and when she has to repay it, right? And also we have added few initiatives like how she can save up going forward to create a alternate, source of money for her family. That is on the microfinance side. And if you come to our gold finance, Muthoot FinCorp, where we give working capital. So if you look at it from earlier time where gold loan was used as an emergency loan, things have shifted from emergency loan to a working capital loan, where customers are using these products to enable themselves to look at creating a working capital loan to enhance their products. And through this, we could also start providing MSME loans or LAP, where they can go to the next level of expanding their business.
Okay, the next question is, how is technology changing the way people understand and manage their money? Obviously, now technology is taking over. Whether we have to pay, we don't have to always have our cards or cash with us. If we have a GPay, Paytm, PayU, I think there's so many other gateways started.
As an organization which is focused on the development of Bharat, we believe all-inclusive growth is the way forward for a country like India. And with technology, we want to bring that inclusiveness in the best way possible. And if you take each of our organizations like the Microfin, which works literally at the bottom half of the pyramid, we kind of educate these customers how to start saving up, basic savings products. We teach them how they need to digitally repay. So most of these customers have just maybe graduated themselves to starting using to how to repay and all that. And obviously India Stack has helped. That is the Google Pay and all those jam facilities which we see. And more as we go deeper, we are educating them to use digital means more responsibly. And the whole phygital capability which we have built helps these customers to put a face to these, the digital aspect of it. So what we kind of focus on is enhancing our phygital capabilities through our platform, which is Muthoot FinCorp One, where we have a digital avatar plus a physical avatar.
Next, the High Impact Panel discussed the future of global trade through the lens of AI and fintech, highlighting how new technologies are expanding access, improving efficiency, and enabling more inclusive participation in global markets.
Firstly, I think if you think about trade, and when you think about in your context, what you have been able to do, what do you feel is really the trade today, given the trade barriers and the tariffs that we have had situations in around the world? And when you think about really the data protection in that context, how do you see whether data needs to be protected or shared? Because the trade assumes
sharing of the data. The purpose of data protection legislation is to remove trade barriers. That's set into, for example, in the GDPR, it's one of the founding principles of the GDPR, is to enable the free flow of data across borders. And so with India now introducing the DPDPA, the intention behind that is in part to open up India's information economy and allow data to flow in and out. So it's part of that Indian export opportunity. But it only works if the data is used responsibly, because only if it's used responsibly will people choose to share it and share it accurately. So a proper commitment to the principles of data protection and proper attention being paid to the implementation of effective data protection programs is part of that opening up.
The context of what Ben mentioned in terms of data sharing, how does the governance play a role in this, in facilitating the trade across the nations?
India is very involved in the technology. Is not only adopting technology, is defining technology for the rest of the world. For centuries, the West believed that the East are the students. They have to learn from the West. But now the time is over. The secular change. And what we are trying to do with our foundation is to see, we will take the technology from India and bring it to Geneva, wrap it, and make things that to be sure that one Indian entrepreneur, one is developing amazing business in India, the global financial system doesn't take it like a risk, but like an opportunity. So that is our goal, is not to be a teacher, but to open the gate. Because for us, there is no choice between heritage and global access. You can have the both, and that is important for us.
Now, let me ask this question to you, Bruce. Doctor mentioned that there is an acceleration to be done from India across the world. And you have been in India for some time, and you have been at the forefront of looking at AI and innovation. What's your take on this? Are we ready? Are we not ready? Where are we in terms of our trade?
If I think about AI and fintech for a second, financial services is made up of two things. It's made up of manufacturing and it's made up of distribution. And from a manufacturing perspective, and that's my business, Investory, I works in manufacturing. So we're all about manufacturing, investment recommendations and portfolios and intraday trading for individual investors. What I see AI is doing is AI is allowing us to drive down the cost of manufacturing. And if you can drive down the cost of manufacturing and make it work in an Indian context, you can start to make it work in a global context. So for me, AI is kind of really working in that. And I think the change that AI is doing is it's meaning that time and materials, so service companies are going to find it harder and harder to make money. And actually, you need to have some IP. You need to be a product company. And I think that the India challenge today is not to rely on other people's AI, but how we develop our own AI in country and how we develop our own products.
Let me turn to you, Debbie. You have been doing some very interesting work in Madrid registry, right? Now, I would take a bet that probably 80% of the people present here do not know about Madrid registry. Would you be kind enough to just explain first what it is, and then think about explaining to the people what context does it have in trade?
So the Madrid system is the international system for registration of trademarks. So it means working with your local IP office, and you can file one international application in English, and you can designate up to 130 countries. So instead of having separate national rights you need to manage and maintain through different local attorneys, you have one international registration and one renewal date. So using the Madrid system will give you a much easier access to your export markets. No need to have local attorneys in different countries when you file. No need to pay for translations. And you have one right to manage centrally through WIPO. So this is going to make your export business so much more speedy.
Thanks to everyone on the dais. I really love it. Thank you so much.
Building on that momentum, a dynamic panel examined cross-border opportunities, stronger market linkages, and emerging sectors that are drawing global interest toward India's rapidly expanding economy.
Let me start with you, Amit. Would you like to talk about your role and then talk about what your first impressions about this summit? And then in terms of what is she as the investment opportunities?
So our role as an authority is to promote the Kingdom of Saudi Arabia to be the investment hub globally. And I am, as Ahmed, it's my role is to focusing on the India investment file from the Kingdom of Saudi Arabia. The Saudi Arabia is one of the fastest growing economy and most resilient economies. And I believe with India, we have a lot of opportunities to work together in different sectors. We have more than 13 sectors in the kingdom where we are looking to attract more expertise from global and India, one of our partnership.
Let me turn to the left. What do you think, let's start with you, sir. What do you think is your goal going forward in terms of your intentions with India? In terms of both the trade, India in and India out. How do you see that happening in goods and services and in terms of the commitments made by either of?
First of all, I think Sudan is one of the very important countries in Africa. It used to be the biggest country until 2011. And then after the secession of South Sudan, now we are the third largest country in Africa. The next phase for us, for Sudan, is reconstruction, the reconstruction phase. And here, this is where India comes as one of the partners that Sudan needs to work with. We believe India has much to offer in terms of the reconstruction efforts of Sudan. One of the areas that I believe we can have good partnership in India with is agriculture. Actually, considering the great achievements that India managed to make in the last decades in agriculture, in transforming the whole agricultural sector in the country through different mechanisms and different policies. For example, the experience of the FPOs, Farmers Producer Organizations, which is a very successful experience in developing rural areas and empowering rural communities. Sudan can learn from this experience.
Now let me come to you, sir. From your point of view, what do you think the potential lies between India and where you come from?
We have a national development strategy. We're looking at the 2030 plan, which is around a low carbon development program. We're focusing on food security, energy security, and climate security. 87% of our land mass is covered by standing forests. We are being paid currently by some organizations and some countries to keep those forests standing and to do sustainable harvesting. Like I said, we are looking at climate security as one of the pillars of our development agenda. And, you know, sometimes food security, energy security can come into conflict with climate security. But because of our program, our low carbon development strategy, we want to be carbon neutral as early as possible. And that is why there are significant investments by Indian companies in solar energy program, in hydroelectric program, and also in construction.
And let me take this opportunity to welcome on stage High Commissioner of Tanzania, Mr. Kanuti Mosha. Welcome. He's the person responsible for investment in Tanzania. And in fact, in the interest of time, probably we'll just do a quick roundup of what Tanzania has to do with India, both India in, India out. If you could just summarize from the trade, investment, and business point of view.
Now, Tanzania has a lot of
investment opportunities available for investors from India and globally. We have a very big arable land. So we have investors that are investing in agro-processing. We have Indian companies investing in cashew nuts, also in spices and other produce. But we also have opportunities in forestry. We have opportunities in mining. We have several Indian companies now investing in mining because we have a piece of land in Tanzania that has been found with a lot of graphite. So we have a lot of now applications from Indian companies doing investing in minerals.
This was followed by a focused fireside chat on sustainable trade, highlighting the responsible practices, green supply chains, and conscious innovations that are driving long-term global business growth.
Given everything that's going on with geopolitical tensions around the world, economic tensions around the world in terms of tariffs, the MSME sector and the agricultural sector, in my opinion, have become very focal points of the conversation. Since we're talking about this and tariffs is something that's on top of the agenda when anyone talks about trade in today's world. What are your first thoughts when it comes to trade balance across the world, looking at how disruptive the environment has become for MSMEs particularly, which are more vulnerable in my opinion?
While it becomes a very hot topic today to talk on an American tariff, we have actually not done our homework in terms of what are the available things on the plate. For example, the SEPA. The agreement, the partnership agreement, which we have already done with United Arab UAE, which says more than 90% tariff reduction happens, and we have our gems and jewelry industry getting benefited out of it. That is one part, which is SEPA. We are not studying CETA now, which is with United Kingdom, where again, ladies and gentlemen, we have 90% free trade agreements happening now. That is a market to look after. I feel we have to balance this out. We just cannot be focused on one part and say that the tariffs have increased. We have to see the other parts also from a geopolitical angle where we are opening markets.
Over the course of the journey, what would you say have been some of the most significant innovations that you made, that you decided to bet on, that changed the trajectory of the company, and those that you thought would work but actually failed?
Yeah. So if you look at a brand like Parachute, we just started with coconut oil, and then it was, at that time it was in tins. We converted the whole market in plastics. Then again rolled out all the innovations in Bangladesh. In that market, we have 80% market share. And then we use the property of coconut to go into other skin, hair care products. So I think that's the whole journey of Parachute and its extension. And now we are seeing it at a global opportunity in terms of leveraging coconut as a superfood in other developed markets. Hair oiling in other countries also is catching on in developed markets. So can we tap that opportunity? So through the Parachute brand name is something which has evolved quite a lot. And similarly with Saffola, started with oils, we went into blended oils, and now we have cold pressed oils also, and then into foods also. So we've gone to oats, masala oats. We have a whole range of Saffola honey, Saffola muesli. So I think leveraging those brands into related areas through extensions has played an important role, But we have failed also. We thought we launched fabric softeners, and we launched it at that time. I'm talking of 30 years back. We were too ahead of our times.
Yeah.
Now the fabric softener market is caught on, but we launched it. So timing also plays a very important role in terms of when to launch. And you do it too prematurely, and then the market is not ready.
Yeah.
So the right timing is, now it's become a big category.
As you look at where Marico finds itself today, and the market has changed, consumer habits have changed, consumer behavior has changed.
Yes.
What excites you about the opportunity, but also what worries you about the change that you're seeing?
So I think you are absolutely right that the consumer habits are changing very fast. Earlier there was to be brands which are for family, then became quite personal. And in terms of marketing language, we used to call it segmentation. Now there is micro segmentation with the emergence of D2C brands. So there is a huge discontinuity because of technology, because of consumer habits. And I think you have to look at it from two windows. What is the threat to your organization? You have to protect that. And what is the opportunity arising out of those discontinuities? And I'll just give you an example of D2C brands. FMCG as a sector is perceived to be very defensive because you needed big money to create a brand through television, through press, and the kind of budgets you needed to launch a national product would be in upwards of 20 crores. You needed a huge distribution network to tap into all of India in rural area and going to millions of outlets. Very difficult for any newcomer to get that, to spend that money unless one is willing for a huge long-term sacrifice. So in a way, we were in a cocoon where we didn't see any new competition coming in.
Yeah.
Come all of a sudden D2C brands and
the competitive landscape has changed.
Changed completely. You can do digital marketing. Your budgets could be 1/10 of the FMCG budgets. You can go
use
through
social
marketplaces, social media. Then you go to Amazon, e-commerce initiatives. Now Q-commerce come in. So all of a sudden, because of those entry barriers going away. So there are two ways of looking at it. As I said, one is threats. So how do you protect your current businesses? Of course, you take whatever action is needed. But more importantly, what are the opportunities arising out of D2C threats? So we acquired 4 brands in the last 3 years.
Yeah.
And today, annualized turnover of those 4 brands are upwards of 1,000 crores. All of them have scaled up very well. But we have managed that very differently because the mindset required to manage a D2C brand is very different than the mindset required to manage an FMCG brand. So different team, much younger, very digital savvy, small budgets, a lot of fast reaction time.
So they're islands within the Marico universe.
Yes. And I'm glad we did it that way because if you had combined with the FMCG marketing, it would have not worked out because they have abundance in terms of budgets. Here you have frugality in terms of the budgets and the way you work, very, very fast pace of action. And we also have our own D2C brands.
Yeah.
So I'm just giving, so this was a threat and we turned it into opportunity. I think we may be the most, if you look at all the FMCG companies, we may be the most aggressive in terms of acquisitions, in terms of number of brands we acquired.
So do you believe that given the landscape that you see today, as well as the fast-paced changes, that building is perhaps harder to do versus buying? Do you think that it's easier to buy your way to market share or build your way to market share and new categories?
So I think you're talking about acquisitions, which is, and I strongly believe in growth, okay? So growth has to be the most fundamental part of any organization. Growth has to be sustainable, it has to be profitable. And acquisitions, sometimes, many companies think that acquisition is very sexy because it gets talked about.
Yeah.
You get a lot of visibility. But I think you should be clear why you're acquiring a brand. Is it to get into new category? Is it to consolidate your market share? Is it to enter a new country? So we've made something like 25 acquisitions. And I think overall our success rate in acquisitions is much, much higher than the perceived success rate of overall global acquisition success rate. They say is roughly about 30%. And failure rate is 70%. In our case, it's more than 80% is successful. Because we are very clear why we are acquiring. Now to answer your question whether it should we look at organic or inorganic growth, I think you have to pursue both. You can't just say I will only look at acquisition because you may not get an acquisition. Or you may get an acquisition which may be very, very expensive and you may not want to pay that kind of a price. So you just can't say, I think organizations have to look at organic, inorganic, because once you acquire a company, again, it has to go through an organic route of expansion.
Exactly.
So organic capabilities have to be there. In some of the D2C brands, we have allowed the promoter to continue. So it's important to be flexible when you acquire. You can't say everything I want from day one. Because if I told that promoter that please sell 100%, they would never ever agree. They want to continue participating in that journey for 2-3 years. They want to see an upside. And also have patience when you integrate acquisitions. You just can't behave like a cowboy that day one you acquire a company and start changing because that company has certain strengths, certain people strengths also. And you can't just create that fear in the people that, okay, we are going to change everything. You have to go deeper and then, of course, over a period of time, what's not working well, you have to change, but you can't from day one start changing things. The other thing which we say is that governance play a very important. Some of the companies we acquired had very bad governance. On that, we will not compromise.
And that brings me to the question on culture, because I know that you see yourself as the custodian of the culture that you've helped create and build here at Marico. And culture is not just compliance with what the regulation wants you to do or mandates you to do. It's much more than that. Why has culture meant so much to you from the very start? I know that you believe from day zero that governance should be part of your preamble, as a company. What made you so conscious of that?
I don't know what made me conscious, but maybe a lot of reading. I read a lot. So because of those readings, I got a little bit more influence for the need to build a strong culture. And because of the innovations which succeeded prior to formation of Marico, I wanted to build a very strong culture of innovation. So how do you create a culture of innovation was the biggest challenge. So I wrote down a lot of thoughts on my own and shared with my team at that time. I'm talking of early 90s, where culture was not talked about. And they took a very positive response. Then I went to a consultant from Delhi, Dr. Mrityunjay Atreya, and with his help, we internalized the culture. I went and talked to people, but culture doesn't start, starting point was me. Ultimately, it has to be owned by the whole organization. And the top leadership has to play a very important role. If they say that this is MD's culture, I don't agree with it. It's a disaster. I don't want to paste our values in the reception, and down the line, people say that this is not the organization which it is. It has to be exactly based on, it has to be lived. And for that living to happen, the top management, the senior management has to set an example. So there is a lot of in-depth, shall I say, attention given to culture, because ultimately in any organization, strategy plays an important. Strategy and culture has to fit in with each other. Culture has to help strategy.
So how different is that handwritten code of conduct that you took to Professor Atre? How much of that has been translated into actual reality over the course of the last 3 decades?
Good question. I think over a period of time, cultural values, there may be a need to change because the business has changed. Those days, there was no digital, the agility was not there. So every 10, 15 years, we look at our values and change the values. Some of the new values which have come in are to do with agility, to do with emotional connect, to reduce bureaucracy. So to have a global mindset, because we went global at that time, we were only Indian company. So you have to relook at what has the business gone into and what are the new needs.
It's interesting that you